take your seats. The event will begin in 1 minute. The program will now begin.
Ladies and gentlemen, it's time. Come on. Let me hear you say, as he rocks like this. Scratch is so nice, gotta hear it twice. Kick it. Let me hear you say,
Please welcome the founder and host of DC Fintech Week, Chris Brummer.
It is so great to have you guys back again for yet another year of DC Fintech Week. I cannot believe it is 7 years on. This is an event that really takes an enormous amount of work from so many people across the city in Washington, D.C., from our powers of government and centers of government all the way to the financial industry, to the technology folks over out in Silicon Valley. So it is a pleasure to have you. DC Fintech Week has always, tried to be fun, even in DC. We've tried to be a little bit action-oriented and to kind of roll back the blinds a bit as to how policy is made in Washington, D.C., and really what industry is doing to kind of navigate how these things impact their business. The idea behind this, and I credit Chris Giancarlo, the former CFTC chairman, was, way back in the day, he wanted to have a safe space for people to have very different kinds of ideas and conversations on financial technology. I think that having that kind of space has become even more important. And we've added on to all of our fun activities and the growth within the city, a stream of things of everything from, as you'll see later today, epistemologists and venture capitalists and intelligence officers, to really trying to introduce new kinds of ideas to make us all think a little bit outside the box, and optimally to sometimes push back a little bit against the politicization of our policy discourse, which probably doesn't do anyone any favors, no matter where they're coming from. But we do like to really start with the facts. Almost every year we ask Robert Lee to give us a little bit of a grounding in terms of what is the investment climate looking like in financial technology. And so I'm going to welcome him to the stage briefly, but I did want to thank so many of the people who have been here at Fannie Mae. In particular, this is an amazing setup to really support this event for yet another year. So Robert, I'm going to cede the stage to you, and everybody enjoy.
Hello everyone, my name is Robert Lay. I'm a research analyst at PitchBook, covering crypto and fintech for venture capital and the private capital markets. First, I want to thank Chris for having me here again this year at DC Fintech Week. I was here last year. A lot of the discussions last year evolved around crypto and digital assets, and since then a lot has changed. And so I want to look ahead and see what has happened over the last year. And since then, a lot has happened in the markets where we've seen investment capital has shifted away from crypto and into other emerging technologies, but it's also slowed down as well over the last year. And one of the main reasons that happened is right after DC Fintech Week last year, we saw one of the largest crypto exchanges, FTX, collapse due to fraud. The exchange was last valued at $32 billion in the private markets, and they raised a total of $2.4 billion from venture capital investors, and that's combined between FTX and FTX US. And so that loss of capital is the largest amount of venture capital that has ever been lost. Just for a little bit of context, Theranos raised only less than half of that at $1.1 billion. So you can just imagine the gravitude of how much venture capital dollars was lost in that deal. This all happened in a rising interest rate environment. Since DC Fintech Week last year, we've seen interest rates rise a further 2%. So this has shifted a lot of investment dollars away from risk assets, so away from venture capital, away from crypto, but also contributed to the failures of some of the mid-sized banks like SVB, Silvergate, and Signature. And these banks were some of the most important partners for fintech and crypto companies. And so that not having a bank partner introduced new operational risk into fintech and crypto business models. And so that further led investors to shift away from investing into these companies. And so while that is all happening, on the other side, we've seen an explosion of AI applications over the last year, starting with the launch of ChatGPT at the end of last year. And ChatGPT has become the fastest growing application ever, reaching 100 million users in just the first 2 months after launch. And then since then, we've seen all kinds of use cases for AI applications, so investors have been a lot more interested in that space. So why am I telling you this, and why is this important? Well, what we like to do here at PitchBook is we like to follow the money. And so as you can see here, investing in fintech and crypto companies has declined significantly in 2023, while AI investments have remained very strong. In fact, the amount of capital that has been invested in AI companies this year is more than crypto and fintech combined. And the narrative is that, investors have shifted their focus away from crypto and fintech and into AI, and that's partly true. We've also seen a lot of crypto and fintech startups pivot into AI as well, partly to follow the money. But it's a little bit more nuanced to that. We think that there's more of a public market connection between fintech and crypto companies than there is for AI companies in the private markets, and I'll explain a little bit more. So between 2019 and 2021, we saw a large number of fintech companies go public. At the same time, we've also saw a large number of crypto companies launch publicly traded tokens. And so those things have public market value, and since they're all down, it has a direct negative impact on the private markets. AI, you would think about, there isn't a single pure play AI public company out there. And so AI private companies have been a little bit more insulated in the private markets from the public markets than crypto and fintech has been. And with that, I want to focus the next few slides focusing on AI. We know that this year, that's been most of the hype. No one's talking about fintech and crypto anymore. So let's see what's going on in terms of the investment data. And this is the VC deal flow data into AI. As you can see, there's been over $70 billion invested in AI companies this year. This is on track to surpass the $75.5 billion invested last year. So it's not going to reach the high of 2021, those figures, but it's still an incredible amount of investment going into AI this year in an environment in which venture capital dollars have contracted. So in most tech sectors, you've seen less VC investments, but in AI, that's not what you're seeing. I also want to point to you at the far dot right there. You see the 5,200 deals that are being done this year. That is a lot less than the roughly 7,800 deals done last year, even though the volume of capital is roughly the same, which means AI companies this year on a deal-by-deal basis are raising are getting larger check sizes for each investment than they did last year. So investors are writing bigger checks for AI companies. And here you can see why that's the case. Most of the capital that's going into AI companies this year is for growth stage and for venture growth startups. So these are the mature, established AI companies with significant market presence. And this is over 70% of the capital has gone into late stage and growth stage AI companies. And this is a divergent from what is going on in the broader VC ecosystem. As you may know, a lot of investors have shifted away from late stage startups this year and investing more in early stage startups. So a lot of late stage startups are having a more difficult time raising venture capital in 2023. But for AI, that isn't the case. As you can see here, AI companies are able to raise and earn most of the money from investors this year. And I also want to show the valuations for AI startups this year. As you can see, that top line there, late stage valuations have remained flat. And so what does that mean? Even though a lot of capital is still going into late stage AI companies, investors have been much more measured in this environment in terms of what valuations they're willing to give. And we think partly is because at the late stage it's starting to get a lot more saturated, but also investors are asking questions like, how are you going to reach profitability? And in our discussions with a lot of investors, there's a lot of scrutiny around business models, unit economics, customer acquisition, and how to sustainably build an AI company. These are things that were not asked or even discussed a lot of the times, not only in AI, but in all of tech in 2021 and early 2022. And these are the discussions that investors are having now. At the early stage, they're still up. So you see seed stage startups and late stage startups, the valuations are still up. And this is just following the trend that some of the capital is flowing into that area, but also investors do put a premium on growth and potential typically for early stage companies. But specifically for AI, there's just a lot of FOMO happening, and this is not unexpected, right? So there is a lot of FOMO happening, and investors do really want to get in early and back the really early disruptive technologies. So that is probably driving up the valuations at the early stage as well. And I want to showcase these 8 logos here. These 8 companies raised 1/3 of all the venture capital dollars in AI this year. So these are some really large deals. And OpenAI raised a $10 billion deal led by Microsoft in January. Anthropic recently, so they're a competitor of ChatGPT. They raised a $4 billion deal just 6 weeks ago in a deal led by Amazon. So this really goes back to my earlier point, is that these late-stage, well-established companies are the ones that are earning most of the investor dollars. And you can see that with just these 8 companies alone here. And so what can we expect moving forward when investing in AI, crypto, and fintech? We're still very bullish and excited in these areas. We think there's still a lot of opportunities, but it's also, these companies will face a lot more new challenges, and there's a lot of nuances to investing in these areas as well. And the first is that we see valuation expectations between founders and investors to converge over time, and this is over the near to the midterm. So you've seen, in the bull market highs, founders they enjoyed very high valuations, and this is what they're still expecting today. While the market is recalibrating and valuations have come down, investors are more measured, and investors are more conservative, and they're more cautious when they're giving out these valuations. And that gap has not closed yet, but there is still a gap between what founders are expecting and what investors are willing to give. But we think over the next 12 to 18 months, that gap will close, and it'll create more realignment between founders and investors. Because in the investment process right now, over the last year, what we've been hearing is that valuations has been one of the biggest points of contention and friction in the investment process. And we expect that to go away once the gap closes and more deals will get done. So over time, we expect more venture capital to increase because that the investment process, the friction process is going away. Next is that we think in this environment, it's going to be much harder for startups to raise venture capital, especially the ones that are at the end of their runway. And startups really have to showcase not only that they are on the path to profitability, but they really have a unique business proposition, because that is something that we did not see a lot of startups do in 2021 and early 2022. And so, over the last year, you've been hearing advice to startups to be judicious with their capital, to really make sure that they're hiring properly and they're growing sustainably. And the difficult part is not a lot of founders heeded that advice. And so we're seeing now a lot of startups that are at the end of the runway and they're not able to raise venture capital, which means over the next 6 to 12 months, you're going to see a lot more startups go out of business. And we track that, and we're starting to see an uptick of that already, and we expect that to accelerate over the next year or so. And the third point I want to make is that the pace of product development and technology development is unprecedented now. You're seeing new applications created faster than ever. And so what we're going to expect to see is there's going to be a lot more growth faster, but also we're going to expect to see the rate of failure increase as well. And so what we're excited about is, even though there's going to be a lot of new startups that are entering the space, there's also going to be a lot of failures. And the last point I want to make is that regulations and compliance will now become in the forefront for startups. As these technologies become more integrated into people's lives and more integrated into the global financial system, startups have to think more about regulatory compliance, because it's going to create more risk to their business model if they don't. And so you're going to start seeing startups very early on in their formation process already having compliance teams in place, or even policy teams in place. And this is something that was unheard of 2 years ago. And this does, unfortunately, increase the operational costs for startups very early on. And it's also something that investors will really have to be aware of when they're investing in these startups. And so with that, I just want to say, even though there are a lot of challenges in investing in AI, crypto, and fintech, we're still very excited about the opportunities in this space. And we're always open to speaking to founders, investors, and other stakeholders in this area. Thank you.
So on that happy note as to the future of investing in emerging technologies, I want to do a quick intro of one of two welcomes that we will have today from Fannie Mae. The first is with my good friend and colleague, Dave Benson. I sit on the board of Fannie, and Dave was the first person to actually co-sign on the idea of Fannie Mae being able to host a kind of event on financial innovation and technology for the DC community. And he did it last year when he couldn't even attend himself. I felt absolutely horrible, but he had some other matters that he had to take care of. So I'm going to have him make up for the absence of a welcome last year by welcoming the president of Fannie Mae, Dave Benson. Dave.
Well, hello, everyone, and welcome to Fannie Mae. I'm really delighted to welcome you to Midtown Center, and this, as Chris mentioned, is the second year running that we've had it here. We are really proud to host this event. Fannie Mae recognizes the importance of innovation to our business, which is housing finance. Now, Fannie Mae began as an innovation in 1938 as part of the New Deal. Franklin Roosevelt, remember him, created the Federal National Mortgage Association to provide liquidity for lenders to make long-term fixed-rate loans. So originally, we were a proof of concept. And 85 years later, I think the concept has been proven. So, we've never really stopped innovating. Going back into the 1990s, we pioneered automated underwriting. And more recently, we've been using AI and machine learning for things such as safely expanding access to credit, reducing bias in appraisals, and understanding climate risk. So, we know that AI and machine learning are increasingly important to our business and housing finance, but we also know that these technologies require strong governance and guardrails. So I'm very much looking forward to learning from today's conversations. So with that, let me welcome Chris back to the stage, along with Michael Barr, the Chair of Supervision of the Federal Reserve. Now, Michael was here last year, and we were so lucky to have him come once again to share his thoughts and expertise. So thank you for coming, Michael, and have a great day, everyone. Thank you.
All right, round two. Vice Chair, thank you so very much for joining us. This is not your first DC Fintech Week. It's not your second DC Fintech Week. It is not your third DC Fintech Week. This is your fourth DC Fintech Week. So even when you were professing in Michigan, the fact that you participated was great, and the fact that now, as Vice Chair, that you are still here is awesome, and we really appreciate it. I guess maybe we should just talk about, from a 10,000-foot level, a couple of basic questions about innovation, especially now that you are over at the Fed. We have a number of developments. I mean, we've been listening backstage to Robert's conversation about how the investment climate is changing. It changes both because of the economy, and it changes because of technology changing very rapidly. You had spoken backstage to some of my students a little bit about the differences between being a regulator and being a professor. I was really kind of curious, and I think that people would maybe appreciate, when new kinds of technologies come on board. This is, how does an agency like the Fed learn things? I mean, you just go on Twitter. How exactly, as a regulator, what does learning look like specifically for technology?
That's a great question, Chris. First of all, it's great to be back with you here at DC Fintech Week. I really enjoy the experience every time I come, and you have myself excluded, you have a terrific lineup.
Yes.
So really glad to be here. It's really important for us to learn about new technology all the time. One of the things I said to Chris's students this morning, they asked me what I like about my job, and I said, I get to go in and every day I learn something new. And that's really an incredible gift of this kind of position. We use lots of techniques to keep up with what's going on in the technology space. We do a lot of outreach, so we spend a lot of time, the staff and to a lesser extent me, just talking to people across the financial services landscape and in the business community to get access to what's going on in new technology. Of course, we talk to our supervised firms. Our banks are engaged in using technology to provide financial services to their customers. We ourselves are providers of technology services. We provide payments rails for the economy in conjunction with private sector rails that are offered. So we're very engaged in technology providing ourselves. And then we do research internally. We do policy research. We do basic research on the technology in-house as well. And that mix of things we use to try and keep up with what's going on around the country.
So you have little people pressing buttons inside the Fed to
We do have hands-on keys.
Okay, excellent. So AI is obviously one of the big issues of the day and of the year. When you have to learn about new kinds of technologies, I'll just use AI as an example. What does generative AI mean for the Fed, both as an institution and as it starts to look at its regulated entities?
Yeah, so first thing is I was listening with interest backstage to the discussion about AI. we think about these issues in very long time frames. So we're not thinking about AI in terms of, how people could make money tomorrow or not make money tomorrow. We're trying to think very long term about the role of AI in our society, how AI might have benefits and risks in economic policy terms. So AI might has the possibility of increasing productivity in a significant way for our economy, for the global economy, and that would have important ramifications for how we think about society. AI, people are excited about in part because it can potentially more readily embed itself in existing infrastructure and achieve that way scale faster than, say, a technology that has to build the hardware to run itself. So there are potential upsides in terms of increased productivity. We also look at potential risks. There may be significant economic dislocation associated with generative AI that might affect how people do work. What tasks within an individual job might end up being a move to generative AI, and therefore how the composition of the labor force might change. We think about the role of AI in making sure that we have a fair financial system. So if we have AI that reproduces or worsens social disparities based on race or ethnicity or gender in our society, if it's trained on bad data or if it has algorithms that replicate that kind of bias in our society, that's very bad. If AI can be used to help generate better financial inclusion by using data in a new way to bring more people into the financial system, that could be a benefit. We also think about AI in finance. Obviously, today, most algorithmic trading is very widespread, and that is a form of using machine learning to engage in trading activities. That can generate, again, benefits in terms of efficiencies, but also risks in terms of fairness, in terms of concerns about market manipulation, in terms of efficiency on the other side. So we just have to watch in a very long-term way the potential risks and benefits of artificial intelligence.
Well, it's interesting because many of the banks are or financial institutions, fintechs, other different market participants, they're moving pretty quickly. And when you're trying to develop that overall vision as to what AI may or may not do, you have one eye on, again, those banks, but also other parts of government. And you had the EO that came out. I was admittedly doing things like figuring out napkins for this event and couldn't go through all the details of the EO. But
what'd you pick?
Delightful colors. I was like, it's delightful. But to what extent did that EO impact your thinking, or does it even really touch on the Fed's thinking? And do you think that the Fed itself, I mean, you guys deal with risk and you have dealt with technology in different guises over the course of the history of the Fed. Is there something that you think the Fed's perspective can really bring to bear when it comes to the executive order?
I do think that the kinds of skills and talents the Federal Reserve brings to the table can help with AIs in other areas. And as I mentioned, one of the most important things for me is that we are able to, can, and do take a very long-term view. And so we're able to have a broader perspective to look at the benefits and risks in a balanced way and not to feel like we need to push or pull in relation to how people are thinking about it minute by minute through the course of a trading day, for example.
Yeah. I guess I'll then sort of move to a number of different areas that I know everyone wants to hear about. But
Did you take a poll on questions?
Well, Twitter. No, I'm just kidding. It's my students more than anything else. In our conversations, I get a sense as to what kinds of things keep them awake. When you think about your own experience, obviously AI is just sort of just one of many things. You've wrapped up very recently, questions relating to the core banking system with Silicon Valley Bank. Just now that you've had even more time, even after obviously being at the forefront of that process, any new lessons that you've perhaps learned from that experience, new insights that you think are going to be relevant as you move forward with everything from capital adequacy standards to other operational risk questions?
Chris, it's a great question. I'll speak to the SVB case in particular. As you mentioned, we issued a report on that. I think in some ways the lessons are very, very old. So the bank failed because of a classic case of interest rate mismanagement and liquidity risk mismanagement. Those are core issues in banking. They've been around since the beginning of banks. They relate to exactly what banks are set up to do. So in that sense, the lessons are old. What happened in that case is the depositors looked at the bank, and I'm not saying this is the right way to think about it, but the depositors marked to market the balance sheet on the asset side and said, we think that bank is insolvent, and they ran. So it reinforces the need for sound interest rate management, sound liquidity management, and robust capital so that banks are safe. Now, there are aspects of the SVB that are newer, not necessarily new, but newer. One is the extent to which the depositor base was networked with each other. In the traditional way of thinking about depositors, we think of each individual depositor, and then we ask ourselves questions like, is this a concentrated depositor group or not? But we traditionally have not asked the question, what's the network interconnection, direct network interconnection among the depositors? And it was very, very high in the case of SVB. And then we also had the role of social media on top that exacerbated people's reactions to how they looked at this set of issues. But I guess I would go back and say fundamentally it was in a sense, a traditional bank failure.
Well, I recently came back from a trip to Switzerland, and there everyone's talking about Credit Suisse. So let's move there. Which is I think is kind of interesting because there you had the unraveling of a GSIB, right? And when you think about how much work the country and the world had done in trying to prevent those kinds of incidents, I think more than a couple of people are wondering how that could have happened and what can we do to prevent it, precisely because it was already recognized as such a large, globally important financial institution. What do you take from Credit Suisse in particular?
Yeah, it's a great question. So first, let me just say, that I do think that the capital and liquidity reforms put in place after the global financial crisis had a significant effect on making that institution stronger than it otherwise would have been. And I also think the resolution frameworks that were developed post-GFC made a difference in terms of how the jurisdictions that were involved. It was primarily an entity that was regulated in Switzerland, but there are entities around the world, and so there has to be global coordination with respect to that institution, and that coordination came up out of that resolution planning process, and I think was quite helpful in dealing with it in the end. The Swiss obviously had a choice between doing a resolution strategy and a merger with UBS. They picked the UBS merger strategy. It ended up massively diluting the Credit Suisse shareholders, which is kind of what you'd want in that kind of resolution, either elimination or substantial dilution. They were to use contingent debt instruments, so-called AT1 instruments, to further squeeze down the debt of the institution, and then to transfer it to UBS in a way that it caused some dislocation in the moment, but didn't lead to a broader set of financial concerns. So I think that we've learned lessons from that. We'll keep learning lessons from that, but that's a basic set of takeaways.
It's one of those issues that I've always found, even in the media, like it's worth a little bit of attention. I think it's super important. Other issues that have attracted plenty of attention involves CBDCs and stablecoins, and really where the Fed is at this point in time at kind of thinking through the place for I should say CBDCs, stablecoins, and tokenized deposits, each different in their own ways. But maybe I'll just start off with the CBDC stablecoin question, and then maybe an extra question or two on the tokenized deposits. Where are you in your thinking right now?
Well, let me take on the question of stablecoins first.
Sure.
So there's obviously a lot of innovation happening in the private sector around stablecoins, and we want to make sure we can harness that innovation to improve efficiencies, if we can, in the payment system. I do think that if a private sector entity is creating a stablecoin that is connected to a fiat currency, in the case that we care about, the United States dollar, they're creating a form of private money. And private money needs to be well regulated. Private money, we've seen many examples throughout history, can cause significant risks in the financial system. And private money that's linked to the dollar basically borrows the trust of the Federal Reserve in its issuance. So we think there's a very strong interest in having strong federal regulation of stablecoins that makes sure that the Federal Reserve can approve stablecoin issuers, can regulate stablecoin issuers, can enforce against stablecoin issuers, and the set of protections around that, including how you deal with wallets and making sure that they're safe and sound. All of that, I think we need a strong federal framework for, and we don't have one of those yet.
So you really do need the Fed, the Congress to establish that. In an absence, that there's a limited amount of things that the Fed can do, or is it just a kind of a stopgap?
We think, I would just say, as a policy matter, it's better if the Congress can decide the basic rules of the road. Yeah. Now, on central bank digital currency, there also is a lot of innovation happening around in the world in that, and there are some countries who have moved forward with stable coins, at least in a limited way. There are many countries who are involved in research and development, many countries thinking about the policy framework. At the Federal Reserve, we're also taking a look at central bank digital currency. We're very focused on research questions. We haven't made a decision about whether it would be a good idea or not a good idea to establish this or that approach to central bank digital currency. If we did decide it made sense to do, for example, a retail central bank digital currency, we would only do that if Congress and the executive branch clearly authorized us to do that step with respect to retail CBDC. And in the meanwhile, we're doing research, and the research will help inform decision making about what we might recommend, and also help think about what the right payments architecture and infrastructure we might need, whether we use a CBDC or don't use a CBDC. Research can help inform how we can improve the payments infrastructure overall.
I think one of the questions that some of the people either attending or watching may have is when you think about the Fed's infrastructure, and it was interesting, you were talking about like the borrowing off the reputation of the Fed. That's an interesting way of certainly thinking about it. There are also very direct ways in which people would like to build on top of Fed infrastructure. You see other countries who have moved in that direction. What kinds of principles guide your thinking in terms of how and under what circumstances to enable that, particularly sort of outside of the traditional banking system?
Well, let me just start by how I think about payments infrastructure in general and what principles are really important in it. For me at least, I think we want a payments infrastructure that promotes financial inclusion. We want a payments infrastructure that works for everybody, that works for low-income people as well as upper-income people, that serves small businesses and not just big businesses. So we want to make sure our infrastructure is accessible to the real economy in that way. And we want to have an infrastructure that also works for the diversity of sizes and types of financial institutions in our country, from small community banks all the way up to the largest banks. So financial inclusion, diversity of approach, I think is really critical. Of course, we need a financial architecture, a payments architecture that is safe and secure and reliable. Those are absolutely essential. we need to make sure that the payments architecture has the right privacy protections so that people can trust using the system, because trust is really the essential linchpin of any payment system. Without trust, you can't make a payment, whatever technology you're using to underlie that basic approach. So these are the kinds of principles that I think are really critical. And when we're evaluating payments architecture, those are the things that we have top of mind.
I don't. Back in your academic world, we used to do things called writing law review papers.
Yeah.
Yeah, I know. It's a delightful experience. And one of the areas in which I've been thinking about over in London is thinking about some of those very same areas, and the fact that sometimes there are trade-offs between those, right? The financial inclusion point and the and whether or not you're getting everybody involved can impact the rate of innovation and vice versa. And also even your financial stability concerns may have interesting implications for limiting the degree to which you are able to be inclusive. When you think about that sort of medley of trade-offs, and again, the fact that banks are fragile, but they do have a certain way of working, and fintechs can be more fragile, but they can sometimes reach populations faster than others. It creates, as I said, this interesting mix. When you think about payments and then say the Community Reinvestment Act, right, which is designed to reach or to sort of activate or operationalize financial inclusion, but to sort of make it more modern because people use cell phones. How does that work in practice? And maybe you can give us some ideas that may be instructive for other areas as well.
Thanks, Chris. So some members of the audience might not know, but so the Community Reinvestment Act was passed in 1977, and it's a law designed to encourage banks to make loans, investments, and provide services to low and moderate income communities and households. It was updated in 1995, so more than 25 years ago, and we just last week introduced a new modernization of the rules under the Community Reinvestment Act. And those were designed to really bring CRA up to our current environment and to strengthen its ability to serve low and moderate income communities. You mentioned the fact that we all use cell phones for our services. I mean, we have to take that into account. So one of the things we did in the rule is say, in addition to banks serving the communities around where they have branch networks, that we should also make sure that when they're lending outside of those areas, which many banks do, that they're also serving low and moderate income communities as well. And we do that in a set of balanced, I think, and appropriate ways. But it's an example of updating CRA to the current circumstances. We do a lot of work to improve transparency and consistency across assessments so that if you're a bank in one part of the country, or you're a bank supervised by a certain bank supervisor, that the way that these tests are evaluated will be consistent, taking into account your local context, because every community is different, but being transparent and consistent across ratings is, I think, really an important innovation. We do a lot of work to make sure that minority depository institutions and community development financial institutions and similar institutions can get access to CRA consideration when a bank invests in them or lends to them, because those communities often rely on CDFIs and MDIs for that kind of innovative access you were describing before, in a way that banks can support and then eventually learn from and adapt and use in their own systems. So those are some of examples of the ways we've updated CRA.
Yeah, it's interesting because CRA it's a big deal. And, I was giving a keynote for HMT, and for October is their Black History Month, and I gave their talk. And one of the first questions I got was, should the CRA be implemented? And I said, oh, CRA, amazing. Navigating a digital environment, critical though, and that's certainly a tricky thing. A number of sort of points in some of your answers I thought were kind of interesting. I mean, when I was asking about AI, you were talking about, well, it could be, more of an efficiency here, and it could be helping more with, have other trade-offs there. But that your answers were very much the answers of someone who's, literally a voting member of FOMC, as opposed to the vice chair of the Fed, right? I mean, I guess one of them is. So what's it like being the regulatory guy voting on FOMC matters? And then secondly, just going back to that original sort of set of answers, how do you play those two against one another? Obviously, AI is what a lot of people are interested in, but just generally.
Yeah, great question. So I am a voting member of the Federal Open Markets Committee, and in that role, I'm quite focused on making sure that our economy is working for everyone. We have a dual mandate. We want to make sure that we're maximizing employment consistent with stable prices. And right now, we're in a situation where inflation has been very, very high. It's still too high. We've moved quite significantly to raise rates in order to make progress on inflation. We have been making progress over the last number of months, but there's still more work to do. And it's really critical that we continue to do the work necessary to make sure we get inflation down to 2%, because stable prices are really the bedrock for economic growth. They're the bedrock for stable employment over time. And so we're really quite committed to making sure that we do that. That we've currently in a place of taking a close look at the data as it comes in. We're going to continue to do that. So I think that's a really important part of my job as a governor and as vice chair for supervision. How do I think about how those things relate? We also, in addition to needing stable prices, we need a stable financial system for monetary policy work and for our economy to work. We need a financial system that is resilient to risks to it. That's why we pay a lot of attention to things like making sure we have robust capital requirements so that capital is there as a cushion in the event that a bank or a set of banks gets into trouble. And so we have a proposal out for comment on increasing the capital rules. We're taking comment on that now from the public, but it's a part of our overall frame for thinking about how do we have a resilient economy and a resilient financial system that really works for everybody.
All right. Well, just 10-second question. You've spoken a lot about diversity of services. Fed's been in the diversity conversation for quite a little while. What are you most proud of in terms of your achievements in the last year or so?
Well, I would say, let me just start with Chris, that there's always more work to do. So I don't think anybody should be in the position of touting where they are. There's just always more work to do to make our country a more inclusive and a more diverse and a more equitable place. And we take that very seriously at the Federal Reserve. The Federal Reserve Board currently, I believe, is the most diverse in history. Yeah. And that makes, I think, for better decision making. When we sit around the table with each other on the board, or when we're meeting with our colleagues more broadly in the FOMC, having that diversity is really quite essential for good decision making. And as you know, there's lots of research that demonstrates this in lots of different domains. I certainly feel on a personal level that I'm really glad to have that diversity around the table. We also have made progress in diversifying regional Federal Reserve banks in terms of the members of those boards that the board is responsible for. We do responsible for a third of the appointments. And we've made progress in terms of our staffing. If you look last year in 2022, a little bit less than half, about 49% of the hires we made, broadly speaking, identify as minority, which is a 7% increase from the prior year. But we still have work to do in particular areas. For example, we still do not have a very diverse PhD economics workforce. So we have a lot of work to do. We've made progress, but there's more to go.
Yeah, the Academy as well. Listen, you have been for a very long, many years, a role model and a friend, and thank you so much again. I know you're busy doing whatever vice chairs of supervision do, but thank you so much. We are going to head into our break. And we will have a great demo from the Vice President of Amazon on what AI is. We have Mike Su coming on. We have the CEO of the largest unicorn in Africa. So lots and lots of great stuff. We'll see you soon. All right, go get some coffee.
Thanks, Chris.
Thank you so much, man. right, welcome back, everybody. You know, I am a law professor, so I like to give homework assignments to people. And so I gave the Vice President of Technology, Dominic Del Molino, the homework of preparing a bit of a demo for you on what is the latest in AI and Gen AI and what it kind of means in practice. Because I think, just like all these other terms, stable coins, fintech, these are terms of art. And so I just wanted to have a little bit of a concrete grounding. So with that, I wanted to welcome Dominic to the stage to do his demo and his presentation. Enjoy.
All right, good morning. Thank you so much. I'm really excited to be here today, and the homework assignment was challenging for me, but I hope to introduce you to some of the stuff in my role in technology. I was listening to the earlier presentations, and there's plenty of terms that I didn't understand about some of the things you do in your world, but I wanted to share what we're seeing in the application of technology for government, education, healthcare, and nonprofits around the world. Particularly as it pertains to generative AI. So I'm not going to spend a lot of time on talking. I'm going to dive right in. We've got a lot of interesting demos and slides you can kind of see of where we're seeing application of generative AI. And I'm going to be here the rest of the day too and hope to get a chance to speak with you individually and see if you have questions. First off, innovation like generative AI can really transform industries. And I've heard some of the earlier talks about how the VC investments are exploding in AI, looking at the long-term impact of AI and innovation on industries. And analysts estimate, actually, that generative AI is going to increase global GDP by about 7% over the next 10 years. And that 2/3 of all of US and EU jobs will be directly affected by generative AI, with the market reaching over $100 billion by 2030. And that's why today over 80% of generative AI research is focused in this area. And it's also why we hear from customers that they want to go fast and they want to leverage their data to differentiate their business and their organization so they can take advantage of this innovation. We've all heard about the massive increase in data. But I think what's really interesting and what has caused this tipping point around generative AI is also that coupling of massive data with the ability to assemble large amounts of computing power to do all the maths, all the math that's necessary to help generative AI generate the amazing output that we're seeing. If any of you were like me and took linear algebra in college, you remember those systems of linear equations, and there'd be 10 by 10 factors and weights that would be applied to those equations. Today's computing clusters can do over 1 trillion of those weights on equations. Something is massively unfathomable if you think a few years ago. But that's what's really enabled this tipping point and power of generative AI today. And we've been using that capability, that massive amount of data, that massive amount of compute, along with new algorithms to really break through and have this interesting tipping point that's occurring over the last 2 years. We've seen a lot of attention about what consumers are doing in this space. But we're really excited about what organizations are going to be able to do as they apply this to their business and organizational problems. I wanted to quickly start to go through some of the educational elements here to help you understand where we are and where we've come from. Early on in machine learning, we were doing things like taking simple inputs and predicting simple outputs. Linear regression was a famous early form of statistical analysis that predated and helped germinate some of the ideas in machine learning. We then got into the neural network architecture phase of AI. This is the so-called deep learning capability. And this is where we would take complex inputs. The famous example of this is ImageNet, where we were taking images and taking pixels and colors and a lot of things that make a more complicated set of inputs to determine something we wanted to predict and have a simple output for. Labeling was a common application of deep learning. And then today, we've gone even further, and you can see the level of complexity of the model in that middle line there on foundation models, which are taking complex inputs and not just predicting a label or predicting an outcome, but also generating complex outputs. And so this is kind of the evolution of where we've seen AI models occur over the last few years and where we are today. And again, this is why it's so exciting that we're able to take advantage of the massive compute power to really generate these complex, interesting, innovative, and creative outputs. move on a little bit here. So again, when we looked at traditional AI models, they were purpose-built for specific use cases, oftentimes to predict an output, to predict a number that might occur, to predict a label on a picture. Use simple prediction type models to do summarization or extraction, even simple like FAQ chatbots where they would just simply take a question, match it and do a search to get the simple answer. But today what we've done is we've taken this massive amount of data on the internet and we've allowed the foundation models to essentially learn and understand and distill that information and learn about the way we talk, the way we've provided data, and we've made that data available in this massive capability. And because the foundation models now have that generic understanding, they can be used for a wide variety of purposes, including text generation, summarization, information extraction, Q&A, and chatbots that are very flexible, can understand context when provided a larger question rather than just a simple question and a simple answer. Here's an example of how a generative AI model may work when it's predicting and generating just a simple sentence in this case. You'll see here that we've got the students, they've opened something. You know, we might say if someone opened their eyes, right? But in this case, we have more context. We're looking at the holistic sentence as a totality to say, oh, because they're students, they're more likely to open their books or laptops than just simply opening their eyes or their mouths. This context becomes super important. Unfortunately, over the past 30 some odd years, we've been trained to search the internet with single keywords, right? With single word, and we hope that those documents that come back contain the word we're searching for. What we've always really wanted to provide the context. Why are we searching for something? What are we looking for? This is where generative AI has really come to the forefront. We can provide more of that context that help guide the answer toward the content that we're looking for. And this is an example of how generative AI works in a simple case, just to generate text and sentences. There are several different use cases that we've seen that are really starting to come to the forefront when we talk to our customers who are interacting with artificial intelligence and generative AI. The first is in enhancing customer experiences. What we've seen in the chatbot realm as an example of this is when someone comes and says they have a question, and we simply in the past would look up in our regulations or in our documentation, here's the content, here's the answer. Oftentimes we'd hear from people that's a frustrating answer. It doesn't take into account my situation. I want to give it more information about why I'm asking this question and what answer I'm hoping to get from it. And so enhancing a customer experience allows for someone to have that experience where they can provide that context. I'm in this situation, this is coming up for me in the next few weeks. This is the kind of information I'm looking for. How can you help me? And providing all of that context to a foundation model or to generative AI really allows the model to generate a much more unique and enriched customer experience. What we've also seen is examples of boosting employee productivity and creativity. Like many organizations, early on when we started to experiment with generative AI, we wanted to be very clear about what generative AI capabilities on the internet we would allow employees to use, right? We were rather concerned about sharing certain kinds of information. But we understood the importance and the creativity and productivity boost we could provide our employees. And so today at Amazon, we allow generative AI internally for use. And we have amazing capabilities for productivity and creativity. An example of this is we have several speakers who are authorized to talk about generative AI, folks like myself and other colleagues, senior executives. Unfortunately, we often don't share the same point of view. We'll say something a little bit different each time. And so we've actually used generative AI to take transcripts of senior executive talking points on generative AI, compare them, highlight what's similar, what's unique, what's different, and maybe where there's some contradictions that we need to resolve. But by using the power of generative AI, the people that are helping write our press releases and our marketing content are able to quickly identify that and become super productive. I find that just amazing. It's super cool. And then again, you can also apply this at writ large on document processing, cybersecurity, lots of different ways we're seeing customers come to us and say, oh my gosh, there's so many different ways we're applying AI and generative AI to optimize some of our business processes. And I've got a demo of that coming up in one of our later slides here. When we first, Amazon's been doing AI for quite a long time. How many people in here have an Alexa device in their home, right? You know, many people do. When it first launched, let me tell you a little bit about how that sounded.
I love The Starry Night by Vincent van Gogh. It depicts the view from his asylum room at Saint Remy de Provence just before sunrise, with the addition of an imaginary village. I like this painting because its vibrant use of colors captures a profound emotional intensity.
So the voice is interesting, but you'll notice one thing. It's very single-paced. It doesn't pause. There's no emphasis on anything. It's just very, maybe robotic, might be a word we might use when we describe that. This is what Alexa is going to sound like next year when we've applied a lot of generative AI to understanding speech and the way people actually emote and have cadence when they talk.
I love The Starry Night by Vincent van Gogh. It depicts the view from his asylum room at Saint-Rémy-de-Provence just before sunrise, with the addition of an imaginary village. I like this painting because its vibrant use of colors captures a profound emotional intensity.
You hear the difference? It's pretty impressive, isn't it? So I'm really excited to see what we're going to see from Alexa in the coming years, in addition to extra content and capabilities beyond just sounding much more human. Okay, let's talk about another use case. We've seen an opportunity to help customers be more productive when they have contractors and employees, developers, writing code. There's so much code that's out there, code snippets. In the past, someone would go out to a website, search for an example bit of code, copy-paste it into their editor to keep working. But we found that there's a way to actually embed that capability right within the environment where a developer can describe what they're trying to do, and a specially trained foundation model that has been tuned to understand code generates code in response to the need from the developer. So in this case, someone is saying, I just want to parse a string, return a list, and so by doing so, just with the comment there, the code is generated by a product we call Code Whisperer. This really allows people to become super productive. Matter of fact, in early results, we've seen people become at least 27% more productive and to complete their work 57% faster when they use this capability. I think this is something we would want to make sure that all of our developers have access to. And also some neat things here where you can say, is it secure code? Is it code that might have restrictive licensing? Don't pull in some code that may inadvertently place a burden on us from a licensing perspective. So there's some really cool ways you can augment and enrich the capabilities of people who are writing code to become more productive. This is a great tool that I think all developers should take advantage of. Okay, so this one's my favorite video capability. So this is a different case now. So before I was talking a little bit about text, a little bit about speech and sound. Let's get richer here. Let's get into video. So in the case here, what we've got is I've got a video that I want to make slow motion. So I've got a dog running. I want to take that video and then make it go in slow motion. Now, normally you can just play the video slower, but quite frankly, that's going to seem kind of odd, and I'll show you what that looks like. So this is the video in regular speed. This is me attempting to slow motion the regular video, and you see it kind of stuttering frame by frame. But look at the flowing dog hair in the second video as it's running along in slow motion. I just love this bit as you watch. Look at that. Right? So this is generative AI filling in between frames to give a smooth slow motion experience by understanding how to interpolate between images and pictures and video. This is pretty amazing stuff. And this is just an early example of how we're seeing people use generative AI to be creative in things they can produce. Many of you use Amazon Shopping, I hope, who ordered something from Amazon yesterday, right? But one of the things I know I've been excited about is this interesting capability to use generative AI to summarize and look through all of the reviews and content that people are using when they talk about an item. And actually, I was talking to my father the other day, and he said TripAdvisor is doing the same thing for reviews on hotels. And it's really interesting to see the generative AI summarization of reviews that are most commonly referred to elements. What does an actual average review kind of say about this product? And so I really find this kind of fascinating. Instead of kind of maybe wading through reviews, reading just the 5 stars and then the 1 stars and mentally trying to extrapolate, the fact that generative AI can do that for me makes my shopping experience a lot easier, and given the multitudinous number of products that are out there that I might be looking for. So super excited. You see this in the mobile app in particular, and you'll see this online. So this is a way we're using it to make it faster and easier for shoppers to get information about products they're interested in. Okay, I mentioned like business productivity, right? Those were all fun examples, right? And in the code one, you can talk about developer productivity. But let's talk about a broader use case, business productivity. So in this case, what we're talking about is a place where who's got 1 million dashboards they look at, right? Every day? Yeah, a lot of people do. And so one of the things I like is, well, can I use data to tell a story? I have data that I want to talk about. I want to make a presentation using data. How can I use generative AI to say, this is what I want to say? Are there data elements? Are there charts that help tell this story for me? So how can we add that to business intelligence dashboards to really make sure that that becomes more powerful? So here's the example that I've got for you.
Now, let's see how generative BI can help the business user who's going to use this dashboard. As a business user, I can quickly create polished stories using natural language that are tailored to my needs. This saves me hours or even days. Today, let's create a story about increasing the conversion of free trial customers into paying accounts so we can boost sales. In seconds, our story is ready. It has multiple sections filled with AI-generated text combined with visuals from our dashboard. The story is customizable. For example, I see this paragraph is about bundling features, but it's missing a visual. I can easily bring in any visual I have access to.
One of the things I like about this is you saw the visual come in and then
Here
it
at the bottom,
automatically generated
I
the
see the
text
next steps
next to it.
section is written as a paragraph, but I think bullets would be more effective. The generative editor allows me to use large language models to summarize this content in different ways. And it's that easy. As a business user, I can now share this story with my team to help them drive towards better data-driven decisions.
One of the reasons I think some of these examples are so powerful is we want to make sure that people understand the productivity increase that's enabled by generative AI is really something we want to make sure our employees, our contractors, our students are taking advantage of. And I know there's a lot of concern about, oh my goodness, how are we making sure people are enabled, know when to use generative AI, know when to evaluate the quality of the output? These are great questions. But now's the time to start learning and experimenting and understanding that so your employees, your contractors, your interns, everyone gets to take advantage of this boost in productivity that's just amazing. There's another example here that we've seen. I talked about the generative AI and the chatbot and customer experience approach here. So here we've got something from the UK where someone wants to search tax code information, right? And this might be in the past as be an FAQ bot, right? You'd ask a question, it would point to the relevant section of the code. But in this case, what I want to show you is someone who's saying, well, I need to understand a little more about my use case and how I can use what I should be doing in the code, in the text code. So this is retrieval augmented generation. So it's thinking about how to provide an answer and then searching in the content to make sure that information is relevant and provided to the individual. Right, so this is just what is an inheritance tax, but you'll also notice there's some interesting things here. I'm pointing to sources, not just the data, but then links to the actual source data as well. Okay, now I'm going to give some personal information. My income is this, what's my estimated tax range? Again, it searches and understands. It's almost like a natural language conversation that's based off the content, but also goes and refers back to the content, so it's really grounded in actual data, which I think is pretty cool. Even more fun, okay, well now I want you to draft an email based on what you just told me, based on my situation and how I can refer to this and send this in. So this is a really assistive and interactive experience that's based on actual data. The model is trained, it understands language, it understands context, and then can use the output from the questions to go search the actual data and then generate content that is based on the actual content that's available today. So this is super cool stuff. Okay, I mentioned that now's a good time to really start getting educated, and I've just given you a little taste of the different ways you can use, experiment, and explore the world of generative AI. But you're going to have lots of different ways you're going to want to think about doing this perhaps in your organization. You may have data scientists who are looking to embed this in their workflow and their processes and to enhance their models. You may have individuals who just are business users and want to get and use that BI capability. You have others who are saying, you know what, I want to build my own model. You mentioned it was capable. We have the capability today to assemble large amounts of computing technology and data. Can I build my own model? And so one of the things you want to make sure that's available to you is this wide range of capabilities. And one of the things I like about what we're trying to do at Amazon for customers is to give those entry points for different kinds of users. For the infrastructure user, for the experimenter who wants to build their own model, we want to make sure we have purpose-built chips, purpose-built hardware that can enhance and speed up that capability. We want to make sure that customers can take advantage of massive amounts of data and analyze it and determine which parts of the data they want to include if they are building their own model or using it for retrieval augmented generation. We want to make sure that there are examples of ways to embed generative AI in applications as well. So when you go from the foundational infrastructure level to the data management level to the data analysis level to just consuming a generative AI model, you want to make sure that all of those capabilities are available to you for the different kinds of use cases and users you have in your organization. And so when you're thinking about your journey to experiment with generative AI, it's useful to make sure you understand the totality of the folks in your organization to see what they're going to need, what they're interested in, and then make sure you've got a capability to satisfy those needs so you're not going down just one model to rule them all. We honestly don't think that's going to be the case in the long run anyway. I can tell you right now, a single large-scale model, you have to provide a lot of context to help it give an answer. I'll admit, I was sitting in the room the other day outside, and someone mentioned the word sluice. And I'm like, I don't know what that means. I'm a hydrodynamic engineer, and I think that has something to do with managing water flow, right? But for many of you in the room, it may mean something totally different. So you understand in these foundation models, particularly the large ones, you have to provide a lot of context to help it understand what you might want to talk about. And so a large model sometimes can be expensive to run, has a lot of parameters, and you have to provide a lot of data to say, no, I want you to talk about this area of information, not that area of information, because so many words sound the same. It's very useful to think about having a tuned model that's specific for a use case that knows what you're going to want to talk about. The perfect example in the deck here was the code whisperer one, right? If I'm asking it to generate code, I don't want it to kind of talk to me about how code works. I want actual code to come out. And so that's a model, foundation model, that's trained specifically on code, only understands questions about how to generate code, and only generates code as its output. That's a very useful and productive model. It's efficient, fast, and runs well. A very generic model will give me interesting answers, but may not always be tuned for the use case I want. So think about your different ways, and the possibility of different kinds of models I think will be very exciting. Lastly, I just wanted to make sure if you're at the level where you need to present this to your board, or you're thinking about just trying to make sure you have a grip on it when you're listening to people come and talk to you about generative AI, make sure that you're getting that kind of executive level training as well. And so I've put a little QR code up here on how we were making from Amazon just generative AI training available at that executive level, so you can baseline and have good conversations where they're very productive in that well. All right, so with that, I'm pretty much complete. I am going to turn this back over to Chris, and I'll be around later in the day for questions, but thank you so much. I hope you enjoyed the presentation.
All right, so we are going to go to our policy-driven conversations, moving again along this little continuum of what AI is, what does it look like, how does it feel, and how does it move, to a conversation with Mike Hsu, the acting comptroller of the currency, and Romain Bostic from Bloomberg. Bloomberg, as well as another members of our media community, have really stepped up the last couple of years, including this year, to really help us out, and we are enormously appreciative of that. So I'll just welcome to the stage Mike Hsu and Romain.
That was a great presentation that we just had there, and it dovetails nicely, I think, with our conversation, and really just kind of the role and the proliferation of AI in the banking system. And I'm curious, as a regulator here, how much time, how much thought have you put into how you're going to keep an eye on it?
A fair amount. It's hard to escape it. I think what's interesting to note is, machine learning has been around for a while. So a lot of the more recent buzz is really around generative AI, and that's warranted. But the financial industry has been involved with machine learning for quite some time, and so I think it's good to put that into context. We've got a saying, the better a car's brakes, the faster you can drive it safely. And I think that philosophy is a good one when thinking about new technologies, especially like AI. And so we try to apply that where we can.
How far are you in sync right now, I guess, with some of the developments in AI? Some would look at regulation or the lack thereof and saying there's a bit of a lag here between what the industry is doing and what regulators have implemented.
So it's a great question. So there is a little bit of distance between what you hear in the public, what gets discussed on investor calls, et cetera, and what's actually happening on the ground. In our experience, what we see, to the extent that banks are engaging or have been engaged, especially on machine learning, it's really been a crawl, walk, run approach with good controls, really focused on use cases that make sense and that meet the safety and soundness and fairness standards that we have. So I think some of the chatter is a little bit ahead of where the reality is, and we expect banks to continue to take that approach because it seems like the right one. Because there's a lot of opportunity there, but there's some risks. With machine learning, there's bias, discrimination, consumer protection issues. Those are very live. The banks know that. Supervisors know that. And with Gen AI, it's just a similar kind of profile in terms of opportunities and risks. And we want to make sure we're really thoughtful about that.
But how do you mitigate that? Is that your role? I mean, when I hear the word bias, I think, is that the role of OCC? Is that the role of other banking regulators?
Yeah, so our mission is, we got the parts of our mission to make sure that the federal banking system is safe and sound, operates safely and soundly, treats customers fairly, ensures that customers have fair access to financial services, complies with laws and regs. So if you're going to be using AI, if a bank is going to be using AI in some way, to meet those fairness standards, to comply with ECOA, Fair Housing Act, it's got to be fair. And so you can't have discrimination and bias baked into that. There's a lot of promise with AI. One of the risks, though, it's a prediction machine, and that prediction machine is based on historical data. And so to the extent that historical data has biases in it, we want to make sure that we're not just moving into a world that just locks everybody in to the past. And so I think there's a trade-off there, and that's why we focus on things like explainability and governance and those kinds of things.
But how do you police that then? Is it sort of going back and looking at the input data, or is it more looking at the end result and whether you can find some sort of bias in that result?
So it depends on the use case. And so there are plenty of use cases which are kind of lower stakes, where what's at issue is not going to have an impact on a particular consumer. There are other cases where underwriting, decision making, clearly that's going to have a higher impact, and so we calibrate our supervision accordingly. And it's kind of all the above. So it depends on what the issue is. But if there's a risk of disparate impacts, disparate outcomes, then we'll pay attention to that accordingly.
Have you used any of these chatbots or any of these AI tools yourself?
So yes, we have. We've got an internal policy where we have made very clear to folks currently these are public. These are in public cloud, right? They're all kind of running, so no private information is utilized. But we have encouraged folks at the OCC use it, right? Use it safely. There's guardrails around that, but we have to learn how to use these things because it's going to be part of the future. I've used it. It's been interesting.
Is there a concern about whether the banks are going to be willing to share some of the data that they're using to input into that? Some banks have already basically said, look, this is proprietary. This is things that we sort of need to keep, I guess, behind the veil of our own organizations. Once you ask the regulators to come in and look at it, it exposes them to a certain level of risk.
So for us, as regulators, we have access to all the information. So it's not a information flow that's necessary for us to do our jobs. I think there's other questions about sharing of data between institutions and others, and that starts to touch on open banking, some other issues.
Well, can we talk a little bit about open banking? Because it's not that far afield, I think, from what we're seeing with AI and with the whole rise of fintech here. The traditional banking regulatory system, you were kind of just dealing with one bank and maybe its counterparty. Now you have, I don't know, multiple counterparties and a lot of the whole ecosystem here. What does the umbrella of regulation look like for that?
All right, so this is we could talk for an entire couple hours just on this one particular question.
I think we only have 20 minutes.
So I'll speed it up. I'll give the ChatGPT summary. So I think there's two parts to really focus on. The first is, and you're exactly right, banking is no longer done by just banks. And increasingly, it's going to be banks working with non-banks. That's already the case. It's going to be more and more the case. And that's really important for us as regulators because our mission is to ensure that the banking system, banking services are safe, sound, and fair. So we need to make sure that those relationships are in service of that particular mission. So the federal banking agencies, OCC, FDIC, Fed, recently put out interagency guidance on third-party risk management. That's basically this nexus between banks and fintechs and others. That's just the first step. Like what's happening now is there's increasingly, we've got supply chains for banking services. It's not just a third party. The third party has a third party. So you've got fourth party, then you've got fifth party. So you've got kind of nth party risk. And we really need to be paying attention to these because on the one hand, you can get a lot of efficiencies. You can get innovation, you can get inclusion. On the other hand, you can get a huge diffusion of responsibility and accountability. And in my experience, this happened, I draw some analogies to capital markets disintermediation pre-2008. Because if you think about pre-2008, what happened? The lending activities that banks were doing got disintermediated by securities firms, securitization, asset managers, mortgage originators, a whole bunch of non-banks that basically chopped it up into a bunch of pieces and created essentially what was a supply chain, and it broke, right? It actually didn't achieve the efficiencies and the resilience. It created a bunch of opacity, was very fragile and brittle. And so there's a promise now that as banks, non-banks work together, we can get those good parts, but there's also a risk that we run into, we kind of recreate some of these problems from the past. So part of what we're trying to do is through guidance, through supervision, through examinations, let's ensure that we get the good stuff and that we can kind of prevent the bad stuff.
Is the dispersion of risk still greater now than what it was back then?
It depends. I mean, I think it really depends that you're seeing, take payments for instance. There's a lot of innovation in payments. So that's where you're seeing a lot of this unbundling, where it's kind of taking place outside of the banking sector through a lot of partnerships. In some of those cases, those innovations are really good. They're pro-consumer, they're more inclusive. That's good. We want to encourage that. But in other cases, it's just a race to the bottom. And you get a lot of erosion of standards, non-compliance, finger pointing, the kinds of things that we worry about. So it's something that we really need to kind of distinguish.
Do you need more authority with regards to, I guess, the types of companies, the types of institutions that you can regulate? It's one thing to sort of have oversight over a Chase Bank or a Wells Fargo, but what about, I don't know, Apple or Amazon or even something like a Firm or PayPal?
So that's a really, really important question. So for the banks that we supervise, we do have authorities under the Bank Services Company Act to look at providers to the bank, almost as an extension of the banking service. And we have exam authorities that go with that as an extension. That's good. And we utilize those, and I don't think those have to be revisited at this time. Now, to the extent that the ecosystem gets more complicated, and you have kind of more complicated chains, more complicated arrangements, rebundling of banking outside of the banking regulatory perimeter, that may require some more authorities. And that's something that we're constantly monitoring and talking to our interagency peers about.
We've heard from several members on the Fed board, including just in the past week, that have talked about this idea of needing greater regulation for non-bank financial institutions, particularly with the role of private capital in the banking system and obviously some of the other intermediaries that you've talked about here. Do you think there's enough appetite in Washington to actually see that through?
I'm not going to speculate about appetite in Washington. I can tell you what we're doing.
Okay.
And I already talked about third-party risk management. If you peel that onion, an area that does require, I think, a little bit more thinking is banking as a service. Because this is one of those areas where you've got non-banks basically facing off with customers, with others, and then relying on a bank sponsor, or sometimes bank sponsors, plural, to provide some of those services. Some of those are relatively straightforward, and you can see where the comparative advantage of a bank and a technology firm can come together and deliver responsible innovation for folks. That's great. Some of them are really complicated, and where you have this kind of vicious cycle between rapid growth and a diffusion of responsibility and accountability. And it's essentially a big regulatory arbitrage. And so we don't want to paint with a broad brush. We want to really dive into that, make sure we can figure out where that line is between good and bad, and kind of through supervision and through other mechanisms, encourage the former and prohibit the latter.
I mean, this debate did kind of heat up back in March and April after the collapse of SVB and some of the other regional banks, because this wasn't just necessarily about what was going on in the banking system. It was also about that extra risk that's surrounding those companies there. That still hasn't been addressed directly. I know there's some proposals out there, though, but what we saw back in March, April, May, has that actually been resolved, or is it on its way to being resolved?
So I would unpack that in a couple of different ways. I can say that from a supervisory perspective, we've addressed those things. So as we have a lot of supervisory authorities where we deal with banks individually. We've got examiners, they go on site and they say, okay, what are your key vulnerabilities? What are your key weaknesses? Plug those gaps. We can do that. We do that every day.
Okay.
Across a whole swath of banks. At the OCC, we regulate, oversee over 1,000 banks. Everyone knows the JPs and the Citis and the Wellses of the world. Also, 800 plus banks below $1 billion. Right? So it's all across the country. We do that all the time. And so to the extent that there were liquidity weaknesses, interest rate risk management weaknesses, others, identified, and we've taken action. Now, that's supervision. That's hard to see for the public to see. So there's a regulatory aspect to that, which we're working through with the other banking agencies for capital, for liquidity, for others. And so that's TBD.
So on the supervision side, though, for investors out there, do they need to worry about another SVB, another signature bank, at least in the moment right now?
So if I had wood to knock, I would knock on it and say, no for now. Because as supervisors, we really have targeted those vulnerabilities and been proactive in identifying where those risks are and getting those handled. In some cases, a regulatory solution would be preferable. It's a bit more stable, it's a bit more transparent. But again, that depends on the particular risk that we're talking about.
But this gets also to the idea, so what has changed between now and then? I mean, we haven't seen a formal increase in capital requirements. We know that there was this idea of assessing the risk of these banks in the context of higher interest rates and some other sort of forward-looking data. How much progress has been made on that?
So I want to be careful about. We've got some things kind of in train, in flight. There's the Basel III proposal, which was actually put into motion well before the events of the spring. So I'm glad you didn't conflate those things, because a lot of folks are conflating that. There are a number of things in train. I don't want to get in front of them before they're kind of ready to discuss publicly. But yeah, there's a lot of work being done to both kind of on a supervision basis, get things set, and then on a regulatory and kind of a more permanent basis, make those durable into the future.
And there's a lot of pushback. I mean, you mentioned Basel. I think Basel III was like proposed back in the BC times or something. Whenever that comes to fruition here, but the idea is that as those regulations take time to sort of get sorted out, you then have additional scandals or additional issues that arise in the system that then requires a revisit of that. When that finally comes to fruition, is it going to be enough?
Yeah. So the way I think one way to think about, say, capital regulation or liquidity regulation, I think of them like building codes. You want to have building codes. The building codes don't tell you what building to build. They don't tell you how to design those things. But there's specifications to say, if you build to these specs, that building will stand. And it will stand in good weather and bad weather, through stresses, through shocks. You don't have to worry about it. You can walk into this building and be assured, if there's some stress or shock, it's going to stand. That's what the building codes are for. That's how we think about capital requirements, liquidity requirements, et cetera, that are rules, because those are transparent. We go through the APA process. There'll be some complaints. There'll be some ideas. What we're really looking for are ideas, solutions. How do we make those so that they strike the right balance and make sure that they provide that assurance to folks that these are going to be good, and they're going to be good for time. So we don't have to constantly revisit these things every time there's a hiccup. That hiccups are part of life. Like, that should be just part of the normal course of what we do. We don't want to have to revisit these every single time.
You just don't want the hiccups to collapse the economy.
Yeah,
though.
or to call it. I mean, exactly. Hopefully we meet that.
I wasn't trying to be glib, but
no. Well, and again, we want them. to not result in a loss of confidence, because at the end of the day, and this is something I really plea when I talk to especially non-banks, banking and finance is all about trust. It is all about trust. And so you can't just take a pure technological development aspect to it. You have to realize, and trust is not something that you can mechanically calibrate to. It's something you really got to wrestle with. And banks, regulators, we deal with this all the time. We got a lot of experience to bear, to bring to it. And so I think marrying that with some of the opportunities with technology is the name of the game.
Well, on that point of trust, and I guess the proliferation of, I guess, the number of players in the banking system that aren't necessarily banks, there's also, as you know, a big movement to sort of create different modes of currency, different modes of payment here, particularly when it comes to crypto, which of course has had its own issues over the last year. We still have not gotten the formal regulation. I know that's not necessarily on your shoulders, so you should maybe go talk to Gary and a couple other people to see where they stand. But is there a solution, I guess, to the problem that I feel like crypto itself kind of created?
Yeah, so in my travels over the past year or so, and I talked to financial institutions, technology firms, other regulators globally. Whenever this comes up, something I have really, it's really emerged. There seems to be more and more of a divide between crypto on the one hand and tokenization of real world assets and liabilities on the other hand. What do I mean by that? Well, with crypto, that's the usual stuff that is reported in the press, and it's what basically shot up and then crashed. That's the crypto world. It's retail focused, largely, and it tends to be driven by the hope for speculative gain. That seems to be the main kind of fuel and interest in crypto, is that maybe I can make some money by investing in X, Y, or Z, a particular coin. It still remains replete with fraud, scams, and hacks. And some of the largest players remain unregulated. Crypto. Tokenization. What is tokenization about? Tokenization is focused on solving an actual problem, and that problem is settlement. Right? This is boring back office stuff, but it's super, super important. Every time you buy a security, every time you transfer money, there's a bunch of actions that happen in the background with regards to settling that transaction. And it seems invisible, but to those in the know, it involves a bunch of different players with a bunch of different handoffs. There's risks, there's frictions, there's fees. Tokenization holds the promise to collapse that and to simplify it if it's done right. And so when I talk to folks, there's increasing interest in tokenization because it solves a problem, and less interest on crypto. It's just like crypto is just, there's just so many problems with it. It's hard to comply with BSA and other laws. Whereas tokenization, if done right, you can really, that holds a lot of promise. The OCC, we're hosting a conference, a symposium in February on tokenization, where it's really going to be focused on legal rights, legal foundations, risk management foundations. Like, we want to establish, if you have good foundations, then that can grow and you get some really good responsible innovation out of it.
You mentioned the Bank Secrecy Act, and obviously it goes into this whole idea of know your customer here. I thought, if you believe the crypto faithful, or I should probably say more the blockchain faithful, the blockchain was supposed to address a lot of those issues. The idea was that it was a public ledger. There was some traceability here. What are the flaws there that you think need to be addressed through more regulation?
Sure. So at the risk of, this audience will get this. So with the blockchain, there's the public ledger. You get the wallet address. You don't know who that is. That's the fundamental problem. And there are all sorts of techniques to try to intuit or guess as to which wallet address belongs to whom. In some cases, you can make that transparent. But that's a fundamental challenge with the publicly permissioned blockchains. A lot of the tokenization efforts that I've seen are private. And in those private environments, you know exactly who you're dealing with. And you can apply all the KYC. So again, I think the reason why there's interest in tokenization is starting to take off, because it's a very clear problem for which you can try to provide solutions. And the solutions may or may not involve a blockchain. A lot of these solutions don't involve a distributed ledger in the way people understand it. It uses different techniques. It's kind of, we're technology agnostic, solve the problem, do it safe, sound, and fair. I think in the crypto space, there still continues to be we have this tool, we want to do stuff with this tool, versus what's the problem that they're trying to solve.
Would tokenization, though, still require banks to act as an intermediary? Would it still require, I guess, some degree of counterparty risk?
It depends. It depends on how the design is. And again, we don't have a strong view other than that development be done in a safe, sound, and fair manner, and we have some line of sight into that. That's our primary interest.
I've heard one of the criticisms towards regulators on this issue is the idea that know your customer should be different from know your transaction. And there have been a lot of folks in that space who've said that you can identify the transaction, have that transparency on the track on that side, while still, I guess, providing them some degree of anonymity, which is what some of those folks want.
Yeah, so I think there are some interesting efforts in this KYC space, and I think that it's an area where some innovation in terms of being able to achieve the policy objective, which is, why do we want to know the customers? Because we want to make sure we've got mechanisms to prevent illicit finance, terrorist financing. That's a really important goal. It's a law. It has criminal liability with it, so we don't want to mess around with that. We have to achieve that. Are there other ways of achieving it using some of the new techniques that are out there? We're open, right? We're open to understanding and exploring those, but not at the cost of not meeting that objective.
All right, Michael, this was a great conversation. I think we have to leave it there. Our thanks there to the acting comptroller of the currency. It's now time to call Chris back onto the stage. She's going to give you an overview of where technology is emerging, along with the CEO of the largest unicorn in Africa, Flutterwave.
Ladies and gentlemen, it's time.
All right. Well, I am delighted to sort of keep the conversation going, but with the question as to really where are emerging technologies actually emerging? And for that question, I am just delighted to have with me today GB, Olubinga Agbula, who is the CEO of Flutterwave. And Flutterwave, you guys are going public right now, or?
No, right now.
Not right now. Okay. But you've really, started with really interesting questions in terms of transforming payments in Africa. We've talked a lot about AI. We've talked about financial solutions. You heard a lot about what the acting comptroller was talking about in terms of limitations of financial technology. Also, we had Michael Barr, the vice chair of the Federal Reserve, talking about financial inclusion. When you hear words like financial inclusion, how do you think financial inclusion is different, in terms of the work that you do, when compared to, say, here in the States? I mean, is promoting financial inclusion in any way different? Is there a different meaning? Do you get the job done differently when you think about financial inclusion, say, in Africa as compared to here in the States?
Thank you, Chris. So inclusion from my perspective in Africa is really beyond just payment type expansion. It's really about payment type penetration, right? In Africa, where we've got amazing payment infrastructure, for example, go to Kenya, there's M-Pesa. M-Pesa is fantastic. In Nigeria, you have the NIPS infrastructure, NIP system, which are very fantastic real-time payment infrastructure. But that said, you can't use M-Pesa in Nigeria. You can't use NIPS in Kenya, right? So inclusion really for us at Flutterwave and in Africa is really about how do you defragment the payment ecosystem in Africa? How do you make it simple and easy for a company who wants to get paid from Lagos, Nigeria, to have customers in Nairobi, Kenya, or Accra, Ghana, or even in the US, right? So it's really about spreading the payment tentacles, making it easy for customers across geographies, across payment type, P2M, P2P, to pay seamlessly what they know how to use to pay. But that said, there's still a journey of inclusion in Africa going on as well. Nigeria, for example, one of the most highly banked countries in Africa. Infrastructure is at scale, but that said, I see a lot of unbanked population that is still being brought to the ecosystem. But the technology is there, the encouragement is there, and we have the infra to make it happen as well.
Okay, so you're talking about fragmented payment systems, fragmented banking systems. Largely banked, but still, weirdly, the system not being optimized. I would never know how in the world that could relate to challenges here that we would have to deal with. It sounds so different. Okay, so maybe you can tell us just a little bit When you think about Flutterwave, and again, I mean, very impressive growth, really impressive company, coming out of the continent. What is it that you guys do that's just different from what what problem are you solving that other both governments and other companies are apparently not solving?
So I think we actually complement the work government is doing across all the jurisdictions that we operate in. For example, in Nigeria, there has been a lot of central bank-backed, payment regulation that's actually enhanced innovation in payment infrastructure. In the last 5 to 6 years in Nigeria, so many fintech have sprung up, and they are growing and scaling because of the Central Bank of Nigeria's backing and their support for innovation. As a matter of fact, the first CBDC in Africa was done by the Nigerian Central Bank of Nigeria, right? And that is the in era. So that shows you the amount of innovation you see with government and regulator in that part of the world. That said, what we're solving for really is, defragmenting Africa payment opportunity, right? We want to make it easy for a small business who is selling to customers everywhere in Africa to get paid in a very simple manner. We want to expand the world of that small business in Lagos, Nigeria, or in Accra, Ghana, or Nairobi, Kenya, to sell to anywhere in the world through our platform, right? And that will require us to ensure that we are present in every corridor where they can get paid, and ensure that we have the infrastructure that makes that payment seamless as well as ensuring that all the risk infrastructure are also well taken care of. That's what we're solving for. For example, today we have a product called SendUp, a remittance product, that Africans in diaspora in the US can use to send money back home into Africa. Our goal is to help drive more foreign currency inflow into Nigeria, right, through that product. And that is growing as well. We also help merchants like Uber, airlines in Africa to get paid by customers in Africa as well through our platform. So we're basically playing on the merchant acquiring side and also on the remittance side.
So you're at times even playing as the infrastructure provider for Uber in Africa.
Yes.
That's interesting. So when you go through and you think about, again, the question of interoperability, and this is going to be a big theme. The Bank for International Settlements is one of our regulatory sort of co-hosts, and they're interested in these kinds of issues as well. What were the major frictions, in building a unicorn company in Africa? Like from a building standpoint, how do you make that kind of interstate highway of sorts? Like what were the more interesting parts of that journey?
I think we've built on the infrastructure that of the likes of M-Pesa, the banking system in Nigeria, Kenya, Ghana, all over Africa. That infrastructure is extremely reliable and extremely grown. Over the years, they've served consumers and banks across Africa successfully. And what we're trying to do basically is how do we bring everything together and create an interoperable network in between the banks, the payment systems, the wallets, and the accounts across the continent? How do we make sure we create value and still earn it back to the bank as well? So what we do really is we complement existing solutions. We're not a wallet holder, we don't hold value. We deliberately work with the banks and the wallet holders to ensure that we are helping them to also expand their own tentacles and also ensure that the customer can get more value for payment through our platform.
So getting back, when you look at that process, and a lot of what you're doing is small business oriented for entrepreneurs, particularly in Africa. Getting back to this question of financial inclusion, what are the kinds of things, and I guess I'll restate it from a more pugnacious standpoint here. What are the kinds of things people need in order to enable financial inclusions? What kinds of solutions do you think that people really need? We've discussed, for example, before, you're not really a big fan of digital assets. Maybe you can explain sort of, what are the kinds of solutions you like, and why, we're talking a little bit about CBDCs, but like when you look at the digital asset space, what is it about it that makes you more skeptical?
So if you look at the way Africa is structured, the basic requirement for the average business or consumer in Africa is really, how do I pay? I want to pay my bills, I want to pay for airtime, I want to pay merchants. Those are the basic things they want to pay for, right? At the end of the day, for the consumer, it has to be simple, it has to be seamless. Not have a long wallet address or anything like that. It has to make sense, which is why I personally backed the Nigeria Union CBDC project, because for me, that's an example of a consumer-friendly digital asset solution that is regulatory compliant at the same time is creating value in the ecosystem, right? At the end of the day, the average consumer just wants to pay or get paid. People don't wake up with the money they want to pay something. They just want to do what they want to do. And I think embedding payment in there is important, but it's really about making payments so simple for the consumer to be able to use. And you know, if you look at Kenya and Nigeria, for example, you will see a lot of financial inclusion innovation and investment by both regulators and also companies that you have thought with. And I think there's a lot of mileage are being made right now because of that focus on how do you actually create value, right, for the consumer on the ground? How do you make sure what we're building, what we're creating for them, is really creating some sort of, you know, ease in how they're accessing, you know, basic payment services across their spectrum. And beyond that, there's also the issue of, you know, it's not just about inclusion, it's also about, you know, enhancing how they can get included, right? The channels, the network that they can use to be able to do transactions, those enhancements are very great for what we're going to as well.
Yeah, you're sparking something that I want to say as a comparison, but I'm not going to preempt you. You know, when you think about what you're doing in Africa, I can see on the one hand similarities with things happening here. I can also see just a couple of differences. Are there any either philosophical, technical, or other things going on either with Flutterwave or in Africa when it comes to cracking open financial inclusion with fintech that you think are exportable to the rest of the world and to our viewers watching?
Yes, recently the Nigerian Central Bank launched the sandbox infrastructure, you know, that I think is amazing, and that's going to encourage a lot of innovation, where a lot of fintechs who are not even licensed can come into that sandbox environment and build solutions that actually work for a particular use case. That is a big deal that can be exploited, in my opinion, everywhere in the world, because obviously that allows to create a safe place for innovation, but also with control around risk and compliance. That's a very big one. There's another one happening also in Ghana with MTech and the Bank of Ghana, where they're building some sort of, you know, digital asset-backed platform to allow fintech and banks collaborate in a safe way with the watchful regulator, but everybody's in the same room with the same goal and trying to look for how do we drive and create value for the ecosystem. That I think is pretty big and very important.
Yeah, we actually had MTech yesterday. Their CEO, Carmel Cadet, was over at our regulatory boot camp in that particular space. You know, just as an aside, one of the more interesting things I think about, you know, is that ultimately, no matter where people are in the world, they want to be able to build a business, and it's hard to build a business if you can't move move any money. I guess, you know, we only have just one last minute, but I did want to get back like to the digital asset, because you kind of answered, but you didn't answer. But I want to put you on the spot. Okay, you know, like, do you think is it the UI issue with, you know, is it just that when you get into things like cryptocurrencies, because you are in the payments business, you're in the business of moving value, is it the clunkiness of it that makes you more skeptical and you look at more streamlined or beautiful solutions that you're thinking about in Flutterwave? Like, what is it that you, because Nigeria, there is a lot of interest certainly in cryptocurrencies. What do you think is the biggest problem, the biggest challenge from someone who's built a major company, like when you look at that space?
So the way I look at that space is really just about, I'm very consumer oriented, right? If you're creating value, the receiver of that value needs to be able to use it, right? And if you go into Africa, our major market, for example, the average business there is not thinking about cryptocurrency. They're thinking about credits, right? They want to have access to more capital to expand their business, their small business. The consumer wants maybe a safer, cheaper way to send money, or a faster, more efficient way to get their payments done. They are not asking for cryptocurrencies, to be frank, right? Which is why when I see, you know, solutions that, I mean, technology, blockchain is great. The opportunity is there, right? I believe that, you know, you can build consumer-friendly applications that ensures that, you know, KYC is being done properly, risk infrastructure is being addressed, and compliance is being checked as you go and scale anything. I know as you scale a fintech business, you learn very quickly that risk is a big piece of, you are running a risk business literally, and you have to obviously scale that as well. And for me, I think looking at how the CBDC of Nigeria has been created around the phone number, right, which is very simple for the consumer, that makes sense. So for me, it's really just about building what works for the consumer while ensuring that all the checks are done properly and everything works.
I really appreciate it. Really appreciate it for being here and for taking your voice and your perspective here, GB. Very much appreciate it.
Thank you, Chris.
Thank you. So we will be having a brief break. Just two quick notes. There's no chair squatting permitted, so you can't leave your stuff here because we're trying to make sure that everybody gets their opportunity to participate. There are lots of folks around, but we are taking a break for you to go and grab coffee. We're going to be having people from the special assistant to Joe Biden, one of the leading VCs, one of the top regulators in the UK, as well as some people to teach us how to build houses on blockchains. Quick break, get your coffee, and we'll see you.
Thank you.
So I'm going to assume that everyone has been properly caffeinated, even more for our next session, which is really, really, really important. I mean, there are trade-offs to everything, and so I'm really welcome this kind of conversation. One of the things that we love about DC Fintech Week is that we not only have the public sector and the private sector together, but also often on panels kind of talking to each other and thinking through problems collectively. It makes us all a lot smarter, although we are going to be asking about what makes AI smarter and dumber and in what context. So with that, I want to welcome Sarah Weed, Steve Holden, Jessica Rusu, Elizabeth Kelly, Special Assistant to the President, and Phil Bronner, all to the stage. And thank you.
So, as Chris said, this is one of those unique opportunities we have to really dig in on a topic that I think is really top of mind for many of us. If you've been talking about generative AI or nodding along as others have been talking about generative AI, this is the panel for you. I am delighted to be joined by a cast of luminaries in this space, and it's easy to say that because it's new, so we're all luminaries. By the end, you're all luminaries. Without further ado, I'm going to kick it off to our panel to introduce themselves and also to just give a little bit of a quick soundbite as to sort of how they think about generative AI and how it's showing up for them. And then we'll launch right into the question at hand, which is what makes it smarter or dumber than first-gen AI. Steve.
Great, thanks. So hi, everybody. My name is Steve Holden. I lead and manage the single-family analytics team here at Fannie Mae. So welcome to Fannie Mae. We deliver models and analysis to our business partners internally to drive our single-family mortgage business, which is about $3.6 trillion. And when I think about Gen AI, I think about a step change in the AI technological progress that we've been seeing over these last number of years. It really is a new and large change to how this technology can be used and embraced, and it's a really exciting time to be doing this type of work. Thanks.
Hi, I'm Jessica Rusu. I'm the Chief Data Information and Intelligence Officer at the UK Financial Conduct Authority, which is responsible for oversight and supervision of the UK financial service industry. So I'm really excited in particular about my role because I'm responsible for the digital transformation of the regulator, which is a fun and exciting job. And I also think that this particular moment in time with AI is exciting as a lifetime data practitioner. The things that we can do with the intelligence that we receive from all of the disparate sources really helps us in our role in keeping markets safe and customers from harm.
Hi, I'm Elizabeth Kelly. I'm Special Assistant to the President at the National Economic Council at the White House, where I lead our work around financial regulation and technology, including artificial intelligence. I could add to my fellow panelists' comments about all the ways I'm excited about AI, but on a lighter note, I'm really enjoying that people have been using Gen AI tools to summarize the President's recent admittedly lengthy executive order and synthesize content that way.
It's a great segue. So my name is Phil Bronner. I am managing partner of Ardent Venture Partners. We're an early stage venture capital fund that focuses on financial services and application level software. And just to frame generative AI in the way we see it at our firm, when you look at traditional enterprise software, right, all of it, the whole market, is driven by structured data. And that's a $150 billion market opportunity globally. When you look within the enterprise, about 20% of the data is structured, right? So structured data accounts for 20%. 80% is unstructured. Until, large language models and generative AI, all of that data within the enterprise was outside of the realm of software understanding. Now we can understand that, and our firm did research and identified a $2.4 trillion automation opportunity just within the US. And so we see a massive opportunity. It's obviously early days, but it's really an unlock for a significant part of enterprise automation that was just outside of software prior to.
So, and last and least, I'm Sarah Weed. I'm a partner at Gibson Dunn. I lead our fintech and digital assets practice, as well as work as one of many in our new AI practice. So, guys, this is an exciting time. I know we were talking about the extent to which the last week alone has been an especially exciting time. I don't want to scoop anybody. We'll talk a little bit about that. But before we get sort of into the, this question of smarter or dumber, Steve, it would be great if you could just kick us off and tell us a little bit about how AI has been informing your work at Fannie Mae, and in particular, if there's anything that you're really excited about on the Gen AI front.
Sure, thanks, Sarah. And I really like, Phil, what you just said, because we think a lot about structured data and the opportunity to take unstructured data and structure it using AI. That's for us a huge opportunity, and we've had a number of successes in that front already at Fannie Mae. And I'll just give you a couple of examples. Today, when a borrower who's a first-time homebuyer applicant applies for a mortgage, their rental payment history is typically not considered in the underwriting. And that's a real shortcoming of the process, because obviously a successful sequence of 12 months of rental payments is very important to understanding whether this borrower can be successful at home ownership. And back in 2021, Fannie Mae introduced this idea of being able to automate the process of underwriting using rental payments that are extracted from bank statements. Now, bank statements come in a variety of different forms, and the rental payments themselves look different from bank statement to bank statement. And when you have a situation where you have unstructured data, where a human being can look at a piece of financial data and understand what it means, but a computer can't because it's not structured, you can teach a computer to do what a human underwriter can do through this sort of repetition and training process. And so we've been able to do that with hundreds of thousands of these bank statements. And now we can take that structured information, that evidence of successful payments, and we can incorporate that into that credit evaluation. And we've seen to date 5,500 applicants who could not get approved for a mortgage without that evidence of 12 months of rental payments. So that's out there in the marketplace, and is a great example of what opportunities machine learning offers.
So nothing important. You're not doing anything important. No, huge. It's a huge leap forward. Phil, you have been in this space for a long time, to the extent AI has been with us for some time.
Yep.
Certainly, in this innovation cycle, AI has been with us for a long time. And I think I saw recently that Ardent has looked at, what is it, like 1,000 startup Gen AI ventures in the last year, which let that sink in. That's a huge number, which necessarily begs the question, how have you all been sort of evaluating these opportunities? What does that model look like, and is it changing?
Yeah, absolutely. So we're now up to 1,800. We've looked at 1,800 companies broadly. We've gone somewhat deep on 900, and I've met with personally over 100 founders in this space just in the last year. And what I would say first to frame where we are, so I was investing when the iPhone came out, and I sort of liken what we're going through now to that. So when the iPhone came out, we all knew it was this magical device that was creating magical experiences, and a number of companies were founded based on that in the first year. But the quality of those companies was relatively low initially for two reasons. One, the infrastructure wasn't fully in place, so it took about a year for the App Store to come out and other core aspects of infrastructure to fall into place. And then second, it takes founders time to sort of learn the medium. So if you think about the iPhone, it took about 2 years before companies like Uber really took advantage of the location-based services that were on the iPhone. So I think the same thing's happening now. So in the first year, we've looked at a number of deals. I'd say the quality is improving every day as founders become more sophisticated as it relates to the medium. I think infrastructure is improving fast, like super fast. So if you think about in November of last year, ChatGPT 3 was launched. It was trained on, I think, 175 billion pieces of data. 6 months later, or 5 months later, ChatGPT 4 came out, it was trained on 1.7 trillion. So it was 10x the amount of data. I don't know if you all track it, but OpenAI had a dev conference yesterday, and they launched an app store similar to what iPhone did. So like you're seeing a lot of infrastructure fall into place. I'd say the areas that excite us are areas that have a lot of unstructured data, areas that are complex business processes, areas that require a lot of accuracy because these models hallucinate, and startups can then add value on top of the model, improving accuracy. And so those are some of the things that we look at, but it's an exciting time.
Okay, I'm going to be a little bit unscripted here and just ask the question. Are you using any generative AI to inform your evaluation of generative AI? Because it sounds like that's just a huge amount of data that you're trying to synthesize.
So it's a really interesting question. So internally, we just built a model. We call it the Ardent GPT model, where we're leveraging generative AI and LLMs to sort through all of the data. And so we literally see about 3,000 to 5,000 founders and companies every month. And before we had to try to go through it, we could only get to, let's say, 10 or 15% of it. We now have a model that literally takes that 3,000 to 5,000, and based on what we're looking for, it sort of weans it down to 300 to 500, saving us a tremendous amount of time. It then also helps us with outreach, so it automatically generates emails and texts and other things that we use to reach out to founders, and so we are using it internally.
Okay, so if you got a text message from Phil, I just want to be clear, it's one he wrote himself.
Exactly.
It's not one that was automated. That's fascinating. So Jessica, I know you've written, spoken a lot about the opportunity as well as the risks associated with the reliance of financial institutions on AI. How are you thinking about this? Are there any particular risks that you're especially attuned to?
Yeah, so it's interesting because when I started with the regulator 2 years ago, I knew that AI was a big deal, and we have an advanced analytics team, and the pro-innovation approach is really important for the FCA. And as we've seen through the course of this year, it's just really taken off in terms of the hype cycle and the focus on artificial intelligence. But importantly, the work of all of the global regulators in collaboration has been something that I have found really reassuring as we work together to address the risks. And you would have seen that the UK hosted the Safety Summit last week in Bletchley Park, and all of the global regulators are thinking about it and addressing it. And I think it's really important that we focus on the systemic impacts and the systemic risks. So you heard about earlier the role of social media that took place with the Silicon Valley Bank. We've looked at how all of the intersections of our digital infrastructure are impacting both on financial services and the related third parties, as well as the critical support system and the infrastructure that supports AI. So I think we actually have to look at it in the round, which is why it takes a considered approach.
No, and I think that's right? I mean, everywhere we look, there are different sets of risks and different sets of considerations, and not to say we should be constrained by them, but we've got to be mindful of them. In particular, just curious, Jessica, your thoughts, but obviously anybody on the panel, how are you thinking about that risk posed related to discrimination? As we think about, the training set really informing what the outputs are, and as excited as we can be about those creative outputs as it relates to generative AI, bias can certainly influence these models, whether intentionally or unintentionally. So
I actually spent an early part of my career as a credit risk modeler, and we've already heard about the role of historical data sets. And some of the historical data is really incredibly accurate at predicting creditworthiness in the future. But we also have to realize that you are beholden to the data, so the data will tell you what's happened in the past. It's not necessarily always going to be able to remove the historical biases or discrimination. So it means that you actually have to build that into the construct of the model. And there are methods available to do that. So you can actually look at and identify the discriminatory variables that are impacting the outcome of the model. And some of the previous panelists spoke about how you can look at the complex approaches and actually get to a white box solution at the end of the modeling effort. So you have to be really aware of the data that you're using. And of course, the hallucination bias, it's not always going to be correct. I asked ChatGPT the other day what were the 12 principles of business that the FCA held, and it got the 12th one wrong. So it's never going to be 100% accurate. So you have to realize how that comes into the model that you're using. And the other thing I would say about consumer harms, we've seen the proliferation of scams. Okay, so we've seen the way the data can be used to scrape and harm individuals using their own biometrics or their own information. So that is something that I am very, very worried about in terms of hyper-personalization. So we've seen hyper-personalization of FinProm type scams. But on the flip side of that, if you're thinking about potentially a medical application, you actually want hyper-personalization because you would get a better outcome. So there's goods and bads around it.
Does that spark thoughts for anybody else as you think about sort of those?
I'll just say that at the end of the day, the use of these tools and capabilities, the responsibility rests with the user, and so having that understanding of some of these risks and concerns is super important. And at Fannie Mae, we have a whole division in our legal department of analytics professionals who are always looking at the work of the modelers and challenging our specifications and making sure that we're doing these things in the most appropriate and effective ways. And so we take this extremely seriously, and we have the infrastructure in place to back that up.
And so I think what we're hearing is, this is not a panacea. It's not going to solve all of our problems. In fact, in some instances, it may introduce ones we hadn't been as, mindful of. But that governance piece is really, really important. And I expect it's going to show up differently for everybody. All right, so Elizabeth, we all know you've been a little busy recently. And so I wanted to make sure to give you an opportunity to talk about any of the risks that we haven't really touched on, of which there are many, right? This is a space where we find ourselves with lots and lots of push and pull. So what are you thinking about these?
Yes, push and pull, goods and bads. We've got some good phrases up here. But I think it sort of boils down to, we know there's both incredible promise as well as real risks with this technology. And I don't want to minimize how real the promise is in terms of aiding drug discovery, carbon capture and storage, extreme weather prediction. Like, we're already seeing really meaningful society impacting uses and applications. And I think we as administration are really excited to help fuel a lot of those. At the same time, there are very real risks that the executive order and the administration is focused on addressing. You talked, Jessica, about the increase in fraud, both around biometrics, but also around people using voice cloning to impersonate relatives and have more targeted scams, or try and use voice cloning to get around voice authentication systems that are sometimes used as security protocols. We've also seen deep fakes used in ways that could be market manipulating. For example, the stock market wobbled in May when there was a deep fake image of a explosion near the Pentagon, very quickly corrected. But this is probably not the first time we're going to see this sort of thing, which is why I think it's so essential that we've seen sort of a global consensus around prioritizing content authentication, watermarking, developing new tools for detecting content that is generated by AI. And that was a key takeaway from the Bletchley Park Summit. It was a key takeaway from the President's Executive Order, as well as the G7 Code of Conduct that came out last week. Two other risks that I would mention. We've talked a lot about the data that feeds into these models, but there's also the data that comes out of it. And AI poses some pretty serious risks to privacy. It's enabling us to link together seemingly disparate pieces of information about people in a way that really can be privacy damaging. And this was the theme of the EO. The president's repeatedly called for bipartisan privacy legislation, and we're excited by the action being taken by the FTC and the CFPB. But we know there's more that has to be done as AI accelerates this trajectory. The last thing I would mention, just looking at this audience, is startup entrepreneurs. Full disclosure, before I joined the Biden administration, I helped start and then sell a fintech, so great to be back with my people. But sort of risk to competition. We know that it is incredibly expensive to develop really frontier LLM models. It requires access to data, computing power, semiconductors, all of which are limited and costly resources. And there's the very real possibility that absent appropriate regulation, you see sort of entrenchment of already large incumbents in a way that is negative not just for consumers who might see higher prices, but also for the broader innovation ecosystem. For example, if you are a business who is building on top of an LLM and or a cash-strapped startup, as I used to be, you don't have that many options. And it can be pretty constraining to your business model, which is why we need to have a really robust and competitive ecosystem. I think for the Biden administration, that means encouraging the FTC to use its full powers and making sure that every other federal agency is considering competition in its approach to AI, both through policy and through procurement, which is a pretty meaningful tool, as well as thinking about how we can foster that broader ecosystem. So for example, to be really wonky here for a second, one of the things I'm most excited about is something called the National AI Research Resource, or the NARE. They might want to work on a less of a tongue twister name. But basically the idea is that you provide researchers access to data, to compute, grants, so that they are able to contribute to this ecosystem, really help produce the innovation we know is going to be so key for seeing all of the positive use cases we want.
So developments are coming at us fast. Even in preparation for our conversation, I think we've seen some pretty significant developments. It's really hard to stay on top of it. I know we're all living very full lives. Someone recently described it as high velocity living, which I've decided is my new favorite phrase. But you know, what are you all reading, consuming, listening to? Obviously, we're all listening to Chris, but what else are we all consuming to stay on top of developments in this area? Because, you know, I think we've all agreed, like, being in this space is powerful, but being left behind is no fun. So what are we reading? What are we listening to?
Yeah, my 13-year-old is disappointed at me every day in the car on the drive to school when I put one of my podcasts on. Honestly, the information is changing so fast that you really need to find sources that have really state-of-the-art, cutting-edge change being reported on. And so, frankly, YouTube and Spotify is where I'm spending my time. And you know, some of the really interesting applications that are being talked about are ways to access data through Gen AI interfaces. So this idea that you can load data and then have a dialogue with a chatbot about what's in the data that maybe isn't quite so obvious. And so there's a ton out there in YouTube. But also in the podcast sphere that I would encourage people to take a look at.
Jessica, is there anything you would recommend?
Yeah, same. So just doing a lot of research in general across a vast waterfront. I'm really interested in quantum. I'm interested in cybersecurity. When I get a chance to read, I think I've got The Coming Wave on my desk at home. So I've been reading about all of the different topics. I'm quite interested as well, even though my focus area is financial services, I'm also quite interested personally in medical applications as well. So I'm looking across kind of a vast waterfront of ways that AI can be useful and technology in general, because as I said earlier, I think it's the general digital infrastructure of our markets that's really changing. So I'll grab anything related to open banking, open finance, et cetera. And yeah, so I think it's just kind of staying across all those topics.
Elizabeth, you can't say the EO. So
no,
what else
I'm not. I haven't read that enough. I wish I could say that I'm listening to AI podcasts, but my 18-month-old is insisting on Encanto instead. I think, you know, usual disclaimer, lots of great resources out there, lots of great outlets doing great work. I think for me personally, I really enjoy reading the information for sort of late-breaking industry developments, including yesterday's conference. I had a good read out this morning. The Import AI newsletter for its roundup of sort of cutting-edge research that's happening, and anything coming out of the Stanford center on human-centered artificial intelligence, or Stanford HAI. They do a lot of really thoughtful work. Like you, I'm reading about a lot of different applications, including in climate, health, and a lot of interesting work out there.
Yeah, all of those are great. If you're technical, I think you're probably in GitHub. There's just a lot of great stuff going on there. Hugging Face is a place where a lot of these open source models are being stored and hosted, and there's just a lot of great stuff there too. I spend a lot of time on Twitter, but I have a love-hate there. But that being said, but I would say if there's one thing I'd recommend, it is the OpenAI Dev Conference. It's like an hour that it was like the keynote from that yesterday. The reason I think that's so important is because it's sort of where the industry is going to be in a year or two on the open source side. They're definitely pushing the envelope. There's a lot of conversation around agents, which I think are going to be really interesting. Their app store is going to be interesting. So if there were one thing, it's only about 50 minutes. It'll give you a sense of sort of the latest trends in the market.
Okay, and I'm going to do one thing to put us all on the spot because it's fun. You can nudge me later. So smarter or dumber? I wish we had paddles. Generative AI. What do you think, Steve? Smarter or dumber?
100% smarter.
Okay, that wasn't one of the options. Yes, Jessica.
It's definitely smarter.
Definitely smarter.
Yeah, absolutely.
I think we know how we selected the panel. So like us all, right, I think the takeaway here is good inputs in, make for good outputs. That's part of why we wanted to make sure we touched on that resource point as we're continuing to think and drive this conversation forward. It's incredibly important that we all be consuming good data that's going to help us really see around corners and identify those opportunities while being sensitive to the risks, which I think we're only starting to understand. And so with that, want to thank my panelists who I think you can agree really are luminaries. You are too. And wanted to thank you all for joining us. We're gonna take this conversation a bit more squarely into the housing market next. So to set the stage, we have some of the best in the business who are gonna get that conversation going. And so we are gonna use the big hook and have us exit. And like to welcome Chastity Murphy to the stage, Senior Advisor to the Assistant Secretary for Financial Institutions, along with Brian Brooks and Mike Cagney. Thanks.
Well, thank you for being here today. I'd like to extend my gratitude to Chris and Fannie Mae for having me participate in this exceptional event and pulling together an amazing panel. Today, I'm thrilled to engage in a panel discussion with both Mike Cagney and Brian Brooks, and I believe this will be both informative and informational. So as we delve into our discussion, I want to start by acknowledging a significant moment in recent financial history. In 2008, the MERS Corporation aimed to modernize record keeping and improve mortgage affordability by claiming title to a significant portion of the nation's home mortgages, roughly about 60 million loans. However, the adoption of MERS technology unintentionally complicated matters for homeowners. With this context in mind and understanding some of the historical challenges in the areas like information processing and MERS, still the concept of tokenizing mortgages remains intriguing. To commence our discussion, Mike, could you please elaborate on the reasons for considering integration of mortgages with blockchain technology and how this integration might change or revolutionize traditional markets?
Sure. So blockchain does two things, and really only two things, but it does them very well, which is it allows us to displace trust with truth through a native digital asset. So it allows us to create an asset that's only lived on the blockchain, where we can look at it and we know for certain the ownership, the composition, the history. We're not relying on anyone's attestation as to what that asset is. And it allows us to transact that asset bilaterally without counterparty risk or settlement risk. And so when we intersect those two things, we can create very powerful marketplaces where we become agnostic to our counterparty. And this is a big deal in financial services. If we think about financial markets, when we trade a stock, there's 7 parties that sit in between a buyer and seller. When we swipe a debit card, there's 5 parties that sit in between a buyer and seller. So blockchain has the ability to distill that down to simply the buyer and the seller. But as it relates to mortgage, obviously one of the huge issues that we have is trust and certainty of what we're looking at. So the ability for a mortgage to exist where I can look at that asset and know for certain how it was underwritten. I know for certain the payment history, the prepayment speed of a pool of mortgages, the ability to trade those mortgages real-time bilaterally versus moving crates of paper back and forth, which is what we historically have done, introduces both efficiency and liquidity into the market that ultimately accrue to benefits to the originator and to the customer.
Awesome. I mean, Brian, what do you think? I mean, what is the argument for innovation? And is there a standpoint for financial inclusions? Are there other opportunities for emerging technologies like blockchain and AI to resolve some of these challenges? Or do we think there are some implications that we should be looking for that could be challenging for consumers as well?
Well, first of all, it's amazing to be here in the Fannie Mae building having this conversation. I was general counsel of Fannie Mae when we built this building, and that was at a time when we had just sold our interest in MERS. So there's a lot going on in this conversation. And I would say for anybody here who remembers the issue about MERS and about show me the note defenses in the financial crisis, you'll readily understand why blockchain has promise in this space. I mean, one of the biggest frictions in getting through the foreclosures of 2009, 10, and 11 was the idea that we didn't know for sure who owned the note. And even if the note was, if the mortgage was registered on the MERS system, people still argued a certain percentage of the time that the MERS system, as Mike said, was subject to human error, that something had been onboarded incorrectly or that there had been a break in the chain of title or whatever. And that prevented banks from getting the foreclosures through the system and getting us back to normal. So the original version of MERS was a bit of a disaster. It was also great. It was better than what came before, which was manual book entry, but it was a bit of a disaster, which is why Fannie Mae sold its interest in MERS eventually. The concept of blockchain is the idea that if the mortgage was originated on chain, it will never be anyplace else. There will never be any human data entry, no fat finger error, no show me the note defense. We'll know for sure who owned the mortgage in a chain of title from the lending bank to person B, C, and D. That's all an amazing thing, and that's part of what Mike has, I think, been trying to build at Figure. We can't go back to those days, and at a point where there's, many of us believe, looming credit problems in the cycle that we'll see more about in the next 6 to 12 months, I think we'll be increasingly looking for some better solution that gets rid of that friction.
Awesome, thank you for that. Given the recent fluctuations in the mortgage market, the persistent challenges in mortgage origination and the emergence of innovative technologies like blockchain and AI, Mike, can you describe how you envision these technologies addressing the longstanding issues of cost and time in the mortgage origination process? Specifically, how can blockchain and AI be harnessed to improve efficiency, streamline mortgage originations, ultimately benefiting both the lenders and the borrowers?
Sure. So back in 2018, we had a thesis that you could use blockchain for asset origination, aggregation, and securitization and save 85 basis points, or roughly 85 basis points of cost. And that cost savings was really manifested through the opportunity to displace trust with truth. So the ability to take raw data such that you don't have to worry whether or not it's a real FICO score. I took it directly from a digitally signed version of a tri-merge, or you don't have to worry that it's real title because I took it from a digitally signed version of a title report. And I went to a bunch of banks in 2018, and I said, look, I believe you can do this. Here's the structure. Here's how you would do it. And every bank was like, Mike, this is awesome. We would love to do this. We'd like to be the 10th bank to do a securitization on blockchain. So there was no appetite for anyone to be an early mover on it. So we ended up creating our own lending business to do this. And we've been able to manifest very significant savings. So take a securitization, for example. Every mortgage transaction since 2008, 100% of the loans get audited at a cost of roughly $500 a loan through Citus or AMC, every private transaction. Our transactions, we now only audit 20% of the loans, and it's around a $50 to $100 cost per loan. And by the end of the year, we think that'll be down to 10% and $50. And so it's an example of explicit savings. And I use a number a lot that we've done $16 billion of mortgage transactions on the blockchain. But I was corrected the other day. We're actually, I think, at $27 billion of transactions at this point, and very significant cost savings that we've manifested. So the idea that this is a solution looking for a problem, that's outdated. We can very clearly show what the economic benefit of the technology is. And at a time when originators need that benefit, they're getting, obviously, a lot of headwinds right now.
Awesome. I mean, I would say the expectation and the aspiration for mortgages to be placed on blockchains has been longstanding, but some would say it doesn't necessarily meet expectations. I mean, I would be curious from you both to talk about some of the obstacles or areas of resistance when it comes to incorporating mortgages on the blockchain. I mean, are these challenges predominantly technological? Is it regulatory, or do they entail other factors?
Well, maybe I can jump in, and I'll see if I can put a flavor of AI into this as well. So there's the blockchain bit, the AI bit. One way to think about why these things go together is that both blockchain and AI are versions of decentralization. So AI is an ability to take widely disparate, widely disaggregated data and learn things from it. And so AI is very useful when it comes to credit underwriting, one of the really important parts of mortgage origination. And blockchain is really relevant to two other parts of the mortgage business. It's very relevant to mortgage recordation for the reasons we just talked about. Also very relevant for mortgage funding, right? So if you think about the way that mortgages are funded today, they're generally funded on a highly centralized basis. They're either funded by the agencies, which is a majority of all housing credit in the United States, or they're funded privately through a series of securitization transactions that are mostly underwritten by one of a handful of big banks. Blockchain makes it possible to crowdsource funding almost globally. I'm actually on the board of a crypto company called Credix. And what it does is it allows people to identify an aspirational rate of return, and it matches borrowers and lenders in different asset classes that achieve that rate of return much more efficiently and much more globally from a much more diverse set of investors. So those things are all good. But what's the problem? Where this breaks down, it's not on the underwriting side. AI can be very, very good at that. It's not on the recordation side, because smart contract protocols can already do that inside of the crypto universe, so that exists and will scale. Where it really is on the fundraising side. And that is because nobody wants to invest in an asset that they can't readily sell. And the reason that it's hard for people to want to invest in a token versus a mortgage-backed security is because of issues around US securities regulation, which make it very hard to either buy and sell tokens or to list tokens on a securities exchange. And you have two kinds of problems here. One is a problem about what is a security. So if I'm buying a fractional interest in a house or a fractional interest in a mortgage pool, is that a security that's subject to regulation? But even more fundamentally, if we decide that it is a security that is subject to regulation, at the moment, the SEC and FINRA won't allow that security, if it is a security, to register with FINRA and trade on an exchange. That's the real puzzling thing about crypto securities, is unlike normal securities where there's a well-known registration process, crypto securities are currently barred from trading anywhere because FINRA won't allow it. That's the last mile problem here. Once we allow mortgage tokens to be fungible, the same way that all other financial assets are fungible, to be bought and sold on an exchange, floodgates will open. But that hasn't happened yet for whatever reason, and I know you have some regulators speaking on these issues later today. You should ask them.
So in defense of FINRA and the SEC, so we have a broker-dealer, we have an alternative trading system. The ATS that we have is the only ATS that can trade blockchain-native securities in a marketplace. And it was leaked. We didn't publish this, but the journalist got a hold of it. a couple weeks ago, we did the first asset-backed security transaction where the asset-backed security was native on blockchain. And I think that's the beginning of what you're going to see as a trend of moving towards blockchain as the medium or the marketplace. And we'll talk more about that as we go through some of the questions. But I think, building on Brian's point a little bit, one of the biggest impediments that you have in terms of blockchain adoption to mortgage is the GSEs dominate the mortgage ecosystem in terms of capital markets. The Fannie Mae Seller Servicing Guide has MERS hard-coded in it as the registry. And what we've done is we've built a registry called DART, which stands for Digital Asset Registry Technologies. It's what we're using right now in all our HELOC production. But effectively, DART does a UCC Section 8 security perfection of a blockchain asset real-time on-chain. And that registry service or something like that is what we need to be able to move assets real-time across chain and be able to demonstrate perfected interest and encumbrance. And so, about a month or 18 months ago, we did the first mortgage transaction where we sold notes into Athene using DART as a registry service for that. But if the agencies are able to dial that back and allow for not just MERS as a monopoly for registry, but actually other solutions like DART, that's going to be a catalyst to drive greater blockchain adoption for capital markets.
Yeah, thank you for that. I mean, I want to build on a bit of what you said earlier, Brian. I mean, why would investors opt for tokenized mortgages over other types of tokenized assets? I mean, what's the risk return trade-offs to do these mortgage-based investments? And what do they present as compared to other tokenized options?
Yeah, I mean, this is really the nub of the issue. It's a great question. And so one answer is, who are the investors? So in traditional mortgage-backed securities, you don't really have retail investors buying Fannie, Freddie, MBS. That is a fully institutional market that trades in chunks in the tens of millions of dollars, would be the smallest, chunk that one can invest in an agency MBS. One of the beauties of tokenization, which is, if you think about what a token is, it's just simply a fungible unit that is able to trade on a blockchain, fungible and exchangeable with other kinds of units that trade on chain, is that people can buy a mortgage-backed security interest of $1. So if you think about in the old days, very few people owned stocks because you could only buy even lot securities. Typically 100 shares was the smallest you could possibly buy, and stocks were expensive. And then we invented mutual funds, and then we invented ETFs, and now you can buy equities for $1. But that wasn't the case in our parents' generation, right? And so the pool of investors is much bigger today than it was then, and as a result, our equity markets are much more liquid and have much less friction. That will come to mortgage as well through tokens. That's the whole point of tokens, is to have global retail liquidity pools versus very small vertical pools managed by 3 or 4 or 5 large institutions. So that's really important. And then the question is, what else is getting solved? Well, what's getting solved are things like custody issues, chain of title issues, title insurance issues. I mean, there are things that we do today, like Mike mentions how MERS is hard-coded into the Seller Servicer Guide, which is true. What's in the Fannie Mae Charter Act is a mandate for mortgage insurance, and mandates for title insurance, which are the stupidest, no offense, they're great products. Totally you should own shares in the MIs. But you should only own shares in the MIs because the statute mandates it. They have like a guaranteed market share. This is a dead weight loss in the system. The number of title insurance claims that got paid in the history of any time is basically never. With blockchain, you don't have to have title insurance because there's no question about the chain of title from origination through the end of eternity. But in a human system, there is the theoretical possibility that somebody's filed a fraudulent lien, or that something was missing historically, or the original record got destroyed. And again, that's what we confronted in that era. So it's really 2 answers. It is eliminating dead weight losses that are baked into a human-dominated system. And it's also radically increasing the pool of eligible investors. Both of those things are enormously important.
And I'll build on that just a little bit. It's also transparency of data and frequency of data. And I remember in March of 2020, when we went into the COVID lockdowns, the prime jumbo market became completely illiquid because no one had any idea what was going to happen to those mortgages in terms of performance. And the issue was the remit reports were 30 days stale. So you were waiting, at least 30 days to make your initial assessment as to whether those mortgages were performing or not. Because we run on blockchain, our remit is real time. So if it's 10 o'clock in the morning, I can see every loan that's paid me as of 10 a.m. that morning. And as such, our collateral stayed completely liquid. And what ended up happening was the hedge funds ended up buying our collateral to front run the remittance reports and figuring out what was going to happen in 30 days. So the level of transparency facilitates liquidity, which improves prices and ultimately, again, benefits the consumer.
Thank you. I mean, I want to focus a little bit on the risk equation of this. I mean, you know, I would say, how does data privacy and consumer protection concerns, factor into the risk equation? I mean, what are the potential cost and time-saving benefits might borrowers anticipate when considering these tokenized mortgages? And are there other current concerns that, we as regulators should be thinking about as well in terms of the consumer?
You want to start?
Yeah, I can start, and I'll go relatively quickly. I think there's a lot of misconception about blockchain, in particular public blockchain. And the reality is public blockchain is the only kind of blockchain that makes any sense. A private blockchain is much better served as a database. And we can have lots of contention about that, but it's true. So within the construct of a public blockchain, there's a concern that if I put a loan out there, the customer information, the PI information is now exposed to the public. That's not how it works. So if I put a loan on the blockchain, one of my loan packets is 5 gigabytes of data. What actually goes to the blockchain is a 256-character hash of that data that uniquely identifies that information, such that if I trade that loan with Brian 3 months from now, he's going to be able to prove the data that I gave him is true or not. But he's not going to know what the underlying social security or address or phone number of the borrower is. So the premise is it's a public registry, it's a public ledger, and it's immutable transaction history. But the construct of data privacy you can control and manage through the technology.
Yeah, I mean, so what I would say is, I think the biggest risk is slow adoption. I don't think there's a risk in the underlying technology platforms. What it feels a lot like to me are, the advent of smartphones or the advent of the commercial internet, even honestly like the advent of the CD player. Like, who's old enough to remember when you bought your first CD player for $999, And the risk was that you were the chump that was paying $999 like I did in 1985 for your first CD player. And 3 years later, you could buy that same CD player for $29. So there's a bit of like an early adopter issue. And I think what many of us have been waiting on for 5, 6, 7 years at this point is, when is crypto going to have its breakout moment, where this mass adoption moment? And I think, Mike and I probably both believe that housing finance is as likely a candidate for that as anything else. And why? Because it's the largest market of any financial asset in the world. The US housing financial market is the largest financial market in the world. So it's more likely that people will start doing that than anything else, and that will break open all of these possibilities. I will just say as an aside, there have been a couple of efforts to do this already. So when my friend Chris Giancarlo was the CEO or the board chair or whatever he was of Common Securitization Solutions, Chris is a long time, his book is called Crypto Dad. I mean, he was the CFTC chairman, the CSS chairman, but was a crypto guy who was very interested in the promise of public blockchains. And there was a moment when CSS and the agencies were really looking at the possibility of using blockchains as a securitization vehicle, which didn't quite get off the ground, and so it took Figure to try and launch this. I think this is a likely early adopter thing, but as long as it remains a niche crypto native activity, it will be expensive, it'll be seen as risky. We have to overcome that. This is the CD player, okay? Yes, your cassette tapes are super awesome, but just get over it.
Okay, I'll take a shift a bit. How does the country...
first.
Yeah. I would be curious from you, Mike. I mean, we talked a little bit about this in the back, but I'd be curious about how the country's macroeconomic situation would impact the tokenization landscape and the level of interest in addressing the potential challenges. How do these factors impact the development in the space, given the increased volatility, the startup challenges, and what considerations should government be considering regarding the market development?
So I think there's two macro trends that I believe are going to persist for many, many years. And one of them is bank credit contraction. And so what we're seeing is meaningful bank credit contraction, both in the form of losing liabilities, but also in the form of changes of regulatory capital. And as such, that bank bid for assets has left the market. That's coupled with constricted GSE buy box, where the GSE has more punitive LLP adjustments for things like second homes, investment properties, high-income borrowers. And what we're doing is creating the need for a private capital market. The problem with private capital markets are, GSE mortgages are great because I originate them, they're liquid, I can deliver them into the cash window. once you move off GSE, you're into a one-off bespoke loan purchase agreement into a non-homogeneous pool with no liquidity. And the reason that products like non-QM, for example, haven't taken off has nothing to do with the appeal of the product to the consumer. It has to do with the fact that no one's going to originate billions of dollars of non-QM a month without certainty of takeout, because at some point the market's going to shut down and you're going to blow up. So what I believe has to happen is you need to create a private TBA market. So replicate what Fannie and Freddie have done with to-be-announced securities, turning into guaranteed pass-through securities. And that private market, or done in conjunction with a Fannie or Freddie, needs to come to fruition, or we're going to experience massive credit contraction. And this is something that we're seeing right now in pockets of the market and elements of where we transact. Certainly we've seen it in prime jumbo, we've seen it in HELOC, we've seen it in now what we call conforming, non-conforming mortgages, but it's going to persist into auto, consumer, student loan, and there needs to be a construct for a private capital solution. Blockchain is a tremendous way to do this. The costs and efficiencies that one get from the technology, the ability to build homogeneous assets, the ability to have immutable transaction history and certainty of data, that's the foundation that you need to create a liquid TBA and ultimately pass-through market with a third-party guarantor. So I believe that's the next step of what's going to happen. We're working with two of the largest investment banks in the world to do this right now. And my hope would be that by the end of the year, you'll see a first private TBA trade on chain.
Awesome, thank you. We have a few more minutes left. I just wanted to ask one last question. If the premise is that placing mortgages on blockchain will contribute to fostering affordable home ownership, is there a potential role for entities like Fannie and Freddie and GSEs to be a part of this conversation to help support the build-up and infrastructure of this?
Well, I'll give you a couple of very quick reactions. I mean, one is anything that takes transaction costs out of the equation is relevant. And if you think about it, like no matter how big your mortgage is, whether you're taking out $1 million mortgage or a $200,000 mortgage, the closing fee is always the same, and the title insurance fee is always the same, and everything else. So there's sort of like a regressive tax on the process. And anything that takes those out creates more home affordability, obviously. So if Mike can create a mortgage registry that's essentially free, and we don't need title insurance anymore, that saves you $1,000 a transaction on any price of house. All of that stuff is good. I would just say the other good thing about tokenization, though, when tokens become an actual unit of exchange, is the idea that people can start treating their houses more like the way that Uber drivers treat their cars, which is as a source of wealth and a source of income, which not everyone does, but some people do. And imagine a world where you were able to only decide that you want to own 90% of the equity in your house, and you'd like to be able to easily trade small increments on a financial market in order to diversify your real estate exposure. That world doesn't really exist today. You own your house or you don't own your house. But there's no world where you own 90% of your house. That will change with tokens, but it'll only change when you have all of the features Mike just mentioned.
Awesome. Well, I really appreciate hearing your insights here. I mean, it was a great conversation, and I certainly learned, and thank you so much for your time. I think we're about to head to lunch, and so I wanted to get Chris up here just to hop on and offer some instructions.
The last person to step in front of the mob in lunch is the least favorite. It's right downstairs. Again, everybody take your stuff with you because we want to, again, make sure that everybody gets an opportunity to participate. For the balance of the day, we're going to have, as I said, epistemologists, one of the top intelligence officers in the country, the Undersecretary of the Treasury Department, leaders from Congress, and the person who is on the front row of the debt ceiling issues. So we have a couple of things to deal with for the rest of the day. So enjoy lunch.
Over at DC Fintech Week, we are obviously interested in the question of innovation in all of its pockets in all of the parts of the world. And every year, we always want to check in with our friends over at the BIS to get a sense as to what innovation means for central banks. And obviously, it brings me no greater pleasure than to have Cecilia Skingsley here with us today to talk about what innovation means, again, from the perspective of a central bank. It's not, usually something that someone tends to think about, but Cecilia, you are here as the head of BIS Innovation, particularly the BIS Innovation Hub. Maybe just for our audience, you can sort of introduce, what does that actually mean? And maybe give us a little bit of a tour of the place.
Well, thank you very much. And I'm sorry I couldn't be with you today, but thanks to technology, I'm still around. And I think it's fair to say that it's also technology that is the driver for why there now exists such a thing like the BIS Innovation Hub. For those of you who don't know, the BIS, the oldest international financial organization of the world, was founded in 1930, has 63 central banks owning it, among those in the US Federal Reserve. And the hub, the BIS Innovation Hub, was set up in 2019, so it's now 4 years old, to serve as a platform for central bank innovation. And why is that? Well, there is so much going on in the tech space that central banks needs to follow and understand as they do their job. In the same way that they need to understand what's going on in the economy, also that the technology is a critical feature. So we help them basically to follow, understand, but also experiment with new technologies, basically to see what are these new technologies mean for the financial systems and services as we know them, but also try to explore, can it be helpful to make central banks do a better job? So we are typically within the areas of money and payments, open finance, subtech, regtech, green finance, and cybersecurity and infrastructures. And it's an interesting model for this. It's basically a joint venture. So we are teaming up with build centers around the world in joint venture between, on one hand, the BIS, on the other hand, central banks. So we have 2 centers in Asia, 4 in Europe, and then we are building 1 in Canada, and then we also have a strategic partnership with the Federal Reserve of New York, which hosts the New York Innovation Center. We typically land our various projects in the proof of concept of prototype space. So we try to show the central banking community, but the rest of the world who is interested, what could be done, or demonstrate the art of the possible, but what ultimately should be done and what central banks and jurisdictions want to do, a combination of jurisdictions, that's up to them. But we're doing this in a very sort of transparent way. So you can find and follow our project descriptions, and we are sort of available through various events such as this.
I actually teach obviously financial regulation. I actually try to talk a little bit about the history of the BIS, because you guys are at the forefront of the history of money and technology, and you evolve all the time as technology evolves all the time. Super interesting place. I know that a lot of your time is now being spent working on CBDCs and improving the payment system, also where you see lots of disruption and innovation and the like. Where do you see the problems in the space, and then where do you see solutions and the potential arrangements?
Well, I think it's going to take time before we have the full picture, but you're absolutely right. More than half of our projects are within sort of payments, infrastructure, CBDC space. And when you think about it, it's kind of logical. Central banks is in essence the assigned authorities within our different societies to be the experts when it comes to providing a good version of money and make sure that it works in our different societies. And good version of money, I mean the version of money that meets the criteria of being a sort of stable store of value and efficient medium of exchange. And with all the technology going, and we know that things can onboard pretty quickly, we are, we want people to stay in the fiat money system. We think that that is the best way for making economic transactions. And we've tried to, most of our projects are in the space of improving cross-border payments. So cross-border payments, I think it's fair to say that there's room for improvements there. It can be faster, cheaper, and more transparent. If you take people living in the US, for example, wanting to send remittances to family and friends in, for example, Mexico or Central America, they can have to pay an extra 5 or up to 10% in fees, and they can take a long time for the money arrive, and there's not that many compatible choices. So we are in that field, and how do we do it? Well, we try first to improve what already exists, but we are also kind of looking into future issues, and CBDCs are an interesting such future thing. But let me first say a few words about what we try to improve in the current system. So in the world, there are currently more than 60 fast payment systems in major economies around.
Yeah.
Take myself, I can, as living in Sweden, use the Swish system to send money to my children very quickly, or friends to share a restaurant bill. And when I spend my life in Basel, in Switzerland, I can use the equivalent there, Twint, which is doing the same sort of operation, share a meal or sharing a gift to a colleague. But I can't send money between those systems. And the idea here is to connect the fast payment systems through something called the Nexus gateway. Because if you try to do this in a bilateral way with all these 64 an increasing number of fast payment systems, you would end up with a maze of more than 1,700 bilateral connections. So we have a group of bold countries, 5 countries in Asia: Indonesia, Malaysia, Philippines, Singapore, and Thailand. They've said that they are prepared to go first, but we are sort of mindful that we want this to scale across the world and hopefully get more countries to sign in. I think the value of having a fast payment system and using that as a client would go up considerably. But we are also looking into CBDCs, and you can think about CBDCs in 2 ways. Wholesale CBDCs would be an offer facilitating transactions between financial institutions in a much better form than is offered today. And you can take a further step from that and also offer it in a retail form to the general public, namely households and businesses. And why would that be interesting then, or worth the effort? Well, the way I'm thinking about it, and this is the short version of a long explanation, in a future society, if, and in many countries, when, cash no longer work on our daily lives, but we still want to be ambitious as policymakers and make sure public policy objectives are being met around inclusion, efficiency, resilience, and people's public trust in the money, and protecting the singleness of money, then retail CBDC should be there as an offer. And I say offer. I really think this is important, that this is not something that should be pushed upon individuals. It should be an offer from the society, and giving fundamentally people a choice what sort of way they want to access money and make their daily transactions in a digitalized world. So we are here to help by experimenting, researching, and then it's up to jurisdictions to see what they want to do with it.
Well, here in the United States, we have our own sort of series of innovations and attempts, and sometimes we take a couple steps forward, sometimes we take a couple steps back. But I'm really curious to get your perspective, being, excuse the pun, but at the nexus of Nexus and all of these different kinds of faster payment systems. Is the United States an outlier in sort of what's happening globally? Is it at the center of some of these conversations? And also, do you see, here in the United States, we're having a real sort of series of debates about not just the usefulness of new technologies, but the speed at which it should be integrated, how it should be integrated. different kinds of legacy systems, have their opinions as well. Anything different or the same about what's happening here in DC?
No, I think what you're bringing forward, the kind of the concerns around privacy in a digital society is all over the place. But I think that what I hear, some of the discussions about privacy and CBDC have gone off in directions that I sometimes think is a bit disconnected from reality. But let me say the following. We know that from the sort of the dawn of mankind, that technology can be used for good things as well as bad things. And I think the concerns about data privacy in the digital economy is real, and I think it should be treated with a lot of respect, because the technology again makes it possible for much of our lives to get monitored. We see the internet as providing a lot of opportunities, but we also, as a result, creating all these data trails around us. And much of the data sits in the hand of the private companies. It's not super well regulated or supervised in many places. I mean, I think we all experienced this interesting situation with all the targeted ads and how the media kind of that comes our way is very much a function of things that we have been looking into. So it may sound like I'm saying, the ship has sailed and the genie is out of the bottle, so what does it matter if we have a CBDC? But I think we must have a much broader discussion in our societies around how to protect privacy while still making use of the technology. But let me say one thing about CBDC. Central banks couldn't care less what you and I, how we spend our money. What central banks typically are interested in is statistics, and that's why, they want to monitor the economic activity so they can make sure that the policy decisions becomes more right than wrong. But that is something, economic statistic can be anonymous, and how people use money is something that I certainly think should be private. I think one of the big sort of trade-offs here, or the balance points, is privacy, but also integrity. If you think about if you and I were going to make I would buy your second-hand car for some reason, assuming we're living a bit closer to one another. Maybe you wouldn't like everybody else to know that what the price we agreed upon or the kind of other conditions. So there, I think privacy is a natural thing to be protected. Let's say we make a transaction of $10,000. On the other hand, if there are people who are transacting because they want to sell and buy illicit substances, then we would probably think that, why is that not monitored? Why are we not making sure that people are getting arrested and for that? So finding the right sort of balances here in the digital society is key. But I don't think CBDCs is the big issue here. I think we have much broader and bigger and more imminent issues to address first.
Well, what I really liked about that answer is, like, you were bringing up privacy, you were bringing up questions of automation, questions of transparency, which also then pushed to the big last issue of both the conference, but also of international regulators involving artificial intelligence. How do you view the biggest benefits and challenges of AI and generative AI in the world of central banking?
Oh, I'm sure there are a lot of participants at this conference who Hannes knows much more about this. I'm still very much a newbie when it comes to artificial intelligence. But let me say that I noticed a lot of interest in large language models, rapidly evolving, and I think the way central banks need to address this are from both sides, which is sort of going back to what the hub is really about. See, how can we use the new technology to do a better job ourselves? So, and I think market monitoring, sub-tech monitoring is probably the areas. But equally important, perhaps even more important, is to follow and understand what the industry is doing with this new technology and say, okay, given that it's there and it's being used, what does it mean in terms of financial stability and other public policy objectives that people such as me and my colleague are particularly interested in. And well, there is opportunities, but there's certainly a lot of risks in this area. So yeah, we're not going to get bored anytime soon.
And neither will we, not at the conference and certainly not in this global conversation. Really, I can't thank you enough for making the time, virtually and otherwise, and looking forward to having you next year here with us. Your opinions are important and they help to drive the global conversation. Thank you, thank you, thank you for joining us.
Thank you.
The event will resume shortly.
The program will begin in a few minutes. Please take a seat up in the main theater or take advantage of the overflow room downstairs if you'd like to continue enjoying lunch.
The event will resume shortly. Please welcome back to the stage the founder of DC Fintech Week, Chris Brummer.
All right, people are trickling back in from lunch. Nothing is like lunch, but we are going to have a very, very, very special presentation right now. We like demos. We like showing people how things work because it's hard to develop policy and ideas and to criticize or to like things if you haven't sort of seen things that work. And one of the themes for today is augmented reality. And we're going to have a conversation on augmented reality afterwards with an epistemologist and then intelligence officers. So I wanted to first have that demo with Justin Malilo, who is the founder of Mona. Justin, come on up.
Hello, hello. Hi, everybody. My name is Justin, founder, CEO of Mona. Today, I'm really excited to chat with you about a lot of future-facing technology, specifically the metaverse, but let's break it down into some more understandable concepts here. So what we're going to talk about today is building the immersive internet. So I'm really excited about this topic. In a little bit, we're going to get into some really exciting things about augmented reality, virtual reality, just the future of how we as humans are going to be consuming content and interacting online. If we look at how we interact with each other today, we're actually spending more and more time consuming content, connecting with each other online than we are in person, whether it's on social media or on Zoom, or even in virtual worlds with hundreds and millions of people who are connecting in digital immersive experiences. The reality is that we are going to continue to interact with each other via this digital medium. And so what we like to think of as the future of the internet as just being more immersive. This is going to impact everything. I think when people think about the metaverse, we think about gaming, of course. That's kind of one of the initial use cases. But it's literally going to impact everything that the internet touches. The entire internet is going to change so fundamentally over the next 10, 20 years. We're already seeing it happen today. And if you're familiar with VR, with AR, you sort of have a glimpse into the future of what this is going to look like. Basically, what we mean is right now we're so used to interacting with content online in a very 2D manner. Kind of like reading a newspaper or a magazine. We're looking at a screen, we're interacting with content, we're watching videos. But with spatial computing and what we talk about with augmented reality, basically the whole foundation of the internet is going to change. Not just the internet, but how we interact with computers as well. The internet is going to become much more spatial. It's going to be much more contextual to our surroundings. And basically, there's going to exist these multiple digital layers on top of our real world. And it's going to be a really exciting future. But where are we today? Today, what it looks like is these immersive worlds that creators are building. So if you're familiar with games like Fortnite, with Roblox, these immersive worlds, these settings, they're built by 3D artists and developers. And so to get to that eventual future where we're consuming content in this more immersive way, what we have to do is provide creators and developers with tools that enable them to build these really exciting and enriching experiences. And so what we do at Mona is really dedicated to that. It's building these tools for creators to build these next generation experiences. And so what we aim to do is really become this foundational substrate of these immersive assets across AR, VR, games, everything. And so I have some videos that I'll show you just to give you an idea of what we're talking about here. So when we talk about the future in AR and VR, we have to kind of meet users where they're at today. And so these are all games that are being built right now. They're all accessible inside of Mona. Some of them are games. Some of them are also just immersive spaces, interactive experiences. that we have thousands of people connecting with each other in. There's scavenger hunts, there's racing games, there's interactive concerts. And essentially, these are all browser-based experiences that are tokenized. Blockchain is a really, really important part of the future of the internet, but also for the future of immersive worlds. And in a minute, we'll get into why this is so important. But what's really exciting is that all these experiences are available online just through your desktop web browser. You don't need to download anything. And we have thousands of creators who are building now. We have upwards of 15,000 worlds that are all available via the Mona platform. They're all decentralized. Another example of this is augmented reality, where we have creators who are building these tokenized 3D assets, characters, experiences, that through the web on your mobile device you can also experience seamlessly integrated with the world around you. So it's not just games, it's not just virtual concerts that you can see on your desktop web browser, but you could actually have an immersive AR experience just on your mobile device today, even without a headset. And then if you think about all the different ways that AI is going to change the creation process, creators today can use text input to generate 2D images. And if when I was building this presentation, it was actually before a really neat tool that just came out that lets you go from text to 3D as well. So in the very, very near future, this whole process of creating immersive worlds experiences, both for desktop or mobile consumption, also for headsets, it's just going to accelerate at such a rapid pace, and it's going to become easier not just for 3D artists and visual effects designers like myself to be able to build these worlds, but for all of you to build them as well with a simple sentence that you type into a computer. Briefly, I would love to touch on some of the importance of why blockchain is a really integral part of this. With Mona, basically, the process enables any creator to build a high-quality 3D asset, upload it to our platform, where it actually gets uploaded to IPFS, which is kind of like AWS if you're not familiar with it, but it's fully decentralized. It's not owned by one corporation, but it's actually owned by a network, a community of people that use their computers to help store the world's information. Because it's decentralized, this is what's really important. We can actually empower people to actually own the assets that are being built by creators. So creators can build in 3D just like they typically do. They upload them, their assets that get decentralized, and then they can tokenize those assets as NFTs using Ethereum or Polygon. And then you can actually go and purchase these assets, whether they're gaming skins or immersive worlds or anything. If we sort of break this down further, if you think about all the money that's being spent right now on gaming skins specifically, hundreds of millions of dollars are being spent in games like Fortnite, Roblox, purchasing these in-game assets, avatars. The reality is that if the game shuts down, if Epic decides for whatever reason they want to discontinue Fortnite, or for whatever reason a game no longer exists, all of that value is lost. You don't actually truly own the asset because you can't take it out of that context of that one game. So this is why blockchain is so important and why what we're doing is really important, because we have this process that basically allows creators to build these assets, and then for you or anyone to be able to own them, use them inside of any game. You could use them inside of Mona, but you actually own the asset and could take it with you anywhere, and you could use it in any way that you like. You actually own it. I want to show you one example of this as well. So this is actually an environment that was built by a creator. This is it through the web browser, through Mona, so you could run around, explore it like any other experience. But because it's decentralized, because the actual underlying asset, which is built in an interoperable file format, you can actually bring it into other experiences as well. So this is running inside of Fortnite, inside the same environment. So basically what you can do now is build one asset and use it anywhere. This example is just Fortnite, but you could also bring this into Roblox. You could bring it into an entire other game. And so the owner of this asset can actually truly use it wherever they like. So that's Mona, that's what we're doing. And what we're really excited about is the future of the internet. Eventually, this is going to bleed into more future-facing tech that we're seeing today with augmented reality and spatial computing via headsets like the Quest 3 or the Apple Vision Pro. But today, it's really important to recognize that we are all connecting in this virtual medium, and it's a really exciting future, and I'm excited to get into this topic further with our other speakers.
Okay, so that was pretty interesting, not just in terms of what people can do, but also the functionality of what people will be able to do individually and otherwise. When we get into commerce, commerce is about relationships. Commerce is about understanding what other parties and counterparties are doing. And it's about understanding what the commercial reality or fundamental reality of things are. And so I wanted to ask my Georgetown colleague, Will Fleischer, to kind of join us. He is an epistemologist. He's a philosopher, smart guy. To kind of talk a little bit about what augmented reality even means, particularly in a space like of fintech. So I guess when you look at how different kinds of gaming systems are arising, and I think people are like, Chris, you're bringing in gaming into fintech, not just because transactions are increasingly, there are commercial transactions embedded in fintech, but also it really pushes the boundaries again on technology and where the innovation is actually coming. How does augmented reality, first of all, I guess, change what we understand to be reality? Qu'est-ce que c'est?
This is a very good question. There's debate among philosophers about whether we should see virtual objects as real objects or as fictional objects. Since we're talking about moving them between games, you might think that makes them look more fictional. But regardless, the effects of these things are very real. People are exchanging very real money for them. They're having very real effects on people's psychology. Cyberbullying has a very real effect. Who owns what has a very real effect. So something about these technologies is creating something very real that's important for people's lives. And so we'll have effects on what we know and what we should do.
Well, okay, so I mean, I almost want to ask, like, what is reality if it's going to be augmented in the first place, right? So maybe we'll just do the vocabulary game here for the moment. Okay, what is reality, and then what is, from a philosopher's standpoint, like, what is the augmentation? Is it in how we understand what is literally in existence, or is it how we understand what information and knowledge is to begin with?
So if you think that virtual objects are real, like Dave Chalmers does, for instance, then you think that what's in reality has changed when we build these new objects. Just like when we build a new chair or a new building, there's a new object there. But even if you think they're fictional, when you write a new fictional book, that has radical effects on people's lives. They might come to love the characters. They might change their behavior as a result for it. They'll part with vast sums of money for it. So either way, there's this change to our reality, just the stuff that exists, whatever that is.
Well, I, for one, know that Count Dooku did live at some point or another, and that, that because of the profound impact that narrative, that story, had on me. Okay, well, if something, regardless as to whether or not it is digitized or physical, is real, as you would suggest, like, what does this mean then for knowledge? I mean, is augmented reality knowledge, or is it kind of knowledge?
You can have knowledge about augmented reality, but the objects here are very different. And when you go into a physical space and you see that you're in a room with 4 walls and you don't see any cameras, you think that you can do things privately. And you might make a similar assumption if you walk into a digital augmented reality or virtual reality space and see that there are 4 walls around you. But in fact, you can't make that assumption because the digital walls do not behave the way actual walls do. You could be being surveilled. In fact, you probably will be. So the assumptions that we make about ordinary garden variety objects should not be brought into the virtual reality world, but they will be. We will all behave that way in ways that can be easily manipulated by others. So there's a real danger of these augmented reality systems manipulating people, changing what they pay attention to, changing what they expect, gathering data on them in ways they might prefer it not be gathered, in ways they won't notice. So a lot of the difficulties of the internet are just going to be exacerbated.
So we'll get to the privacy point in just a second, but you see, I was a comparative literature major in college, which is of course why I do fintech. There are more of them out there than you'd think, and the idea that you have this idea of gaming in particular is supposed to be a fiction, right? Like you're sucked or subsumed into this alternative universe, into a world where you're actually explicitly supposed to be participating in a non-reality, right? But yet you may have things that happen, like a commercial transaction of some sort, buying a skin, buying a tool or whatever it is, buying an NFT, or just paying to use the game, that can have a very real-world implication, and that is probably what interests a lot of the regulators in the room. But what does the idea of fiction mean for then not just the attention span of an individual, but like literally their, legally we're talking about like their intent, their mens rea, but for their state of mind when participating in a virtual activity?
Yeah, that's a very good question.
That's why I'm asking you. You're the philosopher.
So no, you can very easily mislead people if they get too immersed in the game that they're playing. I mean, this is a problem we already have with video games. You can get people, you can manipulate their attention in ways that cause them to buy things they wouldn't otherwise buy, based on not realizing that the structure of the space has certain affordances that cause them to do things they wouldn't otherwise do, that play with their psychology in predictable ways. And so there's a serious worry that you're going to get, talking about knowledge, that you're going to think that you know things that you don't, that you're going to come to know just the things that the people designing the system want you to know, and then it's going to be hard to tell the difference between what's fictional and what's real. Am I spending fictional money, or am I spending real money?
That's a pretty good answer. Okay, so when you then move a little bit, to this question of not knowing, what parts of reality are real, and that blurring of the two, where do things like morality and ethics come into play in something like a metaverse? Is there morality in the metaverse?
Yes.
Okay, well, go.
Yeah, what you do in a metaverse space is going to affect other people. I mentioned cyberbullying earlier, and also the way that people's attention is being potentially changed by the designers of the system, or just by other actors in the system. So there's going to be differences in what kinds of things that you can do in the fiction. If you're playing Grand Theft Auto, most of us think that you can behave in various ways that you certainly can't towards other people in ordinary circumstances. But there'll be other aspects of the fictional space that have very real world consequences, and what you should do depends on how they're going to affect other people.
Interesting. So, my legal law and economics brain is kicking in by saying, well, you're not necessarily internalizing the costs of your behavior, and because you're externalizing them on others in ways that undermine their welfare, then that'd be immoral.
Yeah.
See, all the lawyers are like saying, oh my God, he's bringing me back to the second year of law school. What do you like about then metaverse? What exactly does augmented reality, from a philosophical standpoint, what does it allow? How does it change either how philosophers think about reality and knowledge, and in a more practical sense, what do you see as, say, the benefits for gamers or any other participants in virtual and augmented reality communities?
Yeah, I mean, I love gaming. I do a lot of gaming. So I think these new games that are being developed with virtual reality or augmented reality are really exciting. They might give you the opportunity to have experiences that you wouldn't otherwise have, or to interact with people in ways that you wouldn't otherwise get to interact with people. I used to play some MMOs where I made some very good friends who I wouldn't have met otherwise, and we got to work together on solving problems in ways I wouldn't have otherwise experienced that might have been good for my character. So there's lots of opportunities for these systems to be valuable for people. It's just a matter of designing them in ways that takes those people's interests into account, rather than merely the interests of the owner of the system.
Yeah, and again, for a financial technology sort of fintech perspective, one of the things that I've learned, and I make this joke all the time, California makes it, New York trades it, DC regulates it, and none of them can stand each other, right? All the different sort of poles of the sort of innovation ecosystem and the innovation space. And ultimately, a lot of the things that are made in gaming, right, they find their ways into all kinds of bits and pieces and parts financial ecosystems, like the innovations that start off in gaming somehow find their way into like a bank or some kind of commercial or consumer app. You had mentioned the question of surveillance. So what do you mean by surveillance? Not just from a practical standpoint, although I think you're getting into some really interesting questions and issues when you're talking about surveillance in a metaverse, which is worthwhile. But also, I don't get the chance, even though you're over at Georgetown, I don't get the chance to talk to epistemologists all day long. So I'm kind of curious about what, not just Foucault, but others think about surveillance. But let's just start, with number one. What does surveillance mean? What does it even look like in a metaverse context?
Well, the kind of surveillance, what Zuboff calls surveillance capitalism, that drives the internet as we have it now, is a matter of just collecting data about people. And there might be notice and consent for that data collection, but that notice and consent to most of us in philosophy and law and elsewhere seems inadequate to generate genuine consent because of the sheer volume of things you would have to read through and agree to. So right now, the whole ecosystem is built on finding, capturing data about people's behavior. In the metaverse, now we're going to have a whole lot, potentially more behavior, fine-grained behavior. If people are putting on these headsets and we can track their eye movements and track their behavior through spaces, there's all this additional things that you can learn about people, especially in the aggregate, if you can train a machine learning system to recognize patterns that people might otherwise do. So now, surveillance is in part, the reason why we worry about it is that we are worried about other people knowing stuff about us that we don't want them to know. And now there's just more opportunity for people to learn things about us that we don't necessarily want them to know.
So in one way, you seem to be pointing to this idea that even as you enable more creativity, right, you're also able to then, if we are going to get really philosophical, I guess creativity is sort of an expression of human behavior and existence or whatever. So we can map more of it because it's being tracked, that your creativity is in and itself, not just how you behave, but like how you are proactively creating itself can be tracked. I mean, one of the interesting things about blockchain technology, and you talk about, is like on the one hand you have this kind of a debate, right? People who say everything's anonymous to folks saying that everything is transparent. From a philosophical standpoint, is there a kind of a happy midpoint as to the degree to which you have surveillance, for the optimality of social welfare, and the degree to which, too much of it ends up becoming destructive? What kind of guidance do our great philosophers have?
The figuring out how much surveillance we're willing to accept in order to get good benefits is something that we tend to think needs to be done on a sort of case-by-case basis. We need to think about what the benefits are, and we need to think about who's making the decision about how much data is being collected and what's being done with that data. So I would think that what we'd want would be democratic procedures for ensuring that the kind of surveillance that's being done and what's being done with the data that's being collected meets our ethical standards. That's the kind of thing that we would agree to if we were given the opportunity. And so this is one of the worries with any system that involves massive private ownership. I mean, blockchain allows distributed private ownership, which seems better than mega corporations making all the decisions for us, but it also puts up potential impediments to regulation. And so there's a worry that we're not going to have democratic oversight over these decisions. So while right now I think it's really laudable that we're trying to build this metaverse that we just saw talked about a moment ago through Mona, that we're trying to build it in a way that's helpful for creators, that lets them control their own things, that doesn't let some huge mega corporation make all the decisions for them. But we're still going to be in the situation where someone could have control over the most popular, the most exciting sites, the most exciting spaces. And then those people will have an outsized influence on what happens in those spaces because they just own them.
So I guess what we're going to wind up, because it is interesting, even when you get to the actual crypto space, kind of a question from a legal standpoint, on the one hand, I find it fascinating because for lack of a better word, the more decentralized any cryptocurrency or digital asset is from a regulatory standpoint, the least likely it'll be judged to be a security, and therefore it escapes regulation. But then at the same time, then the question is, oh wow, there's no regulation around, and what does that mean in terms of do you need and want some kind of centralization from the standpoint of just assessing responsibility for when things go wrong? And that's certainly a theme that you see not just from augmented reality, but all across. I think almost every emerging technology has some element, including AI, has some element of that question that our regulators are trying to grapple with. All right, so I guess this last question it has to do with just the internet. It's weird, and maybe that, which is why I really like Justin's presentation. If you guys think about it, we haven't actually used the I word, the internet word, very much, which is kind of odd, in a conference on innovation. But when you see technology on the internet and you see it collectively transforming not just individual experiences, but collective experiences, what does that mean? Again, from these big questions about reality and knowledge.
Yeah, I mean, again, there's going to be just more opportunity for changing people's minds about things and potentially manipulating them by manipulating what they're paying attention to. If everyone is in the same space, if it gets very popular and people are in the same augmented reality space or virtual reality space, then that, whoever's controlling that has the opportunity to change people's minds in ways that might not be transparent to them. And if the space is very popular, then you can change a lot of people's minds. And we've seen that already with social media platforms, that this can have bad effects on society and on democracy.
And on that happy note, Will, I want to thank you. This is super interesting. As I said, I think it's really important to actually ask some of the big questions, even when we're in our little details and in our little silos. Thanks so much for joining us.
Thank you.
I'll let you leave, and meanwhile, thank you very much, Will. I'm going to welcome Michael Inlander, who is one of the nation's leaders from the Office of the Director of National Intelligence, to talk about preventing Skynet. Thanks so much, Michael. All right. Thank you. We don't always have this, just really the ability to have our leaders from our national intelligence community here with us to talk about financial intelligence, financial intelligence, financial technology, and the like. But I guess, from your perch, maybe I should just start there. From your perch, which is pretty different from almost everybody here, even though you are familiar with our financial agencies. What is the role of national intelligence in questions like immersive reality or augmented reality, or for that matter, artificial intelligence?
So Chris, our job here really is to answer policymaker questions. We are designed to give competitive advantage, insights to policymakers, and typically for the intelligence community, we're thinking about the opportunities that exist and the risks that exist. Most often, of course, looking at foreign actors, but of course, when you're dealing in emerging technologies, when you're dealing in the economic and financial space, you have bleed over between foreign actors and globally.
Yeah, that's got to be, just sort of fielding questions from across the policy community. That's got to be pretty interesting. I mean, you've got different ideologies, different parts of the government, and the like. I mean, when you guys, when national security professionals tackle questions concerning emerging technologies, and there's a much broader suite of those kind of popping up, how does the way in which you look at those questions differ from, say, the way in which a financial regulator looks at those questions or tackles those questions?
I think there's some areas of overlap and there are some differences, right? In terms of the areas of overlap, when we think about risk, we might also think about systemic risk. We might think about economic instability. In our space, we're often coupling these risks with political risk, military risk. If there's risk of economic instability in a foreign country, what is the likelihood of spillover to political change? Repression is something that comes up in this space. In terms of opportunity, we're typically looking overseas, but we're thinking, okay, if this foreign actor, if this country is able to make a jump with adoption of a given technology, with the raw materials that might underpin a supply chain for an emerging technology that's set to make a leap, what are the national security implications of that?
Yeah, that's pretty interesting. We had Vice Chair Barr here very early on and first up, and we had talked about sort of different kinds of trade-offs that he has to work through under his mandate as the regulatory guy at the Fed, right? And those kinds of trade-offs obviously have to do with economic growth, for him, financial stability, the stability of the banking system and the like. And it seems to me that the kinds of issues in that bucket of trade-offs that you have to deal with, and certainly over with the Director of National Intelligence, those are much bigger kinds of buckets, right? It's like, well, is the economy doing well here versus what happens in any, the future of a certain country or something, and the macro political environment. Pretty tough to do?
It's a challenge to do. That's why we do it as a community, right? So the intelligence community, 18 elements that are working together. So the role of ODNI in this is really to think about, across those 18 elements, how do they need to be partnering and integrating together? And what are the skill sets that are needed to answer the breadth of those questions? And so we're thinking about, does the community have the right expertise? Are they integrated in the right way? How are we doing burden sharing or aligning to priorities? And where do we need a partner to help fill some of the shortfalls that we might have?
So in the context, we talked earlier, you have this new executive order on AI. It seems that there's a pretty expansive approach in at least the financial community has already been thinking about the risks and benefits of AI. How much was the intelligence community at all involved, mentioned in the EO? I didn't have enough time to read all 180 glorious pages, but was this something that touched on the intelligence community?
Yeah, so there's a little in the EO as it's out that mentions the intelligence community, which speaks to ensuring that the intelligence community and the military are both effectively adopting AI, but also doing so safely and in line with ethical standards that will be established in a White House-run process over the coming months. Our role typically in these things really is as the informer. So if the White House wants to run a process, whether it's an executive order on AI or any of the other national security processes that they would run from there, that's where the intelligence community at the national level tends to plug in and to give a laydown of our understanding of what's going on, in this case with the application of technologies, foreign leaders' plans and intentions with regard to those technologies, related supply chains and the like.
So when you go through risk assessments, this the nature of the cost-benefit trade-off of emerging technologies can be pretty tricky. From the intelligence standpoint, how does one go about even beginning to do that process? What are the parameters of trying to, when you make a risk assessment in terms of the half-life and the like?
Yeah, so this is an area where we're really still sort of thinking about and developing these things in a way that can be standardized across emerging technologies, and particularly recognizing the interdependence between them, right? Not just on things like compute, semiconductors and the like, but also on data and data privacy. How are we making apples-to-apples comparisons that can allow policymakers to understand one risk versus another risk? And so, this is an area where we're always working on developing our trade craft and methodology, but I think we benefit from exchanges with industry and with academia on this. One, to make sure we're understanding the perspective that industry has, both with respect to the opportunities and the risk. And two, that that when our policymakers then are going to an industry day or meeting with regulators, we have sort of a common vernacular and a common framework for thinking about the risks and the benefits of various jumps in technology.
Well, to sort of touch on those different communities, and I obviously appreciate that. We just had an epistemologist on stage, and actually, kind of brings up this one idea, of what does the assessment of risk mean when you're tackling, things that really push the boundary of what people understand as actors or non-state actors. I mean, we're called Preventing Skynet. It's tongue-in-cheek, but it's kind of interesting. When you have non-state automated artificial intelligence questions, and how do you even begin to conceptualize that in a way that is consumable for policymakers across the government? What's when you build out that framework, what kind of stands front in mind for you when you think about an issue like AI, and are there any themes that you think are critical just to keep in mind from that process standpoint? I know you were talking about collaboration with different parts of government, but and with civil society, anything that really comes to mind for you?
Yeah, so I would say that typically when the intelligence community is brought in to help inform one of these conversations, it's where the policymakers have a decision to make. So, how do you break something like AI down? It's typically in a given scenario, what does that mean? So I think, as we sit here and think, and as being reflected in the conversation that you're having with government colleagues today, is there a merger or an acquisition where the government has to decide if mitigation is needed because of national security threats? Is there a license that has to be provided? Is there an aid agreement that's being discussed, or a trade agreement? And so in those contexts, oftentimes the policymakers are thinking about what is the risk to data privacy? What is the risk to intellectual property? What is the risk? And so that sort of gives us a scoping mechanism where you're not confronted with all the risks that may exist in the broadest space of AI. Certainly, we need to be grounded in the technology and have an understanding of the broader context. But we can help narrow sort of what we're looking at based upon the decision that policymakers are contemplating.
Well, we're wrapping around the last couple of minutes, but that's, as I keep trying to underscore, and how interesting and how difficult and tricky that must be, because you have all these different macroeconomic, he's like, yes, it is, geographic kind of issues at play, and then you have like the technology moving. When you look at the speed of the development of technology, right? Like that. Whether or not you're in the intelligence community, whether or not you're a staffer for a congressman or an academic, that impacts, how you think about things and how you frame and create conceptual models. Do you see, just the speed of the development of these technologies, forcing or new kinds of creativity within the intelligence community? I mean, and I mean this very honestly. Like in our regulatory community, on the financial end, everybody kind of, we have something called the administrative state. We have certain kinds of ways in which we deal with stuff, and it's by statute. And there's some things you can do and some things you can't. And sometimes the technology can just do laps around literally the ability of the government to respond just because of those legislative constraints. Are there, is the intelligence community well suited to, or how does it adapt in time for changes in terms of how the emerging technology space is developing?
Sure. I think because of how fast-paced the evolution is in this area, this is where the intelligence community really looks to industry and academia to partner. If we are trying to sit around and understand the tech developments as a proxy for what industry already knows based upon the innovation it's experiencing, that it's driving, that it's funding, we don't have a chance, right? Like at scale, and by the way, nor should we try to replicate that. So this is really an opportunity, I think, when you have things that move quickly in this area, it's incumbent upon the intelligence community to have technologists and people who understand regulation and who understand finance, who can interact with industry in a credible way, but where we can learn from them and where we can really partner around understanding what breakthroughs are coming, how they're being applied. And that lets the intelligence community come in and really start to think about the applications of those technologies by specific non-state actors that are really working on standard setting or might threaten intellectual property, might threaten data privacy, and to elevate those themes when we're asked about risk. And likewise, I think industry has a very key role for helping the government broadly, but the intelligence community included, understand the opportunities, right? If we're only focused on the risk, we're not doing the policymakers a service. So just as likely when we're looking at these overseas actors, where are there elements of the technology that can enable cooperation or collaboration that otherwise might have been inhibited, and how can we elevate those opportunities to our customers as well?
You know, that is great work, and I honestly think that to the extent to which any kinds of conversations are done with the financial regulatory community, I think that they can learn a lot from you, and I'm sure that there are some really interesting insights as well there. But thank you for all of your work, and thanks for coming to DC Fintech Week.
You got it.
All right, thanks. All right, so with that, we are going to get into a conversation to talk about another black box, which is the statistical computations that go into developing many of these tools. And for that conversation, I am delighted to welcome my dear friend and colleague, Jason Kay from FHFA, along with Francesca Hopwood-Head, who's leading all of the BIS innovation work over in London, Melissa Koide, and former CFTC chairman, Tim Massad. Welcome you all to stage. Thanks.
Can't see anybody up here.
All right, I know the lights are on. All right. Well, welcome everyone. Thanks, Chris, for putting this topic on the agenda and for assembling a terrific panel of experts. I think if they cannot explain the unexplainable in this field of study, I'm confident that no one can. So let's get to it. We're really fortunate to have Francesca Hopwood-Head, Center Head, Innovation Hub, Bank for International Settlements, which I hope is as cool as it sounds. We have Melissa Koide, CEO at FinReg Lab and esteemed judge at the FHFA's Velocity Tech Sprint. Sorry for the shameless plug. And Tim Massad, research fellow at Harvard Kennedy School, former chair of the CFTC, and overseer of the Treasury portfolio of emergency programs, who had to deal with some very unreasonable people at some of the independent agencies during the crisis. Is it too late to say sorry, Tim?
One has comment on that one.
So one has to hand it to Professor Brummer on timing. To have predicted 1 year ago that AI would be the topic of the day is one thing, but having the event follow by a week the new executive office order on AI, well, that's impressive. So In reviewing some of the press releases, there was a quote from President Biden that really put the issue in the proper context for the session. Said, "One thing is clear, to realize the promise and avoid the risk, we need to govern this technology." So plenty of work for regulators, policymakers, and market participants, including consumers, to get engaged in shaping the new frontier and the necessary guardrails. But enough about that. Fortunately, like I said, we have Francesca on the panel, who is at the center of the action here, helping regulators and market participants use AI and ML to help advance top supervisory priorities, such as detecting and shutting down money laundering networks. So Francesca, can you tell us how you and your BIS colleagues are preparing for the new challenges associated with governing AI models and methods, especially since a McKinsey study recently noted that explainability as explainability gains importance, it is becoming significantly harder. So how are we going to figure that out?
Thanks, Jason. And I can confirm that, yes, the job that I get to do is a very cool one, and I enjoy it very much. So, I mean, I think some of you over lunch might have seen Cecilia Skingsley, who is the head of the BIS Innovation Hub, talking a little bit about kind of the breadth and the of work that we do. And I think, the question you posed to me was around sort of practical challenges, and I think the contribution that we seek to make in the Biz Innovation Hub in this space and across the other domains that we work in is around really bringing that practical experimentation. So we are working with emerging technologies to really understand how they can be applied to a whole range of different use cases that pertain and are really of most import to our colleagues across the central banking and regulatory world, so that they can start to see kind of what might these technologies mean for them. How might they want to deploy AI and machine learning in different contexts and in different use cases? And I think what's so powerful and important about that is that it starts to really reveal and surface, so what are the key challenges? What are the key opportunities? But at a more granular level, what does that then start to look like across the value chain? We work in the sort of space of proof of concepts and prototypes. And I think in doing so, it really reveals what are the key, if as regulators and central banks, we are using these technologies and we are thinking about them, what questions do these surfaces? What are the things that we need to contemplate, whether it's around explainability, for example, in the work that we do? And I think that is really important and insightful, particularly as you say, Jason, there's kind of a real acceleration and pace of change. But it also, I think, enables different and deeper conversations with the wider market, as you talked about, that wider community of market practitioners and participants, to really have those kinds of conversations about kind of how to interrogate how different tools and techniques are being deployed.
That's great. That's great. And if you haven't checked out the BIS website on the Innovation Hub, definitely do it, because first off, they have very neat names of their projects that they're working on, but they're also very, very interesting. So really, thanks, Francesca. Melissa, you and your team at FinReg Lab have been adding well-informed, objective analysis and recommendations to a topic that is often fraught with hyperbolic predictions in either direction. As we move from ML and basic AI to large language models and neural networks, what's keeping you up at night? And how can we best position the financial system, particularly those organizations supporting the underserved, to be informed users of the new tech?
Thank you. It's a pleasure to be here. I hope I'm sharing some information with some of you you've not heard about before. Before I stood up FinReg Lab 6 years ago, I was sitting in the US Treasury Department, and we were being inundated with perspectives about what technology and data ultimately would mean for people, for households, for the financial system, and bigger systemic risk matters. And so upon leaving Treasury, I was leading the Office of Consumer Policy in the Obama administration. I stood up an organization basically to invite in the policymakers and all the different stakeholders who are trying to grapple with how do we understand the advantages of data, how do we understand the advantages of technology and more complex analytics, and how do we then think about evolving our laws and rules that govern ultimately the use of these technologies and data in the financial system. So since 2019, we've actually been interrogating empirically through engagement with industry stakeholders, what does the use of data in a high risk but high opportunity use case in financial services actually do? So we look at credit underwriting, and we've built and evaluated a number of machine learning algorithms. These are supervised machine learning algorithms being used in credit underwriting to understand, and we independently interrogated the data questions, because I think those two pieces are essential as we think about what keeps any of us up at night. Questions around, can we understand sufficiently how these algorithms are being deployed, especially in contexts where we actually have laws that require explainability. You have to be able to tell a consumer why they got a credit decision and if they were denied. And you also have to interrogate for, are those models fair? And if they're not fair, are there ways of finding fair model outcomes, a disparate impact assessment? And so the thing that keeps me up is the fact that, one, machine learning algorithms of the type that we looked at actually can, compared to more traditional models and approaches for finding fair models, actually can result in greater accuracy and also finding more inclusive outcomes, especially for, we have 50 million US adults who are unable to be credit risk assessed sufficiently with more traditional data and more traditional models. So machine learning as a form of AI can get us into really good places, but it only happens if you get the data right and you make sure that you have data that are representative. And so even when we're looking at supervised machine learning, the data is really essential, mitigating for risks of bias, exclusion, statistical bias. And then when we think about what we've all been paying attention to, especially over the past 11 months, much more sophisticated, complex models, LLMs, Gen AI, these questions around how are we going to make sure that the data that are being used to train those models aren't creating bias and exclusion. I think that's the big thing that's in front of all of us. And the last thing I'll say before we keep going is, I think that especially in financial services, because we do have laws that dictate and govern, you must evaluate, interrogate, and understand. And we have entities that have responsibility for making sure that the use of those models are complying with laws. I think that it's a helpful template as we think about the use of more sophisticated versions of AI in other contexts. I'm not saying we need to whole cloth go adopt a disparate impact assessment in other areas, but I do think looking at what has happened in financial services and contemplating how we think about setting our expectations, going perhaps beyond principles, is an important place for all of us to be right now.
Great. Thanks, Melissa.
Sure.
All right, Tim. Tim, you've served in many key roles during and after the global financial crisis. So it's fair to say you've experienced firsthand what happens when the financial system veers off its intended course. As former chair of the CFTC, you know what it takes to run an organization in the midst of industry change. What are some of the first steps you would take if you were running the CFTC or any agency to ensure that your organization was well prepared for the impact of AI on your regulated entities as well as your internal operations?
Ask for more money, but you're not going to get that. So look, here's the challenge. I mean, you're going to have firms using these models when they don't fully understand them. The technology is going to give an advantage to incumbents and to large organizations with lots of data. And to the extent that it leads to new firms entering your area of regulation, that can be a challenge too, just because of the fragmented nature of our regulatory system means it's very hard for an existing agency to exercise jurisdiction sometimes over new firms. We've seen that over and over again. So what do? How do you make use of the resources you have? Because limited budgets really affect you in two ways. One is you can only allocate so much to this area, but also how do you build a staff with the expertise when you cannot possibly match private sector salaries? So regulators, are going to be doing audits, but that can easily just become a whack-a-mole kind of strategy. I think you've got to think about how do you leverage the resources you have. And to me, in addition, obviously, to having clear access not just to the model, but to a firm's internal audits, if possible, and internal testing records. I think we've got to think about other ways to leverage resources, third-party certifications, perhaps, and testing. We developed that kind of a notion with a lot of the cyber and information technology rules, where we required regulated entities to show that they had, gotten certifications or testing or that their technology providers met certain standards. Maybe we need self-regulatory organizations to help us in this area. I mean, the self-regulatory organizations have been a big part of our overall securities and derivatives framework. Maybe that's needed here. I think this will also be an issue for financial stability concerns. The FSOC will have to get geared up, Jason, in terms of thinking about, what might be the implications of machine learning, where if the models are learning from one another, is that kind of going to create sort of a momentum toward maybe some buildup of excessive risk? I think there also is an opportunity. You'd like to think that, gee, can't you train the models not just to not discriminate and do all the things that Melissa has warned about, but to also advance regulatory goals in the best possible way. But would you have the authority to do that? That could be a stretch of existing rules, particularly if the Supreme Court, as it may over the next year, cuts back regulators' discretion. So it's going to be a challenge.
Great, great. Some of this, reminds me. I feel like I've been here before, and the enthusiasm and excitement of where some of the new technology, the models can take us, and not to be a downer on it. There's a lot of opportunities we can learn from. When I first came to town 110 years ago, there was this thing called Basel II and this new world of internal models for credit risk analysis, and we were very excited. The 1,000 flowers blooming. We were going to get rid of capital ratios and 5 risk weights of putting everything in there. We would say, how could you put everything in the world in a few buckets? And the speeches, I was just looking at them again, talking about how we're going to really use sophisticated modeling and we're going to put safeguards and all of that. And there was a lot of excitement. Some of you in the room might have been on some of those journeys. That was 22 years ago. And now we look at where the regulators are, like I said, 20 plus years later, and we've got a Basel endgame that says we're taking models out and we're going with standard risk weights because we're really not that comfortable. So, there's a real important thing here to really make sure that the market regulators and everybody are really going at the same speed, that everybody understands what their motives and objectives are, and go into these with eyes wide open, because I think that was an interesting journey that got us in some ways back to where we started, but we learned a lot. Let's hope we learn a lot with this one as well. We've got a few more minutes. Is there anything else? What else while we have this great group? What other cautions or ideas or things we want to say? Let's just open it up.
Well, I think it'll be interesting to see how this develops in terms of regulators having access to the models. And Melissa, I'd appreciate your thoughts on that. I just recall, when algorithmic trading today dominates our markets, right? The whole framework of commodities regulation applies to firms that, frankly, aren't the primary traders anymore. The primary traders are not subject to the rules. When I tried to push that issue, boy, did I get a pushback on getting access to algorithms of proprietary trading firms. So, and I think that could have been solved, but then there was this election and I was out of a job. But I wonder how you think about that access issue.
Yeah, I mean, I think the conversation, especially in retail financial services and the more complex models, frankly, has been evolving. I know Yelena is coming up soon, and she'll talk, I'm sure, a little bit about where she had been emphasizing when she was leading the FDIC around SROs, self-regulatory bodies, because there is a lot of pushback still in industry. Wait, you want me to share? Like, this is our secret sauce, whether it's fraud models or underwriting models. You know, marketing models have their own sort of big uncertainty around them, but this intermediate step of finding third-party trusted intermediaries who the regulators will have enough trust and confidence in, their sophistication in being able to interrogate and study the models, but not so close that industry is going to be so anxious. So I feel like this is sort of coming back in some ways. The thing that I would put on the table that is live right now, and I feel like I'm beating a drum here, but it's about the data dummy. And right now we have over 10 years post Dodd-Frank, 1033, the CFPB has issued a proposed rule around consumers and their ability to share financial data, certain financial data, but important financial data that does have inclusion benefits. And so how are we getting those rules right, where we're sensitive and responsive to consumer data privacy considerations, but also making sure that the advantages, especially for the financial sector, which is all about mitigating risk, which is all about data. You need information to do that well. How do we get those rules right? So this is a little bit of a advocacy plea. Pay attention, engage. They're taking comments on that rule right now, and it's got real implications for the financial sector to be able to build models, simple or complex.
But how do we make that rule truly usable by, you know, how many people are really going to use that rule aggressively, right?
Yeah. Yeah.
You know, maybe.
So I will say, I mean, we spent a lot of time talking to the financial sector banks and fintechs, and frankly, there's a level of uncertainty right now on where are the regulators and what's safe to use in terms of consumer financial data. And so getting this rule finalized, I think, is going to help to define, okay, what are governance expectations around this data, whatever model you're deploying it with.
I mean, I just wanted to pick up something that you were talking about, Tim, in terms of kind of, you know, staff and talent and how to engage people. And I think, you know, one of the observations and I think one of the privileges of the kind of the roles I and my colleagues have at the Innovation Hub at the BIS is you get to see kind of the broad sweep of how central banks and regulators across the world are thinking about and engaging for their own purposes, you know, using AI and machine learning. And what I would say is that, you know, there is a you know, the kind of the skills within the data available within agencies to really start to deploy some of these tools. There is a real spread of maturity around that in terms of you know, capability, availability of data, availability of technology, how that sits with your legacy systems, and so the flexibility and agility of different entities and organizations to really harness. You know, we've talked about AI and machine learning, you've talked about supervised and unsupervised, you know, thinking about the different generations and what that looks like, and actually their ability to kind of come into that space in a context where, you know, the theme of the day we heard earlier about sort of Gen AI, we're talking about later on this afternoon, kind of regulation of AI. It's, you know, there is such a pace of change, and how authorities are able to keep pace with that, I think, is really challenging.
Well, and I just really worry about this being the new thing that concentrates the financial system even more, right? Because clearly the model production is going to be concentrated, right? The firms that do this, and clearly it's going to give an advantage to firms with lots of data.
And I do worry about the smaller institutions. We didn't talk about, you know, the thousands that don't have the capacity, don't have the staff. So it is a really important piece.
And I worry about not getting invited back, so I'm going to wrap this up.
They're out of time.
And say thanks so much to all of you in this great conversation, and hand it back to Chris. Thank you.
Our voice of God system back up and operating well downstairs. We're gonna take a quick little break. When you look at the folks coming on, you know it's going to be, it's going to get real. It's going to get very interesting with conversations coming across the regulatory environment with some of our top regulators, as well as people in the front lines of digital assets and safe banking. Go get your coffee and then come back, and I'll see you soon. Thanks. Okay, it is great to see you back. I know a lot of folks got some good munchies. I guarantee you we're going to have some conversations that will keep you awake and keep you engaged for the rest of the evening. And I am delighted to begin that conversation in a bit of a speed round on pound per pound, one of the most interesting conversations for today with Siki Ballard. And we're going to talk a little bit about technology. We're going to talk a little bit about community banks, something that I've always tried to focus on and to bring attention to here over at DC Fintech Week. But first, Siki, maybe you can tell us a little bit about like banks and banking and technology and just a little snippet of your journey.
Sure. My name is Siki Ballard, everyone. I'm the founder of Beta Bank. We are a de novo commercial bank focused on small businesses, and our mission is to provide fair access to capital to all small businesses. Our origin really is inspired by my father's story. He is a pulpwood logger. When I was a kid, he owned a company. People would pay him to clear commercial and residential property. He'd take the lumber, sell it to the local paper mill. He grew a very successful small business when I was a kid, but he wanted to expand this business to surrounding states. And the only way that he could do that was to go secure financing so that he could upgrade his equipment to be able to make the long haul trip. And so he went to a number of banks in the area, 13 to be exact, applying for small business loans, and was denied by every single bank. And his hypothesis was that those denials had less to do with the merit of his business and its ability, capacity to take on debt, and more to do with the color of his skin. And after doing some research, particularly from the Federal Reserve, what I found was that all things being equal, meaning same balance sheet, same income statement, same cash flow, really you're the same financially. Black-owned businesses are about 2.7 times more likely to be denied a small business loan. In the event that they are approved for the loan, they'll pay about 180 basis points more in interest for that loan. This is actually true across all forms of debt financing. And if you imagine in the US, the two primary ways of building wealth are through homeownership and enterprise. So if you have a harder time getting a loan to purchase a starter home, or if you have a harder time getting a loan to acquire a factory to be able to grow your business, you can already start to play out how it becomes a lot more difficult to build wealth over time and across generations.
And so you just decided to start a bank?
Yeah. Absolutely. I thought it was a solvable problem. I just imagined my dad going into the banks, presumably after a hard work day in his, grungy clothes, sitting across the table from a banker who wasn't just evaluating what was written on paper about the merit of his business, but they were looking at him. They were applying so-called character tests, making subjective determinations as to whether he looked trustworthy or whether he fit whatever archetype they had in their mind of what a successful business person looks like. And frankly, that's the opportunity for bias to introduce itself. It plays in similar dynamics for women-owned businesses as well. And so my view was the way you solve this problem is by removing the human from the equation and basing your assessment of credit risk exclusively on observable financial and operating data about that business. I was employed at Amazon at the time, which is
total coincidence.
Total coincidence.
I like that. Yeah.
Total coincidence. But Amazon taught me a lot about how you can leverage data and technology to drive efficiency and automation. Banking, frankly, is in the Stone Ages with respect to data and technology. And so I thought there was a pretty big opportunity there to be able to address this problem that my father and so many other small businesses experience.
We talked very, very briefly, and I felt like we will have many, many more conversations later, but I try to tell people, when it comes to addressing that wealth gap in the United States, the way you build wealth is by owning a home and then somehow participating in the financial economy in one way or another. And if you can't do either one of those two things, you're not going to be able to diminish that gap. So where, you mentioned Amazon. So from a technology standpoint, there's the question of data and how do you utilize that data. We've talked a lot about AI as well. I think the national conversation is very often about AI and how does it sort of entrench interests. I'm really curious to hear from you about how you view AI as a competitive factor for a small business trying to grow, particularly for underserved communities.
Well, I think it has the opportunity to be to sort of democratize the playing field. When I think about the root cause of why my father had that experience, we then sort of go to, how do we solve that root cause? And so we started by filing a FOIA with the Small Business Administration. We asked them for every record of on every loan that they'd backed since the year 2000. They sent us a CD-ROM with about 1.2 million records on it, which we enriched with data we'd purchased from other providers. And the first step was sanitizing that data, which is to say, we want to really scrutinize, interrogate the data to remove factors that might create bias when we're then training the model. So then once we trained the model, we then tested it using the same SBA data and found that we could accurately determine when an SBA loan would be charged off in 98.2% of the instances. So in this case, we are relying exclusively on data, objective data about the financial operating performance of the business to then be able to accurately render whether or not this business is likely to default on the loan or not. So in that case, imagine that model having been applied when my father was applying for that loan. He would have been approved in all cases, I imagine. I don't see it necessarily as competition. I see it as a tool to bring more people into banking, more people into the ability to invest in their own enterprising nature.
So when you look at your journey starting a business, I love, it's like, how did you start your business? I FOIA'd the government. It's like nothing says, it's great. There are lots of regulators who kind of watch and in the audience and who participate. I mean, what do you think government needs to know about businesses like yours that they may not really be aware of and who may not really know that you exist? Like, what kinds of things could the government do better?
Oh, are you giving me an opportunity to explain?
I was like, here it is.
Well, I started engaging with the FDIC, the IDFPR, which is the Illinois banking regulator, and the Federal Reserve at the beginning of 2020. So we have been in the process of applying for FDIC insurance and a charter for the better part of 3 years. I believe the mental model that the regulators are accustomed to is community banking, branch focused, full of bankers and tellers and loan officers. And I don't think their understanding of how technology can advance banking has kept pace with the time. And I'll just give you one example of a question that our examiner asked, and this is after a couple years of going back and forth. She said, okay, you don't have any branches. I get that. You don't have any branches. How will people access your banking services? Now, I think on the face of it, it's a crazy question to hear. It's absolutely bizarre because in a branch-based system, if you don't live within a certain radius of that branch, you're not accessing banking services. So you have lots of communities that exist in bank deserts that may not have relationships with the bank. But I don't think I've ever seen a person who doesn't have a smartphone. Everybody's got a smartphone. So, instantly we go from this model where you can see that there's limitations in people's ability to access versus another model where it can be quite ubiquitous in terms of people's ability to access the service. So I would say regulators have to be willing to take risks. If we're going to build a truly resilient banking system that is taking on the promise of the best technologies available, we have to be willing to get behind models that are leveraging those technologies in responsible ways and bolster them to the greatest extent that we can.
I love this, for DC Fintech Week, what we've always tried to say, what I personally try to say is that everybody deserves to have access to the highest quality financial technology and to be able to grow with those technologies in a safe way, in a resilient way, in a way that actually opens up opportunity. You are an example of that, and I will make sure that I emphasize that throughout the rest of the conference. Thank you so much, man.
Thank you so much.
All right. So at the beginning of the conference, I had promised you not one, but two welcomes from the leadership here over at Fannie Mae. And I have with me right now Priscilla Almodovar, who is the CEO of Fannie, who has also just been an amazing advocate for this event. So I'm going to welcome her to give you the afternoon welcome. So Priscilla.
So great to see all of you. The energy today has been unbelievable. And like Dave Benson, my colleague earlier this morning, welcomed you. I too wanted to thank you and welcome you to Fannie Mae's offices. We have been a huge supporter of DC Fintech Week. And that's because we're very much committed to innovation and how we can find ways to use technology to create sustainable and inclusive communities for homeowners and renters across the country. For us to do our job well here at Fannie Mae, we have to stay on top of financial markets, the economy, but also what technologists and other entrepreneurs are doing. That's why today we are super excited that Chris gave us the AI, Artificial Intelligence Day, because we agree with a lot of the insights, and we're listening and learning as well. Like, how do we use data? Someone earlier said, it's all in a data dummy. And how do you use artificial intelligence to help us tackle the biggest housing challenges that we all face today? So again, mine is just a welcome and to thank you, to thank Chris Brummer and all the speakers. The next person on the stage will be Undersecretary Nellie Liang. Chris Brummer will join her, and I think you'll enjoy visiting with her. Undersecretary Liang has been in the front lines of the cutting edge questions relating to emerging technologies. So again, thank you for being here. Enjoy the rest of the program and look forward to working with all of you. Thank you.
Thank you so very much, Undersecretary. She was remarking on our fine Mozart music that was being played for this. So we do nothing but the finest here over at DC Fintech Week. Thank you again so very much. We know that you are extremely busy, and to take the time down, it really means a lot. I guess we've been having these conversations with all kinds of folks. One of the more interesting was with one of our leaders from the national intelligence community, who had remarked about the rapidity of technological change and just even keeping in touch and on track from an intelligence standpoint. From your perch over at the Treasury office, you guys have to deal with very similar challenges. And I'd even asked Michael Barr earlier, like how does the Fed learn about technology? But when you look at that pace of change, what's the Treasury Department's approach, and really, how do you approach financial regulation in light of technological change?
Yeah. So first, thank you. Thank you for having me here. It's really a pleasure to be here, and the music's great.
Yeah, I think. All night, folks. All night, folks.
So this broad view of financial innovation and AI and distributed ledger technology, from the financial regulator's point of view, I don't think we're starting from scratch. Financial regulators have been addressing financial innovation for decades, as you know. We've had machine learning in the past. We've had algo trading. We use models, different types of models. But so we're not starting from scratch. But and financial regulation is always about trying to mitigate the risks while preserving the benefits of the innovation, right? So there's no doubt that some of the newer innovations are faster and they're more complex and they're going to make the job harder, but it's not fundamentally different. And I don't think, and at least not the approach. You will look for the risks. You will say, how is it governed? What is the models? Where's the data? How are they managed? Are they creating interconnections that in ways we don't understand? And do we have the rules to address these? And so we'll take that same approach. Having done that, you may find there are places where there are gaps. I would say that usually, that can come up, and then in that case, you would, try to write some rules, but you would be approaching it in that sense. So AI's been around in different forms.
Yeah. I guess that's interesting. Even when I think about gaps, it's like technology. It can either move in a gap, it can create a gap. The regulators sort of have to fill it, but it is, there are certain kinds of priorities that you guys have. But one of the words that I always hear is this technology neutral stuff. Like you may have like a rule book, right? But or a philosophy, an idea. But technology neutral, like qu'est-ce que c'est? What does that actually mean for you in practice?
So it is it is the word same risk, same rules. It's basically you regulate the risks of the activities, not the technology that's producing the activity. And the benefits of that, I think there are strong benefits of it, is one, you're not chasing the technology, or you're not writing regulations that become easily arbitraged or become obsolescent very quickly. So it's about, different technologies, you do the same function, financial services, there's some sort of product or service or operations that you're changing, and you want to regulate the risks of that activity and not how it's produced. So that's all that's meant to say.
That's interesting, because even the terms of art in asking the question of like technology neutral, and people, one of the toughest things I tell my students is figuring out what it is that many times people will use a term of art, and even within industry, people can have very different definitions and ideas as to what a term of art means. And the tough job of regulator is to kind of take that and then either insert it into a regulatory idea or concept or term or something, and then to kind of make it more concrete and then to apply it. And so when you think about that work, and getting back to your original thing, your original observation that we do have models, we do have approaches, and the like. How then, when you look at AI, because you had sort of mentioned that at the very, very end, generative AI and the like, how does that compare to sort of earlier trends, earlier episodes in innovation?
Yeah. So first, as I said, we've had forms of AI. We've had machine learning and algo. We saw some, even like in the treasury markets in 2014, there was evidence of algorithmic trading that caused a little bit of a rally, a flash rally in a 10-second interval kind of thing. And I think there's a lot of learning, but there's no question it's faster, it's more complex, it's going to rely on more data, and so there's got to be more responsibility for data storage, data processing, more computing power. There's going to be models that will generate outputs that may not be able to be well understood, and so there's got to be a fair amount of governance and risk management about the models as well as the data. There could create spillovers and interconnections in ways that we haven't anticipated. So I think we have to work on that. And so those are, from a regulatory point of view, you're looking at the institutions that are wanting to use AI and say, what's your governance? How are you managing these risks? Can you explain the model outputs? How are you managing the data? Do you understand how this is connected to other firms or products in the system? And if you can't answer all those, then that's a risk management problem. So you start there. Could turn out there could be some risks that arise in the use of a new technology that aren't covered by our rules, right? But in general, we have a lot of rules around risk management and governance and conflicts of interest and fraud and all that. So usually there are some that apply and they may need to be modified. But
yeah, I mean, I know that you're like you're very, very plugged in, the Geppetto of the global economy. But with the EO had come on, was there any surprise? I mean, well, I guess maybe not a surprise, but where does the Treasury Department sort of fit in that work?
So as you know, the EO is broad. It's economy-wide, it's global, it covers a lot of things. Treasury is engaged mostly on two fronts. It's a pretty small, because there's a lot ongoing already. It doesn't mean there's not a lot of work that Treasury's involved in. One is on the AI-related cyber risks. And it specifically requires a report by our Office of Critical IP, thank you, OSIP, I know the acronym, to write a report on AI-related cyber risks. And that will feed into sort of more AI-related risks for the critical infrastructure of the economy. So that will fit in. And it turns out it's quite related to some of the work they've been doing on third-party service providers for critical infrastructure and cyber. A second way Treasury is very involved is just with the financial regulatory agencies. How do you think about how will financial firms use AI? And there's the regulated firms who understand how to work within the set of rules and regulations that they're used to. But technology has a way of sort of encouraging entry by new firms, right? And many of the firms aren't used to being in a regulatory space with supervisors. And so there has to be some focus by the community, by the administration, by the regulatory community on where are the new entrants, how are they adding value, and what kinds of risks are they adding? And so there's that in addition to just what the regulated firms are expected to do in using AI.
Yeah, I guess the talk is obviously about AI and Gen AI. There are a host of other issues, but one of the older, newer technologies would be social media. And particularly over the last year or so, and we've had two conversations with both earlier with Mike Su and Romaine Bostic from Bloomberg, sort of going through parts of SVB, and then I had sort of pinged Michael Barr earlier on just, again, SVB and Credit Suisse. Yeah. But when you think about social media and the Twitter or the X or the LinkedIn or whatever it is, carrier pigeons or the like, certainly that is playing a role in really the speed and the acceleration of not just data, but data processing and human responses to those data. Mm-hmm. Like how do you view social media and how it plays almost systemically or into governance and into your work?
Yeah. So I'm going to broaden social media to just sort of broader technology and banking and deposits, which is the SBV and things. So without a doubt, those deposits were extremely fast. There's no question. If you look at some research papers on bank runs and whatnot, every bank run episode this was the fastest we've ever had. So like Continental Illinois pointed to 30% of its deposits outflowed in 10 days. And it was because of new online banking, so there were some electronic funds transfers back then, and this is, back then. So that was the fastest run. But these were much faster. It was more than 30% in 10 days. It was much, much faster. So there's the ability, online banking, the ability to switch deposit accounts is going to make the job of supervisors and regulators quite a bit harder. Social media may have an impact as well. What the channel is, I think, is hard to know because there's information and there's misinformation. We do know, if you look at the history of internet searches. I'm going to just use that broad generic term, internet searches at the time. The failed banks had, huge surge in internet searches. Banks that are similar, like regional mid-sized banks, similar type business models, also had a surge in internet searches. These banks didn't fail, but they did come under pressure. Their equity prices fell. And then the largest banks really didn't at all. It was just sort of an interesting pattern. They were viewed as more resilient, and they turned out to be. And they were correlated a bit with stock prices. So there's some research out there that's sort of bringing some light to the role of social media, but it's not one for one. Like not every bank that has this surge is going to fail. So I think there's a bit of work to do. I think the regulators will be doing this. FSOC is following up on this. The FSB and the international, as you mentioned, global, the FSB working groups will be also looking at this. So there's a lot to learn here. And so what does one do? I think one has to think about, are our current liquidity risk management techniques appropriate in light of the speed of withdrawals? And so that's an area of follow-up. And
yeah, it's a bit of an academic-y nerd question that I have, but it's like, okay, so, liquidity, and even trying to think about liquidity in a world of social media and the like. Maybe I can ask a kind of a similar question that I asked Michael Barr, and you're already giving us some kind of insight into this, which is, okay, that's an interesting theoretical and real life question. Like, how do you learn and how does the Treasury Department deal with those kinds of questions? I mean, like, what's the process like when you're trying to think through a question like that? Is it a research kind of a question, or is it a sort of coordination question with other academics, or how does that work?
So it's all of the above. I mean, I think actually at one of the international meetings we had recently, we had a panel of academics talking about the role of social media, the role of what determines bank runs, what are deposit betas, have they changed? Like the sensitivity of deposit rates to interest rates, has that changed in light of all the new technology? So I think it's all of the above. I think it's a way to inform us and the broader community before you roll out new regs or rules or even supervisory practices. So I think it's just an important part of the process.
So I'm sure everybody still continues to ask you about the other big issue of the day, which is, the stablecoin digital asset. Oh yes, it's your favorite topic.
Still trying.
Yeah, like you didn't think I wasn't going to ask you. All right, so it's been at least over a year since you had, I guess, the EO reports, but not about AI, but this was about the digital assets work. Were published, the PwC report, and you've really taken a leadership role in kind of thinking through both the stablecoin and CBDC issues. I'll just sort of break them into one of two, so we have a little bit of time. From a CBDC standpoint, have you learned or thought about, or as your thinking sort of evolved a little bit about CBDCs? You talk about internationally, a lot of your counterparts and others are kind of vocal on that issue.
Right. So I think innovation, the whole theme of financial innovation and payments is, that's just an active area. So whether it's 2 years ago or this year or, coming, I don't think this is an area we'll stay active in. I think broadly, our approach to that has been the same. What need is it filling, this new technology? Can we govern it? Can we manage the risks? So I think for the CBDC, and this is more a central bank, not Treasury decision. It's a liability of the central bank, so it'll be their decision to make whether they would want to issue it. I think there's been interest within the global central bank world of wholesale, how it meets the needs for better, more efficient settlements. And there feels like there's a need there, and I think there's a lot of experimentation going on in terms of across banks, central banks, in how to do this. And I think that's being involved in the design and experimentation and setting up the standards and requirements seems like a good place to be. The report that we wrote 2 years ago on stablecoins was about if the private sector wants to create a payment mechanism, this is what the regulatory framework should look like. It is payments, so my view is that should be within the federal regulatory system. And it should make sure that if it offers $1, it should be able to be redeemed at $1. And so there's a set of regulations we would propose, and we still very strongly encourage legislation on this. We think that there is a gap in this case. But more broadly speaking, like this whole technology, the crypto technology, it's hard to say. I don't know where you are on this these days, like what the future of unbacked crypto or even stable coins is in the future system. But the distributed ledger technology and the shared ledgers, the potential for that to bring efficiencies to payment and settlement seem pretty like high potential. And I think that's an area we want to be thinking about how to, promote, allow for the benefits of that, allow private sector to innovate there, and still manage the risks of such an important function for the economy, right? So that's where we've been on that.
So I'd ask Michael a pretty funny sort of question, because one of his answers to I thought it was going to be a very regulatory, I'm a lawyer question, was a very FOMC-y answer and response dealing about with the speed of the economy, GDP growth, and I made the sort of joke. I said, "Wow, you sound more like you're voting right now than you are sort of the regulating financial market." You got to kick out that too. And Treasury sits at a very interesting kind of place too, right? And you have everything from technology, CBDCs, stable coins, to interest rates and debt ceiling, or at least what does it mean for the economy. That question of innovation and sort of how you tackle innovation in light of things like larger macroeconomic trends, does that put more pressure to, for lack of a word, be vigilant because of the uncertainty in the macroeconomy? Like, how much of what happens in the world macroeconomically sort of seeps into how you view the regulatory strategy?
It's a great question. So a lot of the innovations and financial innovations, technology, go beyond the implications for the financial sector. I mean, we're coming at this conversation from the financial regulatory side. At Treasury, and thinking about payments or CBDC or those kinds of, like that as an example, there's also strong considerations for the U.S. as a global financial leader, for the U.S. as the home of the strongest, most efficient capital markets, for national security reasons, for illicit finance, which I raised myself, but I don't really want to get into. But it's there's lots of. I know you can have somebody else get it. But there's, from Treasury's point of view, it is a broader mandate, to consider some of these particular financial innovation. And we, when something like payment systems where work with the Fed has the responsibilities again for the payment system, or if it's a large bank, or how it can facilitate credit. And the banking system also care about how it facilitates credit, but may have national security implications, the role of the dollar system, the role of the U.S. as a global financial leader. And so there's a broader set of considerations it brings to the table.
Very, very cool. Okay, so last question for you. When you look forward, any hint as to either your top priorities or something that you find really interesting that you're aware of in terms of what the kinds of things that you may be thinking about in the next year or so?
Oh, there's
in between the next FinTech Week.
There's a lot of issues that we're facing, right now. So I think financial innovation is one of the more exciting parts of the agenda. Very rapid. It has the potential to bring a lot of efficiencies and innovation and keep the U.S. leader. So I do think it's important for us to set up the frameworks to allow for that to allow and new entrants and keep our systems competitive. So that would be in the AI space, but the distributed ledger and tokenization, securities markets, where you issue and settle in a market. I think that has potential. Other areas for the financial regulators, this gets into the macro space that Treasury is very much interested in, is we're in a big transition period of loose financial conditions, inflation, so you tighten interest rates. And so all the financial sector is adjusting to a new environment of higher interest rates. We see little episodes flare up here and there, but in general, the banking sector has done well. We had some bank failures, and we'll learn from that. Yeah. But the fact that this core of the banking sector was so strong, it allowed that to kind of be without a lot of spillover. And that's sort of what you would aim for. So.
Well, thank you much, Undersecretary. It was, again, even coming across town, trust me, for these kinds of people, they're very, 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 very good. And thank you so very, very much.
Thank you, Chris.
Thank you. Okay. So we are going to continue into this conversation and getting even more, how do we regulate AI, with Adrian Harris, who is the superintendent of the Department of, and a friend, a very close friend for years. Adrian, could you please come on up? It is a pleasure seeing you, and this is, not just on a professional matter, but we since law school, and to see you in it's a long time, but in the leadership, it is just a pleasure. I think knowing you and all that you've done, maybe it's useful, just to put into context for the audience a bit about sort of your journey. You've now been in the job for about 2 years?
A little over 2 years.
A little over 2 years now, right? Okay, put in context for a Washington, D.C. crowd, sort of like the role of the states, what you've learned and what you've seen up over at DFS.
Well, it all started when Chris used to give me his outlines in law school. Worked really well.
Clearly. Great notes.
So, JD MBA, started my career at Sullivan and Cromwell in New York, spent some time in the Treasury Department working for Sarah Raskin administration, and then as a special assistant to the president at NEC, managing the financial services portfolio. So back to the private sector. During my time in the White House, I stood up an interagency task force on fintech. I stood up a task force on distributed ledger technology. And so when the administration ended, I thought, wow, I should maybe put my money where one thing to talk about regulating a space, but you should also spend some time in this. So I went to Silicon Valley, founded an insurtech company that we then grew and thought, I'm going to be done with public service now. And surprise! But then Governor Hochul about this role, and I just thought, how can I say no? DFS is the best of all worlds when it being a regulator. So just for those who don't know, we regulate, of course, all the state chartered banking institutions in New York, small ones to 17 G-SIBs, 120 international banks. We regulate insurance, about insurance companies, life, property, and casualty, and health. We're the only regulator in the country with digital assets, the only prudential regulator with digital asset specific authority. We regulate debt collectors, pharmacy benefit managers, mortgage, right? You name it, it falls under DFS's purview. And one of the most amazing things is, as you noted, right, it's obviously a state regulator, so we deal with these hyper-local constituents. I make the team go to the state fair every year and eat fried things and talk to people, so we are really on the ground and at that grassroots. But because it's New York and because 120 foreign institutions and 17 GSIBs, and we're the group-wide supervisor for AIG and MetLife worldwide, so global. So I spend time in the UAE, I spend time in Europe, right? And so it is really the best of all worlds, and you get to see that between insurance and cybersecurity and climate and housing, and there just isn't another regulator like that.
Yeah. It's such a unique and important and critical role, and you know, not to be too much, you know, I'm just talking it, but like, you know, the nature of the federal authorities to states and to New York in particular, as you know, gives your suite of responsibilities, you know, enormous importance, and sort of silos over the federal level, but federal, and then the horizontal nature of DFS over New York. You know, I think it's just, for the crowd, it's very, very to kind of understand where all that sort of fits in. Yeah. So without further ado, you know, about AI, you know, we've talked. You know, in our AI sort of centered day, for someone with so much depth and reach, you know, how is DFS approaching the question of AI?
Yeah, it's complicated, right? Anytime we AI, like the cyber regs, we just finalized our amended cyber regs last week. We have to make sure it fits across all the same is true for AI, right? We can look at AI in insurance, and we can look at AI in banking, but we also have all these silos. And what does AI mean for cyber security and for digital assets? Both, of course, as the regulator, we're doing some stuff with insurance now, so you'll see soon from us insurance underwriting across all lines of insurance, and AI and the guardrails that we're putting in place there. Use it internally. I think the other cool thing about this job is it's so operational, right? I think it's hard to find another regulator that cyber rule that's going to have impact globally. But then I also, right, when we have, you know, I manage the leases of the office space, and like when we get new carpet and all these other things, and that also means that how are we using it ourselves? So we're in the midst now of we have a guy stood up a climate division at DFS, where we're looking at weather data from SUNY Albany, with homeowners insurance data, and then looking at redlining data in the mortgage and overlaying this, because we know for LMI populations and communities of color are disproportionately impacted by climate change, by redlining in the mortgage space. When you start to put all that data on top of itself and ask really interesting questions. What is AI going to be able to do? How we can better regulate insurance and mortgage and when we can use that. And then there are like the really now preparing to roll out a chatbot for our website, right? It's got so many regulations, so much regulatory guidance on it. Is the consumer experience, and I've gotten to play with it a little bit, which is so much fun. Go ask plain language questions as a consumer and have that spit back out the answer to you, to dig through pages and pages of regulations or regulatory guidance. So it really is for us both how you regulate, just as importantly, how we as a supervisor use it.
So fascinating, right? You know, sort of thinking, okay, which makes complete sense, but that's a tricky job, you know, like how does it apply to insurance versus a bank versus another financial services provider? The undersecretary was sort of here talking about, you know, whether or not, or, you know, we're in a different phase of sort of innovation and having established categories. And we take that direction in a slightly different direction. I mean, when you look at AI and to your earlier comment, I mean, at the forefront when it comes to digital assets, particularly under your leadership, the risk reward or the trade-offs or just I guess the risks and very different technologies. Any interesting observations you have there?
Yeah, I mean, I think it's the right question, right, to compare this, because we have been regulating virtual assets since 2015 and done a lot more in the last 2 years. But how do you regulate a technology that's so new, relatively speaking, where we don't know going, right? So you don't necessarily want to front run too much on the innovation, but you want to be close enough to it in putting up guardrails. But I think it's also important, right? We think a lot about the risks, and that's very important. Opportunities that are there too, and how do you regulate with that in mind? Not just what don't we want to happen, but what do we want? We help steer an industry that way through our regulatory guardrails. And I think too, lots of similarities in when you think about blockchain or distributed ledger technology and artificial intelligence. What's our market facing? What's back office? What is, how is the institution using it? It's using it through a vendor, right? So there are all these different vectors to get at and think about how you regulate them that I think are similar about distributed ledger technology and AI. And then, of course, there's the overlap between the two. So,
I mean, in my little decentralization sort of course, theme of decentralization across all different kinds of technologies. Some of them are probably watching you right now. When you think through the scope of your responsibilities and this kind of risk-reward trade-off, you tackle a lot of different kinds of, in part because of that horizontal nature of the DFS obligations. I wrote once something that comes out as whether or not financial inclusion would ever be included in a regulatory agency. How would that change that risk-reward trade-off? So we saw earlier C.K. Bailard here, who is his own bank, his own sort of digital bank, and how do you attack the communities there? Economic development, which is pretty, it's akin to sort of, right? It's in your, it's under your mandate. Like this is like a fate, and then therefore I asked what would happen if it was in other agencies, but it is part of yours.
Yes.
Like how does that come out? Technology? Is it even important that it's an actual explicit part of your mandate?
I definitely think so. I think it really helps us do our jobs to keep that in mind, especially as too often we think you can protect consumers and markets or you can build a robust. And I've never felt like those things were mutually exclusive. In fact, they should be mutually enforcing. So for me, to have an organization where both the consumer and market protection and the economic development are both part of the mandate, it is a great thesis that you can and should do both, and that they are mutually reinforcing. So when it comes to how do you develop it safely and within the guardrails, right? But you want that innovation in New York, not under my supervision, because we are nimble and we are leading in cyber and digital assets and now AI. So I the eyes on it. But I want New York then, as it has been with digital assets, with cybersecurity, to be that lead. We're nimble, we're on the ground, not just in the financial capital, but increasingly the tech capital of the country, happening in New York in real time. And we can move quickly to put the guardrails in place, but we're right there. I think now a lot in insurance as well. As we think about property and casualty insurance, and I'm sure folks all worry about California and Florida and what's happening there, right? Bad for consumers, bad for the market, bad all around. So, but we know in New York, right, we want insurance for property and casualty to be inaccessible. And the way you do that is by having a number of players competing in healthy, thriving insurance companies. So it doesn't make sense to hold the rates artificially low and to pad them, right? You have to find that balance, and it's the same with technology, right? You have to find that, because those ideals are mutually reinforcing and not opposed to one another.
Yeah, I have to say that I've always thought of, and again, I really tried to, and to the extent to which you have a mandate to actually think about financial inclusion means, when you're listing your different kinds of trade, actually think about, okay, if I'm doing something in this particular space, does this act when it comes to actually the same people whose welfare I'm presumably trying to advance?
Well, and it's the operationalizing part of it too, and being in a nimble state agency. We did guidance when I first came in, banking in New York. New York has a law in the books that says our state chartered institutions have to provide low fee, which is great. We looked at the bank-on certified accounts and the basic banking requirements in New York and found that we did guidance that said, if you get bank-on certified, that will satisfy your basic banking requirement in New York. It banks to comply, and it meant that there were more affordable accounts available to New York. In fact, we saw institutions, as a result of that guidance, become bank-on certified, but they took it another step and said, and this is not the way regulators typically think, but then we wrote a letter to banks and said, and you have to train your frontline staff on to customers when they come in, right? This is not about the safety and soundness of the bank. It's not about consumer. It's just think about the human experience when they're, in any cases, still walking into an institution. Frontline staff has to be trained to tell people that this is available. And because we live in a digital age, we said, we started going through the websites and counting clicks. How long does it take us to affordable account? Right, if I have to click more than 3 times, this is a problem. And so we said, visible to people, it needs to be on the home page, right? Or it can't be more than a click. So I think this is the other advantage of being on the ground and really taking that consumer center to things.
Well, another area where you've been has to do digital assets, right? And really active in promoting really very clear sort of maybe you can just sort of walk us through where you are.
Yeah, absolutely. So as I said, we're the only prudential regulator in the country with virtual asset specific authority. We have built a team in my time of over 60 professionals. So as far as I know, it's the largest unit anywhere. We have all the tools. So we have very, very robust framework, thing we call the BIT license, and also through our limited purpose trust charter. We have examination and of course, enforcement authorities, and we've brought some of the largest enforcement cases under my time. But I think the key here is we've got rules on the books that are transparent, so people understand what's expected of them. We've issued 8 pieces of guidance. But if you step back and say, what does regulation in crypto or digital stable coins, because we regulate that as well, you would say financial crimes or BSA, AML requirements. Well, the same requirements we impose on our banks are imposed on our crypto companies. Cybersecurity, the same cybersecurity requirements that apply to our banks and insurance companies apply to our crypto regulated. We have the most conservative capitalization requirements, a very formula. We don't allow rehypothecation, we don't allow lending rate, all of these things. In fact, only state or maybe one of 2 states where FTX was not allowed business because they didn't meet our license. So it's really proven to be a very robust framework. And the undersecretary mentioned, right, have a dollar stablecoin, you should be able to get $1 back. We require $1 in reserves and that's been issued. We require T+2 redemption time. We require cash and cash equivalents as the reserve and those consumers. So it really is the model, but I will say we're eager to have a federal partner as well. So we are eager for that day to come, as I know the Undersecretary is.
Just a little highlight over that. I mean, so because you had, you actually have the dispensation to be a currency regulator. I mean, you've done so much. How much, I guess, gets back to the financial inclusion or the economic development mandate in your part. The regulator in charge of an agency, how important is it as opposed to sort of operating with less as to your authority?
Yeah, it's such an important question because I think there's this more, right, like if you have economic, lower the standards so people come to your state. It's just not what the facts show. Everybody was complaining about how it was overly rigorous and overly, New York is the worst place ever. And then we had, Chris, are really smart. You really got this right. And I was like, yeah, maybe so. But even with this and onerous standards anywhere in the country, we see that in 2021, for instance, half of investment companies was in New York companies, right? And continued into 2022. So this idea that lower the regulatory standards in order to attract business just has not been our experience. To the contrary, the transparent engagement with industry, right, and staying abreast of just proposed new coin listing guidance, we revised our standards, all of these things have just drawn the principal actors to come to New York. And look, when rigorous rules, you bring enforcement actions. We brought $100 million against. We brought $30 million against Rob, that tool as well.
So I guess then sort of link, double clicking on the conversation about, is there anything, when you think about these kinds of issues, whether or not be crypto assets, is there skill sets or perspectives that the states are bringing to that question as compared to the federal government?
It's such a wonderful partnership that we enjoy. As you know, I now am the FSOC. I spend a lot of time here engaged in the federal regulators. And I think that's true for many of my state counterparts. I do think, though, having now done, there is something unique about being at that state level and really seeing how the rubber road, especially with consumers, but even for institutions. When you have the diversity of institutions that I have under my program, you can go to the state fair and eat fried pickles and talk to people about how they experience changes. It's actually really important. But when you can get that perspective, I think it really informs not rules, right, but how you operationalize them. And you think much more about the consumer because they are right there. We just, in the last 2 years since I've been there, $77 million in restitution, not penalties, restitution, so money back to New Yorkers as a result of 100,000 complaints. So then you can look at the data and So, and there's a nimbleness at the state level where you can just respond much more quickly to individuals, but also in cyber, in crypto, in climate, and I think that's a real advantage too. And then when we can start learning, talk to hear what they're seeing and doing on a national and global level, right? That exchange is so important.
So you've been a New Yorker. You've lived out Valley.
Yeah. DC.
DC. So you've been to, I guess, all the sort of innovation and with really deep experience. When you think about a person or an innovator or something, it's fascinating. Depending on what perspective they're bringing to it. But you've been worn lots of different hats. So what kind of advice Regulatory or otherwise, would you sort of give someone like CK or others really starting to build innovative businesses?
So I always give the same piece of advice for all regulated entities, but I think especially for startups, don't ever surprise your regulator. We really don't like surprise. And my general rule of thumb is about it before I hear about it from you, starting in a bad place. And you laugh, but it happens a lot, right? And then we have to call people and say, like, why are we reading this and we didn't hear about it? So err on sort of over-disclosing or just coming to your regulator and talking about what you want to do. I know that's not industry muscle memory, but it really is helpful. The other thing I found really interesting about my time West is at the time, I think this has changed, has matured, but at the time there was a real sort of disdain for X. It was like, we're disrupting, so like we don't need to know about the thing. And I was like, well, okay, one approach, right? But if you're going to disrupt the thing, you should know about the thing. And so, right, I'd be afraid, I think, to incorporate the stodgy lawyer, the former regulator now gone private sector into your thing. Come to your regulator to say, here's what we're trying to accomplish. I think you'd be surprised how often this is your objectives are aligned with ours, and then we can work together to get there. Where they're not, in general, right? I think having those conversations early and often is the best piece of advice to give.
Another regulator, we were having a conversation at a panel, and he had said something very, very similar. And his piece of advice was, first time I ever hear about you, and you're in the middle of a crisis, it's probably not the impression you're going to make.
Exactly.
That was.
But it's true for life, right? You the relationship really before you need the relationship.
Exactly. Yeah. Who would have known that when helping out with notes?
With outlines. I'm getting lost.
It's like conference. Thank you very much, Superintendent. I appreciate it.
See you.
All right. So with that, I'm going to go next super panel. And I'm proud of the super. With that, I'm going to introduce Felipe, Williams, Caitlin, Josh, and Ben all to the stage. This is going to be good. And we'll be talking about the future of
Good afternoon, everyone. I'm excited to be here moderating this panel on the future of. I do want to give a shout out to Chris, who's done a phenomenal job. I've had a little bit of a behind the scenes. Chris. This eclectic individuals here is all Chris's brainchild. So
We're really friends of Chris, that's what he means. So we are panels, yes.
Exactly. So it should be a really extremely diverse set of participants here. Maybe, and you saw the outlines, everyone. Elena McWilliams of Cravath, former chairman of the DC. We have Caitlin Long, who is the Sodia Bank. Ben Miller, CEO of Fundrise, and Secretary for Financial Markets, Josh Frost here. So maybe I'm going to start, Caitlin, with you. We've obviously talking a lot about technology here today, maybe taking a technology and really getting a sense of what you see as the future, given your perch and kind of what you're doing with Echo. Specifically, when it comes to debt sustainability, what are some thoughts you have?
Well, if you take a third view of the financial system and look at the history of why money evolved debt itself to data being able to settle at the speed of light, basically for the last 150 years, created intercontinental telecommunication systems, but money was, and so it had to settle at the, and what ended up happening was the financial system created all these abstractions for that. Data could move fast, money could not. And as a result, the financial itself and money, which was at the time, of course, physical, i.e. gold, evolved to be debt in and of it. Now that we have the technology to move money at the speed of light and match the speed of a transaction with the money leg of a transaction, specifically what I'm alluding to is stablecoins, we don't need all that debt anymore. Is I just looked today at Tether, for like it or not, the stablecoin that trades the most. All I'm looking at is the technology when I make this point. It's M1 velocity today down to 150 times, but at various points it's been a time. So the average Tether has traded today. Right now it's 150 times, so it's less than 1 time a day, but the velocity of the US is 1.5. We don't need all that leverage to create transaction velocity. The exact same can transfer without adding all that debt.
Very interesting. And actually, Caitlin, one with you. I know maybe you can share a little bit actually about Custodia Bank, and then I know there was maybe an announcement you wanted to share as well.
We're a state chartered bank that was designed to bring that ecosystem into the traditional financial system without either side causing problems for the other, and it all does come down to this match where we get to the point where we can actually bring the trade and the settlement together. So that our Bitcoin custody platform has been live a couple weeks ago.
Congratulations. Elena, maybe I'll turn to you and talk a little bit about kind of debt instrument in your new role. What are you seeing really across all? We're having a discussion of what debt we're referring to here, but however you want, in terms of the debt instruments that are being put today, and what are you seeing kind of from your perch over at Cravath?
Yeah, so when I think of kind of 3 tranches of that state's debt, which I used to worry very much so when I was state senate. I would like to say I don't want to do. And we're seeing all kinds of the yields with the U.S. Treasuries and some of them. Things that I think you're probably better of talking about. So the next, the corporate debt. This is where we look at kind of the demands that some of the large corporates are issuing, leverage lending terms. We're looking at syndicated lending. We're looking at the private credit, and we're change frankly in the terms and the tightening of the credits on the corporates as well. Last tranche that when we talk about what's happening in the debt market is the consumer, and what we're seeing, this is the secured and non-secured credit to people who don't have funding, and what we're seeing there is that the terms and the conditions are now pay later on the small dollar loans, on even the mortgages. I mean, I think we're 8% lend in terms of the APRs on these mortgages. We're quite a bit of the credit tightening. So what I would say we're seeing is that whether because of the economic conditions or the economic conditions down the road, the credit terms are tightening on just about that issue. And, I would say from the United States government needing to be a little bit more generous than in the past to attract the buyer, the larger, basically saying, maybe now is not the time to go on very risky investments to the consumer credit, which is frankly going to be very dire for low-income communities that have established credit histories.
I love the changes and the way you're thinking about it. Ben, maybe if you maybe want to share a little bit about it, but you're deeply entrenched in the real estate market yourself. Obviously, specifically real estate, something getting attention these days. What are the changes to the economy, maybe specifically interest rates and other things that you're seeing mean for in the commercial real estate market overall?
Okay, yeah, so we have a couple million investors, and we buy finance
in the billions, so I have a pretty good sense of what's happening in capital markets, and I want to sort of dove sides of it are on the banking side. If I go into a bank today, and we say we want $100 million, well, you have to obviously put down 50% equity. We also need to put down 20 to 30%. So you have to basically put it down 2 down payments essentially to get a loan today. That gives you a sense of how the lending environment is, and that's basically because of liquidity. It's not a credit constraint. That's a liquidity constraint on the bank. And then in October, when Treasury yields were in the 5s, essentially at least commercial shut down. Yeah. I mean, it absolutely was dead. It was like 2008. I mean, there was a moment where the year in the market was like, and I'll give you an example. We took a $100 million property to market. In August, we had 20 offers and 0 offers by October. That is highly unusual in my 20-plus year career. I've never seen 2008. So I think that there's a lot of stress on the market. It's extremely tight environment.
If I can maybe just key off of that, and I think part of some of it is real. Some of it is real economic concerns, real tightening of market conditions, business layoffs, et cetera, that translates into the eligibility to borrow. But some of it is also about perception. And what you have with, the bank failures that have happened over the last, 7, 8 months, the market confidence being undermined, both from the consumer, from the depositor, from the investor, and from the market participant. Some of it is real, some of it is a matter of perception, but that perception could be almost as tangible the real, because in the end, it's a self-fulfilling prophecy. And I think partly we're, I would say, a seesaw between.
Yeah, the idea of the perception and then the reality, and how even the perception causes a very real as well. Josh, let me turn to you, and obviously, Elena talked about one of her tranches being the government debt. You on that, there's a lot of talk about kind of the debt ceiling negotiations and some of the volatility in the bond markets, as we've talked about. What are some of the, what do you see, what are your comments from your perspective, and what are you think this audience?
Sure. Thanks for having me. I saw the talk of the panel, the future of debt. But can you even more? And I thought, no, the answer is probably not. Look, if I take a step back and think about the U.S. Treasury, and recent moves in yields notwithstanding, by a wide margin, remains the deepest and most liquid market in the world. Is the issuer endeavor to keep that and recognize that that's not even. And so we undertake this to enable that. So what do? We try to fund the government at the lowest cost over time. And one of the key mechanisms we have seen as a regular and predictable issuer. We want to be, we don't want a premium being built into Treasury security. It relates to our issuance patterns. And that's just been a long-standing cornerstone of what we do. As we make our issuance decisions, we have a wide range of people in the market. We talk to buy side, sell side. We have a bar committee that meets with us every quarter to give us specific advice on how to fund the government that quarter and on a longer term. A few times already we've referred to an increase in yields. I'd say a lot of that is on the back of an improved economic outlook, but also, it's our market. So we keep a pretty close eye on the trend at all times. I think one thing that I found quite comforting over the past few months is how orderly trading conditions have been in the. Oftentimes when there's an event that causes a volatility shock, you can see liquidity decline proportionally. What we've seen here is Treasury market liquidity remain up the last few months.
That's fantastic. Pivot a little bit. We're obviously here at a financial technology conference side. Ben, I'll pull you in to talk about, as a CEO of a large organization now, how is technology changing what you think of as debt? And, the business is really transforming this overall with Fundrise. Is there something about that as an instrument or the investment that is changing overall from your perspective?
Well, so I found Fundrise after the 2008 financial crisis because I sort of lost confidence in a lot of financial institutions at the time. And my theory then is that, and remains, is that essentially debt is intermediation. Financial intermediation, you're intermediating time essentially with debt in the future. And we built a financial system around certain assumptions around how information, but essentially debt is a data problem. And we're like every tech company, we're hacked using some of the AI, some of the GPTs that have been created, and there's no question that AI is going to become the intermediary of finance, and that's going to be highly disruptive to the banking sector. Regulate it, and they'll want to start to basically slow it down or own it. But it's most about analyzing information and making a decision, and I think AI is going to be at the minimum. It's going to lower the amount of people needed in banking, but it's evolution underway, and that's I think mostly a good thing, but certainly could be just for the sector.
Absolutely. Can you maybe elaborate? You mentioned a little bit. You think AI will intermediate. You mentioned kind of maybe less people. Can you elaborate a little bit on that? What that might look like?
I mean, it depends on the asset to get specific, but you could look at a consumer. Imagine any 25-year-old saying, you can have 100% of my transaction data, everything about me, and you basically that you can actually talk to my personal AI in order to figure out how to price my debt in order to make sure I'm a good party. Same thing with real estate. You can have basically near perfect knowledge about the real estate asset and their fidelity around the data in an asset. Basically, a human can't even use it. Is that as the AI gets to mastery around something, it wants to be AI doesn't want to be AI talking to a person. And so that's going to be a radical change time that'll happen all at once. And that's probably the other end of this next cycle. I mean, it's at least, but it's you can see the technological capabilities. It's just a question of like finding in all of the know-how have about how to actually make it do the right thing.
Caitlin, maybe I'll ask you to jump in. I know you talked a lot about that comment about this idea of debt being this area, and maybe what Ben is alluding to, maybe AI is.
Well, it's an abstraction, but it creates a fundamental instability in the. If we can get the monetary velocity that we need through technology, as opposed to through leverage up with a far more stable financial system, which I think is everybody's goal. But in the past, because of all action, we had to create debt instruments in order to do that. But I think at the end of the day, technologies for data like AI become implemented, that puts even more pressure on the need to have a programmable dollar, and it doesn't exist except in stablecoins. And therein lies the clash, right? But this has been that's been in place for more than a century, where we've been able to move data, even in simple data structures, at the speed of light for a century or more, but we haven't been able to move money as quickly. And so in order to reach the true opportunity from what is AI is just the next level of big data, right? In order to realize opportunity, you've got to be able to move the money and be able to program it and be able to settle it at fast. The whole idea that our securities markets still require 2 days to settle a transaction, that is what a technologist would call tech debt. It's just the debt that came from the market structure because we couldn't move the paper fast enough. All that is going to go away, but we need a programmable dollar in order to be able.
Maybe switching a bit, sticking with you, Caitlin, a bit and talk about the high interest rate environment. We alluded to it a lot. from your perspective, who do you think is winning with the higher interest rates? What are your with higher rates?
I hate to say this, but it's rich people who own treasuries. And what's so fascinating is that corporates that are sitting on these big cash piles have become the new banks. It used to be that the old joke was 3-6, borrow at 3, lend at 6, and you're on the golf course by 3. But now it's the corporate because they locked in long-term rates when rates were low. Corporate treasurers were extremely effective at yield curve. They're sitting on cash piles earning 5% risk-free, and they're on the golf course by 3, right? So I hate to say, and this is a real problem for monetary policy as well, because we were in such a low interest rate environment for so long that the yield did impact monetary policy. But when you look at liquidity, you have to factor that in because the yield is very meaningful. A lot of large corporates are just raking it in right now. They're earning more from their financing cash than from their operating cash flows right now. You see it in the big businesses, and that's the reason why the stock market hasn't corrected as you would have expected given how interest rates have gone up. Real estate absolutely has, but not the large corporates. The big keep getting bigger. It's unfortunately a subsidy to the rich.
Josh, let me put you in, not necessarily, but from your perspective, what do you see in the higher interest rate environment or some of the uncertainty around debt? What perspective do you have?
I guess I'll start with an obvious point that in a rising rate environment, the people who have floating rate debt are going to be worse off than the people who, it relates to your question, what the corporate treasurers did in 2020 and 2021. Side, I think if you look at most consumers, most corporates, they've got fixed rate debt out there. I think I think about where pocket floating rate debt are out there. I think particular concentrations probably in commercial, maybe with a particular focus in office and leveraged loans. I think even though, if I look at the mortgage market as an example, there's a lot of ink spilled about the headline mortgage rate being % right now. The average American mortgage holder with a loan out there, I think the weighted average is something like 3.5. So it's going to take some time for the higher rate environment to start to bind on. I'd also just maybe quick step back. If I think about what's going on in the secondary market, the primary market for corporate debt, despite the reasonably large increase in risk-free and risky rates that we've seen a few quarters, markets are open. The primary market remains open. Secondary markets remain, liquidity seems fine. So I guess stay tuned, but things seem pretty good right now.
Yeah.
Secondary market.
I know we were joking around in the back if a lot of the folks in this room that are helping orchestrate the soft landing, saying we should get trophies and hand them out, make sure everyone gets T-shirts and celebrates. I think it'd be a phenomenal achievement. Let me. You had a super interesting perspective having run the FDIC and seeing this kind of all the. From your perspective, the chair you used to sit in, what's your perspective on where the risk is popping up, where the macro is, and maybe specifically what that means for community and regional banks that you used to oversee?
Yeah, so I think that we're going to experience a little bit of a shift. And when you really think about it, I've never known anything but the good time. So they came out into the banking space, in 2008. And so for them, it's been just up, 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 up. And I think those bankers are going to have a rude awakening, a few quarters. Where I do think that the banking conditions are going to change, taking state, what is happening with the vacancies in the real estate downtown, much A properties with B and C properties, mainly C, and then I think you'll probably see the movement of the tenants over the next few quarters from C to B, from B to A, and I'm not sure where the A go. But I think we're going to see some tightening of the credit conditions in general, and I think that's going to impact the bank's bottom line. I think the treasurers that banks are going to have to become managing the balance sheets. To your point, it's been complicated. If you lock, that's great, but they do mature. And so when that happens, what do you do? You know, what do you go to? I know that if you're lucky enough, you know, somebody managing your finances, people call from time to time and say, oh, you know, you should move your money here. And you're like, why? So because I think that people in the know, and to your point, the people who have the money are going to be able to manage this in a way that optimizes their line. Where I'm really concerned is with people who live paycheck to paycheck. You know, I think everybody has that Federal Reserve study from several years ago that said, you know, most people, something like 60% of Americans don't have $400 an emergency. And for those people, the change in the interest rate is huge if they're borrowing. And so for a lot of them, what you're seeing is that, you know, the credit cards are tightening their interest rate, the APRs on revolving debt as well as the unsecured debt. I think it's getting difficult to find a car to buy. Remember, we had like a supply chain shortage and all of that, and the interest rates were super low. Now you can actually find, but financing that vehicle has become by far more expensive. So it's really for people who live paycheck to paycheck, people who economy, and I think that for them, this is going to be a pretty seismic shift.
I think you're absolutely right. And what other impacts maybe do you see coming from that rising debt? I mean, in 93, we saw some bank consolidation. Do you see any of that happening from your perspective?
Well, I would say just like open up the newspapers for, you know, a few months, and you will see that the you know, the rising interest rate environment has really caused. I'm going to be careful how I phrase this. Caused a lot of commotion for the bank. When you think about it, I don't think that you had a single banker. Well, maybe there are some through 13, 14 consecutive federal funds rate increases consecutive. And so I think that was such a shock to a lot of people managing the Treasury market, the Treasuries, I don't mean the U.S. Treasuries, but the Treasury market for these banks, that they really had to kind of have a and so I do think that the interest rate environment is going to reshuffle where we are in banks. I do think they're not going to be able to manage that appropriately, and we'll just have how the economy fares them to stay afloat.
The last time we had a rising rate environment like this, it cut the number of in half, the consolidation in the early 1990s, where we had all the consecutive interest rate rises. Yeah. We'll see if that happens again.
So we'll see if the legislation and regulation follows this. You know, I always say legislation is always, regulation is even further behind. And so we always try to solve the last crisis. And, you know, ranking crises actually are alike. They may look alike, they may have some of the common criteria and shared care alike. So I do think we always are behind in our regulatory framework where we need to be.
Well, unfortunately, I have to leave it. Fantastic discussion. Our panelists will be around if you want to catch us after here. But with that, I invite Chris back to share a few words before. Actually, sorry, let's go ahead and get done, and I'll invite Chris to come back on.
Thank you so much, guys. I am just going to do the last for our very last panel of Emily Wilkins and Wiley Nickel, congressmen, to really talk about what's going to come up next when it comes to financial technology and Congress. Congressman French Hill could not make it of a markup, but we did really want to get the perspective of Wiley, particularly he's on the House Financial, and is one of those rare individuals who is very often engaged in with, frankly, the aisle. And this is one of those issues that makes that interesting in terms of an experience. So I guess I will both onto the stage. Thanks.
Right. Hello, everyone. Well, we're a little bummed that French, but as he's actually doing work, I guess, you know, it'll be fun. It'll be just a nice conversation.
Last night, and he knew there was a chance he wasn't going to make it, so he sends his apologies.
Well, we'll catch him to be chatting with you. I'll just give your bio real quick. So you are currently serving your firm from North Congressional District. You live with your wife, Caroline. You have 2 kids. You also earned your Bachelor of Arts in Political Science from Tulane University. And then you graduated from Pepperdine University School of Law. I don't know studying at that school. I visited once. It's absolutely gorgeous. I would just the window and be on the beach the entire time. So you must have been very law degree from there.
No, you can see the ocean from the library. It's a beautiful campus.
Oh my gosh. And so you're in the North Carolina. As a North Carolina state senator, you're an attorney, you've been a small business owner, and you've worked in administrations. And now you have been, I think, 10 months now, wonderful world of Congress.
And it's been a real adventure here in our first, in this Congress. You know, the positive stuff, but we just haven't done a lot. So that's really the place we are with this Congress is what can we get done? What can we in government? We can get things through the House and Senate and onto the president's desk. That's our job. And so far we haven't done much. Financial
services. I mean, how did you come to serve on that committee? Was it because they're like, oh, the guy with the last name Nickel, he'll do good on committee?
That was it. No. If I had a nickel for every time I heard that joke.
Sorry.
We've got Patrick McHenry, who was the temporary speaker, where he's the chairman of the House Financial Services Committee, also from North Carolina. So we thought that was important. You know, banking, Carolina, so we cover banking, Wall Street, housing. Great committee for North Carolina, and I fought to get on one of 2 from Democrats to get over. So it was a good one for.
It's the A-list committee. It's what everyone wants. It's the club. It's the in club. I know that you just said that Congress is not getting much done. So I'd like to kind of challenge you off of that. For a lot of the fintech groups, why should they pay attention to what happens in Congress? Why should they call their lawmaker? Why should they sort of be attentive to what you're doing? Often we see a lot of stalemate in Congress and not necessarily so much legislation.
I mean, I think for the people out here in legislation, you know, we certainly can pass bills. Everyone knows, you know, how you pass a bill through the House. I've seen that, you know. But really, there's that, and we're working on a number of bills that, but also, you know, our position with the administration, where you know we deal with regulators, we supervise, tell them what we think publicly and privately, and we have an outsized role in influencing how they do their job. So that's an important part of it. If you know you don't have a seat at the table, you're on the menu, and so if you don't make your voice, you don't advocate your issues. You know, you're going to see some real problems in Washington, and so that's my for everyone. Build those relationships. Congress for me is all about building relationships with Democrats, Republicans, but same for, you know, if you're trying to influence in Washington. Everybody here has a congressman. You've got 2 senators. You know, do your best to know what you think.
In which case, sorry.
Yep.
Same boat.
Anyone from DC?
Yeah.
We want to make sure you get to have a voice in Congress, in the House and Senate. So, DC statehood.
I wanted to ask a little bit. All right. Yeah. I love it.
Always a good applause line in DC.
I also wanted to ask, before we get into some of the details about the bills that the Financial Services Committee has moved along, I wanted to kind of take a minute and go to the 30,000-foot level. Obviously, there are issues when it comes to fintech, over-regulation, not enough regulation, consumer protection. And I'm wondering if there's one specific area honed in on as kind of one of the most important areas for Congress to legislate in.
The big stuff that we've done that I think, you know, could have far reflex is, you know, is our digital assets market structure bill and our stablecoin bill. Those are 2 things that I think are, you know, I was a bipartisan group in support of both. or what counts for being bipartisan, a decent amount of Democrats. And so those are places where I think we need to regulate. Love crypto, hate crypto. You should be in favor of regulation. I think matters for an industry that continues to go overseas because of the lack of regulation.
And talk to me a little bit, because I think a lot of people have heard something about these bills, given that it's crypto legislation. I think really the first significant crypto legislation that was able to begin to move through committee. We're waiting for it to come to the House floor. Huge question mark, I think, in the Senate. And of course, it's a clock with other priorities. But let's go back to a second about how the sausage got made there. Because so many go through the committee process, you see either all the Republicans vote yes and all the Democrats vote no, or vice versa. Every Democrat voted yes on those bills. You had, I think, 5 for one, 6 for the other. And so that kind of comes able to find that bipartisan ground.
There are the Republicans, so French Hill, who's the chairman of the subcommittee that handles digital assets, obviously isn't here, but was going to be, was a big part of that, Patrick McHenry too, and it was really a process how Congress has hundreds of hours going back and forth on these bills, doing things more Democratic support, we can move it out of committee with a bipartisan vote and then get a bipartisan on the floor of the House. Bills are supposed to be done. That's the way we're supposed to operate as a Congress, and in this case, always, but in this case, it was a real good example.
Did you get a sense for why? Because so often in the House, Republicans can control it, and, I'm trying to pick on Republicans, Democrats do this too, work with the other side to get legislation across the finish line. So when you were talking with French Hill, McHenry, what was your sense of sort of why they were bothering to include, no offense, freshman Democrat, big top-level conversations?
Everybody knows in Washington we have Democrats in control of the Senate, Republican majority in the House, and then the White House. And we can't get anything done unless you do it bipartisan way. So the stuff that's all one party, become law. And to their credit, the Republicans on this committee were focused on doing things that can way through the House and the Senate. Otherwise, it's just a waste of time. We can go messaging bills, which you see so much of, that are law. And that's been my frustration. I just try to focus on the stuff that we can actually do, and this was one of the more rare on doing that.
I know that the top Democrat on the Financial Services Committee, Maxine Waters, with Patrick McHenry for a while, particularly on the stablecoin bill, trying to come to some sort of agreement on that. Ultimately did not happen. Can you talk a little bit about why so many of your Democratic colleagues sit on the ultimately support those bills, and where do you kind of differ in your thinking from them?
I think we're close, and watched the debate on that. It was very loud, and it was very partisan. But I think we're really close. Just the day leading up to that vote in our. So I'm very optimistic that having what the big issue is state regulators and having a strong federal floor for stablecoin is we're not very far apart on that. So that's a place where as you continue to move through the sausage making process to become law, there will be changes that will be made that will get more support and help Maxine Waters.
So do you think, and have you been talking with Waters, have Democrats and Republicans on financial services continued to work since that bill's passed through? Can make it more bipartisan?
Well, I got to say, we did take a month off, and nothing happened during this drama and chaos and confusion. We just, we had a lot of things that we should have been, that just, and all that work stopped. So little gap, but hopefully we get back to moving bills, and then everyone starts paying attention, and you get, you that opportunity for collaboration.
And I'm wondering, might the bill that comes to the floor on digital assets or stablecoins, might that be different of committee? Should we expect to be seeing some changes, and if so, what?
I think both. I think stablecoin, say of what the sort of strong federal floor means. I think that's where we need to go. On the structure bill, I'm not sure what that what the issues are that are going to attract credit support. All you need a willingness to work across the aisle, and we have that on this one. So I think we'll see changes in the House, and then if we can get it through the Senate, you'll see changes there. There's in shape, wants the marijuana banking bill to move. You got to kind of horse here and there. So those are some deals being made.
Got it. And have you been in contact in the Senate side with chair senators over there about kind of what the lay of the land is once these bills clear the House?
I think we got to get it House first. Then we move on. We've moved some bills to House, and we're starting those. That push already. The accredited investor bill we talked about. That's I think one of those that we're working on in the Senate now.
Over there, the big push right now is Senator Elizabeth Warren's bill, trying to kind of prevent within the crypto industry. I know that there are some mixed feelings about that, but it is getting bipartisan support. Senators go ahead and sign on to that. I know our bill has yet to clear the Senate, and so I'm not going to touch on it, but I do want to say, in terms of just the sense of do you think that that's something that you would support, your colleagues support it, and could you see some of your Republican colleagues supporting it?
Yeah, I think everyone wants to get bad actors out of the system. How we do that is a question. So I think there's some good parts, there's some bad parts, all this stuff.
What are the good parts? What are the bad parts?
I mean, keeping sure that you can't use crypto to part of terrorist groups. That's a good. That everybody agrees that we need. But so much of this is covered by FTX. Just has been a real challenge because anytime you say crypto, that's kind of where a lot of my colleagues, and it's an education process where we got to talk about what actually is in the bill, how regulation helps protect. Mm-hmm. And that's the place where I think there's good progress to be made.
Do you think the bill would prevent another FTX?
I do. The bill for the digital asset market structure bill over and over in committee to our witnesses, our experts, and that was consensus is absolutely this is something that have a regulatory framework and structure in place. You're going to prevent things like that.
Got it. And I know that you mentioned that your own legislation that you have introduced, and we talked about it a little bit, but it's on accredited investors. Tell me a little bit about what that bill would do, what problem you're trying to solve for.
Yeah, trying to make sure we help startups. Anybody here getting money from accredited investors for your fintechs?
Over here? Yeah.
Essentially you got to have $1 million in the bank to be an accredited investor. That's the way you do it. We understand Gary Gensler wants to in. I think they're still trying to talk about what they do there. I represent a diverse district. In communities of color have access to private equities to make those investment choices for themselves. Startup community, really big in the triangle. So the bill would just allow anyone to be an accredited investor as long as you pass by FINRA. Understanding the risks of making those investments, I think that's something that is good for every startups, good for my district. It passed the House in a very bipartisan way with 383 votes. Now we've just got to get one of the few bills that can pass both chambers and should be signed into law.
And of course, we'll see. Once again, I feel like it's great. They're trying to fund the government, and then trying to fund the government after they fund the government. And so it's a figure out how to work within the current structure of things.
It's just such a low bar. I mean, all we're trying to do is fund the government big victory, which I think we should have higher expectations. So,
I wanted to ask you about sort of two big issues in fintech. Congress moved much on. I know that there's some individual members. One is the earned wage access and the now pay later. And I'm wondering if either of those are issues that are on your radar, things that you've heard of, if you kind of have a stand in terms of what Congress is thinking of.
Yeah, both things that I think are helpful for the folks that I represent. Earned wage EWA allows for more people to have access to control their. That's good. The innovation behind both, especially good. We want to continue to make sure that the fintechs that have the ability to continue innovating. We don't want to get in the way of that. So I think those are both good places.
What's next for the Financial Services Committee now that you guys, I know that there's still discussions being had on both stablecoin assets, but is there sort of a next big thing that the committee is starting to work on at this point? Yeah. Now that you guys have McHenry.
Good to be back as a committee with our chairman. I think the digital assets market structure bill to be the bigger things. Some of my Republican colleagues may talk about ESG a little bit more. I see that as a huge problem we need to solve. But maybe we'll hear some more of that. Jacob's in here. I'm trying to with the next big stuff. Maybe a little bit with housing, but we're and some national stuff talking about keeping money out of the hands of bad actors. There's some certainly bipartisan agreement on those issues. We're really just kind of focused on funding the government right now, so that we know that in just I think 10 days for the entire federal workforce.
And then cancel everyone's Thanksgiving, because that would be the next.
Oh, yeah.
Sorry, I'm thinking about this. My mom wants me home. And so I also wanted to ask, going back over to the Senate for a second here, Senator introduced his, this is the title, the Credit Card Competition Act. And basically that would allow, other than retailers, pay for those interchange fees that come when we ever swipe our credit card. And I know that, again, this is something that has stirred up a good bit of controversy within the industry, also has bipartisan support in the Senate. And so I'm wondering, from your perspective in the House, what are your thoughts on this type, and what is your sense for your colleagues' thoughts on it?
I think one thing that I've learned, it's my first year in Congress, is really good at doing nothing. So when you have people who want nothing to happen, we're good at that. I think that bill is very, very unlikely to see the light of day in the House. I don't support it. I think my constituents, they like their critics, and it would do away with those. So that's one that I think it's less likely that we will see any. Maybe people talk about it a lot. I know in the Senate they'll attach it to a lot of things, but I think it's that becomes law.
Hypothetically speaking, because so often these initiatives that we see, they come for the next and the next and the next and the next. Do you get a sense that a lot of your Democratic colleagues are interested in something like this, or do they have observations that you seem to have?
Yeah. I mean, it just hasn't been a huge topic of discussion in the House because the committee's controlled by. It's not a big issue there. But all the things we do, whenever you lobby a member of Congress on a bill, sponsor something, and write a letter, all of that sort of helps with the push in this current Congress and the next one and the next one. So a bill from the last Congress that kind of got close with a lot of co-sponsors, it has more heft in the next one.
Yeah, and it does seem that there is, I would say, between yourself and I'm thinking several other Democrats who sit on the committee also supported the stablecoin and digital assets, and a number of other Democrats who, oppose those issues and, are supporting some pieces of legislation that sounds like understand where's the divide within the Democratic Party when it comes to some of these fintech issues. How would you define it?
My colleagues on the left, they want to protect consumers. I think that's great. But, those of us in the center, we want innovation. We want to, help business. We want to cut red tape. So there, I'm in the place working hard, screaming loud to find that middle ground and that consensus on those issues to help, folks innovate, continue their businesses, and try to the government get out of the way as much as we can. I want to protect consumers too, but there's a good balance to be made, and that's the place where those of us in the middle try to focus our time and attention. I'm part of a group that's the Problem Solvers Caucus, another group, 32 Republicans, 32 Democrats. We meet every week and talk about bipartisan issues, so that is where we can be most helpful.
I also wanted to ask a bit, I hope you don't take offense to this. Congress has a bit of a reputation for when it comes to tech issues, when it comes to the next big thing, several steps behind. You've seen hearings where questions have been asked that seem pretty basic. A general kind of question when it comes to Congress regulating these issues, who's actually doing the regulating? And even Patrick McHenry at a hearing back in 2020 kind of say, how can we make sure that we understand regulating? And so I wanted to see if you can kind of take us inside the closed door meetings and whatnot. Do lawmakers really understand some of this rapidly developing technology? And if they don't, are they really understand it?
I mean, I think a lot of members are really great. They understand the issues. A lot of members have staff that are really great and understand. So, it's a challenge. We cover so much, and you just are really interested in learning more. And with most of these issues, if you educate people on an issue, they're going to be with you. But a lot, especially with fintech issues, to explain them to members, to understand, to make the connection, the people that we represent. There's some generational issues on some of these issues, some of the things we deal with that are tougher for colleagues to kind of deal with. Maybe the more younger colleagues are a little more, interested in some, and that helps a lot as we're trying to advance the ball.
Does that make it more difficult for Congress to regulate? And does that, I'm wondering, give towards, like the other the other agencies a little bit more power when it comes to forming the regulation of the industry?
Yeah, no, I again, see a lot for the regulators, and at any chance I get, I think Congress should be able to weigh in on these. It's our job, so I think it's important we try to reclaim that as much as we can, and but the regulators, the SEC, many others have an outsized influence.
That the regulators are currently doing.
I've been.
I know that's very broad.
Yeah, sure.
That covers many of them, but I know there are some high points, and also it seems some bipartisan concerns.
Yeah, I mean, we've made our concerns known publicly and privately for Gary Gensler's regulation by enforcement. I think the best way I can explain it, I've encouraged them to consider a little more stick. I think that would better serve the industry, and I hope that's where they get.
Can you say when you carrot, less stick? Anything specific that you've tried to talk to them about might be a bit of a concern? You might want to look into this.
I mean, God, so a number of issues. One I think good court win. We're seeing the SEC move in the right direction there. There have been some good. The courts have stepped in, and that's helped move things along. But we get a chance to legislate on these issues, and I think you'll see some of that in the coming months.
PB also recently put out their proposed rule, the 1033, the one that basically really allows consumers to have over the data that they have at banks, be able to kind of more easily access some of those third parties. And I'm wondering if regulations like that come out. Number one, I'm just interested in your thoughts on that one, but also how does that change how Congress sees what it needs to do as these agencies begin to come out with this potential?
We like open banking. I think that's we're moving in the right direction on that issue. Those of us who serve in Congress, we want to have a chance to weigh in for our constituents, and that's whenever we can, and I think hopefully as we become more of a to see a little more of that this year and next.
Fingers crossed. Well, next year's election season, you get about 3 to 4 months of real lawmaking, and then it's just back home in the districts. I did want to ask very quickly, just about AI, because I know that's another area that Congress has interest in, that is trying to tackle with. I'm wondering kind of how you see AI and fintech playing together at this point, and if there are any particular areas that you need to really take a close look at and really try and be regulating or getting ahead of.
I think the more time dedicate to the issue, the better. For folks like me, I have to admit I'm trying to learn as much as I can. And I think the way we approach the issue will matter tremendously for the economy, for the way we move forward. but you know, there's just so much to try to unpack, and there's not a lot of, but it's one that, you know, we need to really come up with good bipartisan to, you know, this incredibly rapidly changing technology.
Do you have a sense of some of these things? Because I feel like a lot of it right now is like, well, we need to education, we need to socialize, we need to, I mean, what is like a realistic time? Seeing some very serious legislation on fintech, on AI. Is this going to be a matter of decades?
You know, what we do is we get some crisis, something happens, and then we respond. You know, bank, you know, then we focus on banking. You know, the debt ceiling, you know, all right, we gotta get our house. That just unfortunately seems to drive a lot of what we do in Washington, and it's not the best way to approach things.
Well, if you have any other ideas. It's a bit of a somber note to end on, but we appreciate your time today.
Well, I think the best I heard, we are keeping everybody from an open bar downstairs. So. Oh
well, in which case we'll wrap up very quickly then. Congress, so much for taking the time chatting today. Thank you guys, and we're gonna have Chris come back on. Thank you so much.
Okay, I just want to say one quick go for drinks downstairs. Really big. I want everybody to get up and give a big clap for a Camille Sullivan who did every. Camilla! Yoo-hoo! She is the power behind this, and she literally, I mean, the number of like 4 o'clock in the morning, I can't emails from Going Wave. She deserves all the credit. Way out. Drinks downstairs. Thank you so much, every guys, and see you tomorrow.